introduce the facilitator for this morning's session. I'd like to, we already know the drill. It's an all-day event. We are taking 5 modules today, and we'll be taking the additional 5 modules tomorrow when we'll be closing the session for this season. So without further ado, without wasting further time, I'd like to introduce the facilitator for ethics with which we are starting off this session, Odiri Ogini. She is a CFA charter holder and one of the society leaders of CFA Society. Odiri, you have the floor.
Thank you very much, Yemi, and good morning, everyone. It's good to be here to support every one of you in this journey, a very interesting journey, very worthwhile journey, but also a very taxing journey. So my name is Odiri Ogini. I'll be taking the ethics part of the curriculum. It's a 1-hour session, so my focus will be on key points, so I won't go too detailed. You know, ethics is a very worded session, so I will try and highlight key points and also share questions that I will want everyone to participate in the chat box. So when there's a question, I read through the question, you just drop the answers in the chat box, and if it's correct, I'll take it and then I'll explain also why that's the correct answer, or if not, also explain why those other answers are not the correct answers. So let's go on. I hope you can see my screen. Please, if you can see my screen, just put it up in the chat box. Yes, you can see my screen. As much as possible. All right, as much as possible, I want this to be a bit more interactive, so most of the interaction will be on the chat box anyway. All right, thank you. I can see the yes. So on the ethics section, we have about 5 readings, and the first reading talks about ethics and trust in the investment profession. I'm an asset manager. I work in the investment management industry, so I can tell you for sure that trust is a very big part, you know, of the industry. If your clients don't have trust in you, trust me, no matter how good your returns are, you know, your pedigrees are, you know, nobody will really patronize you. So the unethical behavior of an employee can have a devastating effect on a firm and other employees for no fault of theirs. So there's a the curriculum started with the story of an analyst, the action of an analyst at a financial service firm, a research analyst who felt he could support his own firm, you know, by misrepresenting the research report, which backfired to the firm. And at the end of the day, you know, the firm had to pay for it. They had to probably shut down. They had to send, ask some employees to go. So that's the action of one single individual, you know, had a ripple effect on the firm as well as other employees of no fault of theirs. So the bedrock of the investment management industry is actually trust, and ethical behavior is a key part of that structure of trust, which is why this ethics session is starting with the concept of trust. So business and financial market flourish on trust. So when we talk about ethical behavior, it's really not just about obeying rules, laws, and regulation. It is more about identifying potential conflicts and acting religiously in situations where there are no stated rules. So there are times when there are no rules, or even the rules are not clear, you know, and so at the end of the day, you might not know what to do. But what ethical behavior is saying is basically, you know, look at, are there potential conflicts, you know, how do you act in that kind of situation such that, you know, you take into cognizance the impact on other people, on the other stakeholders, on your colleagues in the office, you know, your colleagues within the industry, in cases where there are no rules. So like I said earlier, trust is a key ingredient in investment management, and trust is about trust is established by acting with care, due diligence, and judgment for clients. When market participants trust investment management professionals, it leads to efficient capital markets and a smooth function, which in turn helps in the development of the economy. So, but the truth is, it's not easy to behave ethically. You know, I can tell you that it is not an easy thing to behave ethically. We know that sometimes people say, oh, you know, this is a gray area, is neither here nor there. You know, that's where people are trying to compromise, you know, when they're in a particular situation, because there are challenges to ethical behavior. And one of such challenges that was highlighted in the curriculum is the fact that sometimes we overstate our own morality. You know, there's this overconfidence that, you know, I am more ethical. You know, people believe that they are more ethical than they really are. And overconfidence can lead to poor decision making, you know, because emotions is involved. It tends to cloud our judgment, you know, and at the end of the day, the decisions you are making, you know, are in your own interest rather than in the interest of, you know, the other stakeholders. So overstating our own morality, overconfidence is one of the challenges of ethical behavior. Another challenge of ethical behavior or ethical conduct is what we call situational influences. So for overstating one's morality, I will look at that as an internal factor. You know, that's an internal factor. For situational influences, that's basically an external factor, something that external cultural, social, environmental factors that influence your own thinking or your own behavior. So what do I mean by that? You know, in investment management industry or even in investment professional, we know that, you know, employers pay good money, either in terms of compensation or salary, as well as bonus, or, you know, promotions come, you know, at regularly to a large extent. And so the desire to say, oh, I want to get a good bonus, like the story of the research analyst, or I want my firm to do well so that they can promote me, they can pay me good bonus. That's basically thinking or acting in the short term without taking cognizance of what the long-term implication would be. So that's basically one situational influence that can affect your decision making. Another, sorry, there's something distracting my slide.
I can see your slide now.
Yeah, but okay. All right, so another situational influence that can affect our decision making is money and procedures I've talked about, and then loyalty to employers, colleagues, and employees. So, you know, loyalty can be a positive or a negative one. So if you're loyal to somebody, you want to do what the person wants. You know, you want to please the person. You know, whether you're loyal to your employer or you're loyal to a colleague. So when they tell you to do something that is unethical, there's that tendency to do it. The same way when they tell you to do something that is ethical, or someone encourages you to probably register for the CFA exam, you want to do it because you are loyal to that person. So that's those factors come under situational influences, and they are basically external factors that tend to affect, you know, or challenge our ethical behavior. Another concept that was highlighted in the curriculum is the fact that, you know, the fact that you act in accordance with the law doesn't make you ethical. So there's a difference between being ethical and legal. So there are cases that can be termed ethical, but they are not legal. You know, they are ethical, but they are not legal. So for instance, civil disobedience, protests, where you whistleblow, those are ethical behaviors, but they are not necessarily legal behaviors. You can also have a case where they are not legal as well as they are not ethical, as well as cases that are legal and ethical, or legal and not ethical. So for legal and not ethical, we can talk about insider trading. So in Nigeria, insider trading might be illegal, but you might go to certain parts, other countries where it is not illegal. But we all know that according to the CFA Institute from perspective, you know, and also investment professionals, insider trading is not ethical. So basically acting in accordance with the law and acting ethically are not the same. You know, so laws are not sufficient to ensure that ethical conduct among market participants can be obeyed. So the fact that, you know, there are laws doesn't mean that, you know, if you obey them, it means that you are ethical. No. You know, ethical conduct requires us to go beyond what is actually legal. You know, what it expects us to do is to consider the impact on all the stakeholders. How will my action affect this other person? How will my action affect my employer? How will it affect, you know, my colleagues? How will it affect other stakeholders? And on the back of that, make good choices. whether there are laws and there are regulations in place or not. So basically, I think ethics, the burden of ethics rests on us as individuals, us as professionals. So, but one of the key things here I also want to emphasize is that there are ethical decision-making framework. So there's a process also to helping investment professionals to adhere to codes of ethics. And there are four process in that framework. The first is identification phase. So identify all the relevant facts, lay all the cards on the table, look at things extensively. Make sure you are able to distinguish between what is fact and basically what is opinion. But the core thing here is identify all the relevant facts, lay all the biases, the judgments, the conflict of interest, put them out on the table. And then you now begin to analyze them, which is the next phase, consideration phase. Begin to analyze it. Consider situational influences, which I've talked earlier, consider the biases that might come up, and then seek guidance. So guidance could be from maybe your compliance department, it could be from the CFA Society, Nigeria, it could be from the institute, but seek guidance based on the facts that you have come up with and in the course of analyzing those facts. And then you decide and act. After the decision and action has been taken, then you can now reflect. Look at what the outcome that you got. Is it what you're expecting? Why is it or why is it not? And then at the end of the day, you might have to go through the entire process again. So if the outcome you have is not what you're expecting, then you have to go back to start all over the identification phase, laying down all the facts and reviewing the facts, the judgment, the biases, the conflict of interest, and then going through the constitution again, analyzing those things, making a decision. If you get to the stage of reflecting at the outcome, so it's an iteration process which you have to continue to do. So this 4-process framework helps us as investment professionals to be able to comply or adhere to the code of ethics. So this is just a highlight of the first reading talking about ethics and trust in the investment professional. So I'm going to throw up some questions which I want response in the chat box. So the first question says, an ethical decision-making framework A is legally required to be implemented by all investment management firms. B provides investment professionals with a tool to help them adhere to a code of ethics. And 3 helps decision makers avoiding unethical decisions and guarantees a positive outcome. I can see C, I can see B. An ethical decision-making framework provides investment professionals with a tool to help them adhere to a code of ethics. So I talked about the ethical decision framework, which is the identification phase, the consideration phase, the decision and acting phase, as well as the reflecting phase. So basically it's a tool that helps investment professionals to adhere to a code of ethics. So thank you everyone who said B. The second question says, firms which are more ethical, A, may incur lower regulatory costs. 2, make better investment decisions. C, comply with legal and regulatory requirements. I can see A. I can see more of A. So definitely as a firm, if you are more ethical, definitely the fine will be reduced, penalties will be reduced. So the costs you pay to regulators will also be the option, most ideal option. The next statement, most accurately, the law cannot be used as to ensure ethical behavior. Law being legal as well as necessarily being the same, and then not be used as a mechanism to ensure ethical. Doesn't mean that you obey the ethical. So the first option says law practices subject to interpretation and it's problematic for market ethics required judgment, and a new law may reduce an existing activity while creating a different but similarly problematic. B, I can see C. So first of all, laws market practices. So that's not correct. Market practices. So when market practices, regulators can, just to, market practice if it's negative. This says laws are not subject to interpretation. Subject to interpretation. I can interpret the want it if it will be beneficial to me in a way that may be different from. And then C, a new law may read an existing activity while for a different one, which is true. You can come up with a law to practice, but that might also create for a different or even more on the back of that. So the answer is which of the following statement with respect to influences is least likely correct? How situational influences as that impact our decision making. So which of the following statements is correct? The first is overestimation of our own behavior in unfamiliar situation is an situational influence. B, situational influences accepting long-term risk as a result of focusing on. And then C and B, I can see A, which is interesting. Of colleagues and the employer behavior is an extremely powerful influence. So which of the situational influences is least likely? So we said situational external factor. One of the points we highlighted as a challenge conduct is overestimating. That's an internal factor. Overestimating the morality of our own behavior, especially in unfamiliar situations, is an important situational influence. No, that's an internal factor. That's not an external factor. So the answer is A. That's least likely correct. So overestimating the morality of our own behavior is an internal factor. That's overconfidence bias. It's not a situational influence, which is an external factor. And then an individual internal traits and intrinsic motivations, the primary determinant of whether an individual will act ethically in a certain situation. A, yes. B, no. Large financial reward, and I say are the most powerful incentive for individuals. And then C, no. Good people with honorable motives can also behave unethically in a certain situation. So I can see A, I can see C. The answer is C. Good people with honorable motives can also behave unethically. So when you place somebody in a particular situation, no matter how good that person is, it's still possible for that person to behave unethically. So the answer is C. Okay, so that's we'll move on to the second reading, which speaks to the Code of Ethics and Standard of Professional Conduct. So yeah, basically, we're going to look at talk about the structure of the CFA Institute Professional Conduct Program, look at the process of enforcing the code and the standard. And so the Code of Ethics and Standard of Professional Conduct basically stipulates the rules and guidelines for CFA Institute members and candidates on how to conduct ourselves in a professional and ethical manner. So we talked about ethics and we talked about trust. And so now we are saying, what is even that ethics self? What are those code of ethics that we need to even adhere to, as a candidate, as a member of the CFA Institute? So these are things we'll be talking about in reading 2. So these codes and of ethics and standard of professional conduct basically applies to the members of the CFA Institute, CFA charter holders, as well as the CFA candidates. Now, the Professional Conduct Program, in conjunction with the Disciplinary Review Committee, is responsible for enforcing the code and the standard. Basically, DRC, which is the Disciplinary Review Committee, is a volunteer committee. They are charter holders who serve on a panel basically to review conduct and then partner with the professional conduct staff to establish and review professional conduct policy. So basically, there's a process of enforcing this code and conduct. When a member has been seen to go against any of the code of ethics and professional standards, how will that disciplinary process happen? That's what basically we're going to be looking at in the second reading. So the professional conduct inquiries reason. So you can disclose, there's this annual professional conduct supposed to disclose if they've been in some litigation, whether civil litigation. So that's a source of inquiries also for the professional conduct. Be a written complaint. The professional may receive a written complaint of misconduct, particularly during the exam. Somebody is in one way or doing things within the that could be a source also, not by CFA exam proctor for the professional conduct. So once an inquiry, there's a self-disclosure, there's a report, what happens? The conduct program team will carry out an investigation. Once if there's any violation, if they establish that on the part of the candidate or they propose a sanction, any form. It could be a public censure, suspension of membership, also CFA designation. It could also be revoking candidates may also even be suspended from further participation. How serious you take compliance with the and standard of professional conduct. So even when there's an investigation, has been established, as a candidate or a member, right to accept or refuse. If you refuse, the case is taken to the disciplinary committee. So I see the disciplinary review committee as more of an evaluator of what the program team have done. So now, what are these ethics that we need to even comply? What are the things that we need to know and ensure that we adhere to them? So according to the curriculum, there are 6 components of the code of ethics. These are important and they should be memorized. So the first talks about act with integrity, competence, diligence, respect, and an ethical manner with the public, with the client, with prospective client, with the employers, with the employees, with colleagues in the investment professional, and other participants in the global capital market. So there are various stakeholders that you have to act with integrity with. So integrity here is very, very key and a high priority in the code of ethics. Also, the next speaks to place the integrity of the investment profession and the interests of clients above your own personal interest. And then use reasonable care, go the extra mile to all extent, use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendations, taking investment action, and engaging in other professional activities. And then next speaks to practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the professional. And then back to integrity, promote the integrity and viability of the global capital market for the ultimate benefit of society. And then lastly, maintain and improve the professional competence and strive to maintain and improve the competence of other investment professionals. So these 6 components of the code of ethics they are important because there are questions that could come, and tell you to identify whether this is a code of ethics or this is a standard of professional conduct. So you should be able to distinguish between them by understanding in detail these 6 components. So I'm going to ask some questions. I want to see response in the chat box, basically on the code of ethics. So the first question says, which of the following is least likely required under the code of ethics? Members and candidates must A, promote the integrity and viability of the global capital markets for the ultimate benefit of society. B, deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, or taking investment action. And then C, maintain and improve professional competence and strive to maintain and improve the competence of other investment professionals. So the question says, which is least likely under the code of ethics? I can see a C, I can see a B. The answer is B. When we looked at the A, says promote the integrity. No, that's number 5 here, promote the integrity and viability. C says professional competence. The last one here says maintain and improve professional competence. So is not a part or is not under the code of ethics. So we need to pay particular attention to those 6 components, because if you cannot distinguish them between a standard and a difficult for you to be able to answer that question correctly. So the second question is likely a component of the CFA Institute Code of Ethics. So the first one says act with diligence and respect with global capital markets. And then the second says act fairly and objectively prospect when disseminating investment recommendation. Others to act in a professional and ethical manner that will reflect credit on profession. I can see more of B. I can see a C. So, act fairly and objectively is not a code of ethics, it's a conduct which we'll get to. So act with diligence and respect with market and encourage others to act in a professional and ethical manner that and the societies are components of the code of ethics. So the answer is B. And then the next is the responsibility of reviewing professional conduct policies falls on all of the following except. So who enforces the professional conduct policies? So I can see A, so I'll take A. So the institute, the CFA Institute Board of Governance is not part of the review. It's not part of the responsibility for establishing and reviewing professional conduct. We talked about the role of the disciplinary review committee. We also talked about the role of the professional conduct program team or division. And then let's also take this next question. An exam proctor submitted a evaluation against a CFA level 1 candidate. The designated officer, upon reviewing the matter, found that the violation of the code and standard had occurred and proposed a disciplinary action. Can the candidate reject the disciplinary action proposed by the designated officer? A says yes, the candidate can accept or reject. B says no, the candidate has to accept the disciplinary action. And then C says no, because if the candidate does not accept the disciplinary action, he will be suspended. So I can see A. So the answer is A. Yes, you have an option to accept or reject. And once you reject, it's taken to the disciplinary review committee for further review. So the next reading we are going to look at is the guidance for standards. So we talked about the code of ethics, and now this is professional conduct, standard of professional conduct. So we're going to look at that in details. So there are 6 code of ethics and there are 7 standard of professional conduct. We need to know the difference between the two. There are questions that may come up that it might be a code of ethics, but if you mistake it for a standard of professional conduct, that might be inaccurate. So the first standard here talks about professionalism, which is the components under professionalism means knowledge, includes knowledge of the law. So you need to understand and comply with all applicable laws and regulations, including the codes as well as the standard. One of the things I also want to draw here is where there are where there's a law and then there's a standard, comply with the stricter one. So that's a principle that we should not forget, always comply with the stricter law. The second talks about independence and objectivity. So to a large extent, as investment professionals, use reasonable care to achieve and maintain your independence and objectivity. Maintaining your independence and objectivity helps you to protect the integrity of your opinion. So do everything it takes. If you have to restrict special cost arrangement for flights, if you have to limit gift, don't solicit for gifts, anything that will ensure that your independence and your objectivity is protected, as investment professionals, we have to do. And then the next talks about misrepresentation. What that means is that do not knowingly make any misrepresentation relating to investment analysis and recommendation of professional activities. So don't omit facts or outcome. And this is because trust is the foundation of any client-customer relationship, which is what we talked about at the beginning, that trust is important. And then the next talks about misconduct. Do not engage in any professional misconduct such as dishonesty or fraud or deceit. Now, it's possible that an investment professional maybe have to declare bankruptcy. So personal bankruptcy is not a misconduct, except what led to that bankruptcy, it's as a result of fraud or deceit. And then the next standard talks about the integrity of the capital markets. So basically, do not act or cause others to act on material non-public information. So if you're particularly for research analysts or traders, if you are in possession of any information, if that information is not yet public and that information is material in the sense that it can affect the value of that investment, then you cannot deal on it, you cannot act on it. The next talk about market manipulation. What that means is that don't engage in practices that will artificially distort prices with the intent to mislead market participants. So, there are times when as a broker or as a firm, you might engage a broker to carry out activities on your share price, such that, the goal is, I want people to think that, people are trying to mop up this share price, so, you are just trying to create artificial scarcity or trying to deceive people so that people can rush towards buying your shares, so that the price can increase. That's what we call market manipulation. So it says, don't engage in such practices that will artificially distort prices or mislead people, mislead market participants. The third standard talks about duties to clients. So we, as investment professionals, we have a duty to our client, and that duty includes loyalty to them, act with reasonable care, exercise prudent judgment, and act in their interest, as well as place their interests above your own interests and also the interests of your firm. Also, fair dealing, deal fairly and objectively with all your clients when you're providing investment analysis. Now, it's possible to deal fairly. It doesn't mean that you are dealing equally. So being fair and being equal, they're not the same thing. So when you are dealing fairly, it means that you're taking into cognizance everyone. But you might send an investment recommendation to all your clients at the same time, but some might read it now, some might not read it now. You won't say, oh, until everybody reads it, before I can now take an action on it because I want to be fair to everybody. No, as long as you have disseminated that information equally, fairly to everybody, it doesn't mean that it must be done equally at the same time. And then next duty to client talks about suitability. Suitability here says, when you are making investment recommendation, you must consider, is this recommendation suitable for the client? And suitability also from the context of the entire client's portfolio, not just a part of his portfolio, but the entire total portfolio of the client. Is this suitable for this client's financial situation? Is this suitable for his risk profile? Is this suitable for his return expectation? That has to be considered when making investment recommendation. Also, we are under duties to client. We talk about investment performance communication. Your communication of investment performance to client must be fair. It must be accurate. You must not have any error in it, and also it must be complete. You're not communicating only when you are doing well. You communicate both the good and the bad, and then preserve the confidentiality of your client, except your client permits you to disclose or is required by law, or if there's an illegal activities involved, you need to protect the confidentiality of your clients. The next standard talks about duties to employer. So we have a duty to our client, you also have a duty to our employer. And one of the duties of the employer is about loyalty also. We talked about loyalty to client, you also see loyalty to employer. So loyalty for employer basically says, I'm going to use my skills to benefit my employer. I'm also not going to divulge confidential information that can cause harm to my employer. And then don't enter into compensation arrangement that will compete or create a conflict with your employer. If it has to be done, then you have to disclose. Written consent must be gotten from all parties involved. But the primary principle here is do not engage in any compensation arrangement that will be seen as a conflict of interest or put you in a situation where you are competing with your employer. So let me give an instance. So you work in an asset management firm, you provide investments and financial advisory services, and then you are doing that on the sideline for somebody. To a large extent, someone will say, oh, but these are clients that my firm will not accept, they are small clients. But you have to disclose that, and you have to get written consent from your employer that they know about it and they don't see it as a conflict of interest. So that's very important. And then lastly, talks about responsibility of supervisors. So as a supervisor, you can delegate, to a member of your team, but that doesn't absolve you of any responsibility. You delegate, but you still take ownership of ensuring compliance with the applicable laws and regulations. And then the next standard talks about investment analysis, recommendations, and actions. So basically, exercise diligence, exercise independence and thoroughness in analyzing investment. So if you look at these standards, what basically comes to mind is the fact that these are high standard And every point in time, we need to ensure that, that we maintain that level of high standard in either in making investment analysis, or we are making recommendations, or in our dealings with our clients on a daily basis. And then communicating with our clients and prospective clients, we need to be mindful of what is a fact and what is an opinion, and we need to distinguish that in our research report, basically. And then retain records that support investment analysis and conclusion. So you go through the rigor of coming out, doing a lot of analysis to make your investment recommendation. You ensure that those records are kept. So the CFA Institute recommends retaining records for at least a period of 7 years at the minimum. Another standard that is very important is the conflict of interest. So for conflict of interest, full and fair disclosure is very important. Full and fair disclosure of all matters that could reasonably be expected to impair an investment professional's independence and objectivity. Another area is priority of transaction. So investment transactions for a client and your employer must come before your own personal interest or your own personal transactions where you have an interest in it. It doesn't mean that it must, because this is a family member, you cannot deal with that client until you have done for your client and for the employer. But as long as that family member is a client, he has to be treated as a client, not as a family member. And then referral fees. For referral fees, I think the idea here is to disclose to your employer. This is one particular area where a lot of us, we really don't pay particular attention to it, because you give investment recommendation, you do this, but in one way or the other, some people get referral fees for doing that, but the standard in Nigeria has not really been very steep, ensuring that there's full disclosure. But for the CFA Institute standard, we must disclose to our employer and also to client or prospective clients if in any way, we are getting compensation for any investment advice or recommendation of a product or service that we are giving. And then lastly, responsibility as CFA Institute members or as CFA candidates. So we also have responsibilities as members and as candidates. And one of such responsibilities, don't engage in any conduct that compromises the reputation or the integrity of the CFA Institute, the CFA designation, or the integrity, validity, and security of the CFA Institute program. There are some questions that will help us, throw more light on that. And then don't misrepresent or as the meaning of or the implication of membership in the CFA. So because I'm a CFA charter holder, I might want to give the impression that I can deliver outrageous return, competitive return, just because I'm a CFA charter holder. That is not as part of the standard. And then the CFA, the Chartered Financial Analyst and the CFA marks must be used as adjective or after the CFA charter holder's name is prohibited to be used as a noun. So you can't say Odiri is a CFA. I hear that a lot. Odiri is a CFA. So it should be used as an adjective, used after the name, and it cannot. And then reference to CFA Institute, the CFA designation, and CFA program is not intended to prohibit statement of facts. You can say that as a CFA charter holder, I am committed to ensuring a high standard in my investment recommendation. That's a statement of facts. So the fact that we don't want to misrepresent doesn't prohibit from saying factual statements that are related to positive benefits of the CFA designation. So let's look at some few questions here. The first question. Sarah Wallis has recently passed CFA level 2. Of the CFA exam, she's applying for a position in the qualifications and experience statement. Statement 1 says, I have successfully passed the first 2 levels of the CFA exam attempt. The second statement says, since I've been working in the industry, I expect to end my charter 1 year after completing the CFA level, completing the final level of the CFA exam. Wallace is most likely in violation of the CFA Institute standard of professional conduct with respect to what? Statement 1, statement 2. I can see a lot of B, which is interesting. So yes, for statement 1, that's a factor. That's a fact. She passed the first 2 levels of the exam in consecutive attempts. That's a statement of fact. We're not prohibited from giving a statement of fact. The second statement is saying that, you're already ascribing your charter in the future, which is not acceptable, because there are a lot of process, there are a lot of things that needs to be done, before you can even get the charter. So saying that I'm going to get it in next 2 years or in next 3 years after I pass my is a violation of the CFA Institute statement, standard of professional conduct. So the correct answer is statement 2. So the next question says here, which of the following is not the proper reference to the CFA program? The CFA charter holders are trusted, objective experts who have been trained in investment ethics and are held accountable to a strong code of ethics. B says the CFA charter holder achieves better performance results as they pass 3 levels of rigorous exam that test an advanced curriculum of investment management and analysis skill. And then C says CFA charter holders have one of the most up-to-date and advanced skills set on the planet because of minimum 4 years of experience in the investment decision-making role and insight. So which of this is not a proper reference to the CFA program? I can see a lot of B. So B is correct. So for A, I said earlier that as a CFA charter holder, you are not prohibited from giving a statement of facts or even references to the benefit of having the CFA charter holder. So A and C speaks to a large extent to the benefit of being a CFA charter holder. But B says as a CFA charter holder, you can achieve better performance results, which may not necessarily be the case. So that's more of a representation. So the answer is B. The next question says, which of the following situations least likely constitute a violation of the CFA Institute code and standard? A says, senior researcher obtained information concerning a potential merger deal pertaining to an issuer company covered by him, which is yet to be publicly released. The researcher disclosed this information to his supervisor and compliance department. B says, McCree recently passed CFA level 2 exam and does not intend to appear for the level 3 exam for at least 3 years. And then he identified himself as an active candidate of the CFA program. And then it says, portfolio manager allocates oversubscribed IPO shares to suitable non-family client account prior to family client account to avoid the appearance of a conflict. So which of the following situations least likely constitutes a violation? Clearly the answer is A. A is the answer because you obtained a material information and he disclosed to his supervisor and his compliance department, which will make it difficult for him to act on it. McGree says, oh, I'm not writing the exam for the next 3 years. You cannot say you're an active candidate. And then for C, allocating oversubscribed shares to suitable non-family ahead of family. As long as the family members are clients, they have to be treated as client also. But the fact that they are family member doesn't preclude them from, being treated as a client. So I'm going to move on to reading 4, which talks about the introduction to GIPS. So GIPS is like a global investment professional standard, and it's created to make it easier to compare different investment management firms. So I work in an investment management firm. There are also other investment management firms. So basically, how do you compare your investment performance? How do you ensure that what this firm is doing and this firm is doing? If they're not similar, if the basis of the performance reporting or creating that performance is not similar, it's going to be difficult to compare. So which is the purpose of GIPS? To ensure that there's uniformity, to ensure that we're all doing the same thing. It makes it easier to compare. So if anybody wants to make an investment in a particular one, he can say, oh, this one is better here because of this and this and this, and the basis for comparison are the same. So the GIPS standards were created to make it easier to compare different investment management firms. So without a standard, different firms will select the method which will make their performance look good, which is basically the truth. I can decide to highlight where I'm strong in. This other firm can decide to highlight where he or she is strong in. That makes it difficult to also compare one firm to the other. So the GIFT standard ensures fair representation and full disclosure of investment performance. The GIFT standard leads investment management firms to avoid misrepresentation of performance and to communicate all relevant information that prospective clients should know in order to evaluate past results. So the GIFT helps to avoid the following misleading practices. So one of the things, the reason why the GIFT standard is very, very important is because there are a number of misleading practices that can be curbed if there's full compliance with GIFTs. One is showcasing only the top performing portfolio to represent the firm's overall investment result. So I can say, oh, in between 2000 and 2008, my performance result was bad. From 2008 to maybe 2012, it was really very good. So I'm excited to focus on the 2008 to 2012, and that's what I'm going to be showing. That's what I'm going to be communicating to investors. Without realizing that, I'm trying to avoid the fact that those other years, because results were not good, the portfolios were not performing well, they were not competitive return, I'm not showcasing that. So GIFT standard creates a uniformity to ensure that for a certain period of time, you need to disclose your results, whether those results are good or bad. And also it avoids excluding poorly performing portfolio and presenting an average performance history, which is what we call the survivorship bias. The ones that are good are the ones that survive. That's the way I like to look at it. The ones that are not good are the ones that don't survive. And then presenting performance for a selected time period during which the mandate produced excellent results. So these three misleading practices is one of the key reasons why the Global Investment Performance Standard is very, very important for investment management firms, to ensure that there's uniformity, to ensure that there's completeness, and as well as accuracy. And then GIFT applies only to investment management firms that manage assets. So if you're a consultant, as long as you don't manage assets, you cannot claim compliance. So GIFT only apply to investment management firm. And then standard is also voluntary. It's not mandatory. It's a voluntary exercise, but it's also a voluntary exercise that gives credibility to you as an investment management firm. So comply fully with GIFT's requirement or not. So there's nothing like a partial compliance. You can't say, oh, I comply years and you're not complying now. No, it's either you are full compliance or you're not complying, and there's nothing like a partial compliance. If compliance benefits the investment management firm, it also benefits the prospective client. So as an investment management firm, it gives you credibility. That you have done the right thing, gives you credibility that they are not misleading activities that you have carried out. Say, oh, as a GIFT compliance firm, this is what we have been able to do. And for the prospective, you can be rest assured that what you are getting or what you are seeing is accurate. They are not. So it's a great benefit to both the investment management firm as well as prospective clients. Now, one of the key points about the GIFT standard is that it uses what we call composite. Composite basically is the aggregation of one or more portfolios according to a similar objective or a similar standard. So if you create a portfolio low cap stocks, that's a composite. So all the portfolios that align with that particular are all come under one particular mandate or composite. So they are all grouped all in line with a particular objective or a particular mandate or a particular investment style. For a composite, it must include all actual, so you cannot include a dummy. It must include fee paying, so the clients that you include under the composite must be clients who, truth is that they are clients who don't pay fees. So for composite, actual clients, fee paying clients, and this portfolio managed according to the same investment discretionary. So discretionary manager, you use your discretion to decide where to invest, what securities to sell, investment to put in that portfolio. But when a client makes that investment, so the client says, no, I will tell you what to buy. I will tell you when to sell discretionary portfolio. So under actual clients that pay, that you have discretion over those portfolios. firm claim compliance, they can decide to hire an independent firm to perform verification. It's also not compulsory, but verification does not ensure the specific performance representation. So the purpose to say, what we is accurate. No, that's not the essence of verification. So firms may subjectively select which portfolios to include and exclude from the calculation and present side. So you cannot just today decide, oh, I will put this one, tomorrow you say, no, I will take out this one. No. At the initial that there must be a criteria. So that criteria must have been pre-established, at the initial stage of commencing that composite. So you determine which portfolio to include at the initial stage and not at your own discretion or where maybe the organization is having trouble. You say, okay, you take out this portfolio, no, we include this. No, it must be done at what we call the ex ante basis. So I'm going to just time is almost running out, so I try as possible to round up as quickly as possible. So the first question here says, which of the following firms can most likely claim compliance? A, plan sponsor. B, software vendors. C, investment management firms. So we have said earlier that only investment management firms that manage assets can claim compliance. The second one says, which of the following statement is regarding verification? A, verification ensures the accuracy of a composite presentation. No. B, in order to claim compliance with the GIBS standard, firm must seek verification. No. The soundness of a firm's policies and procedures to calculate performance in accordance with the GIBS standard. Yes. So the answer is C. Verification is basically to test the soundness of your policies and your procedures. The next question says, which of the following is most likely correct with respect to the application of GIBS? So A, GIBS are voluntary standards that are applicable to investment managers and are developed to provide performance results to potential clients. B, GIBS are involuntary standards applicable to investment managers and are developed to provide performance results to current and potential clients. And then C, GIBS are voluntary. So note that they are applicable to investment management firms, true, and they are developed not just for current clients, they also developed for potential clients. So the answer is C. I'll take one more question. Which of the following misleading practices least likely created the needs for the GIBS standard? A says there was a conflict between performance presentation laws of different countries. Top performing portfolios were selected to represent a firm's overall investment results for a specific mandate. And then C, average performance histories were presented, which excluded portfolios with a performance track record, which were weak enough to lead to a termination of the firm. So we talked about 3 misleading practices that created the need for the GIBS standard. And if you look at the option here, A wasn't one of them. So there was a conflict between performance presentation laws of different countries. Yes, the laws of different countries, the performance presentation different for different countries wasn't the misleading practice. The need to harmonize was the reason why there's the GIBS standard, but it wasn't the A is not stated as a misleading practice. So the answer is A. So this is the last reading for the ethics, which talks about the GIBS standard. So we looked at the introduction of the GIBS standard. So here, basically, I'm just going to highlight some few key things, to note with regards to the GIBS standard. So when local laws and regulations conflict with GIBS, GIBS is voluntary. But when there's a conflict between the local laws and regulation and what is stated in GIBS, firms are required to comply with the local laws and regulation. Earlier, when I was talking about the standard, the professional standard, we said comply with the stricter laws. But here, under GIBS, we are saying when there's a conflict between local laws and GIBS, comply with the local laws, but make full disclosure of the conflict. And the firm can still claim compliance. So even when you comply with the local laws, when there's a conflict, you must make disclosure, but you can still be able to claim compliance. So that's a key point to note. And then there are 9 major sections of the GIBS standard, which we need to read and highlight some of the key points which can be asked in a question. There are fundamentals of compliance, input data, calculation methodology, composite construction, disclosure, presentation and reporting, real estate, private equity, wrapped fees, and separately managed account portfolios. So you might see questions that might put about 2 of these and then put a third item and ask which of the following is not a major section of the GIBS standard. So knowing those 9 major sections of the GIBS standard is really very important. And the GIBS standard must be applied on a firm-wide basis. It's not applied on a portfolio basis or on a client basis. It's applied on a firm-wide basis. And then a firm is required to initially present at least a minimum of 5 years of annual investment performance that is compliant with the GIBS standard. So if you're not been in business for up to 5 years, then is that number of years you've been in business. If you've been in business for more than 5 years, then at least a minimum of 5 years. And then later the firm might present an additional year of performance, building up to a minimum of 10 years of GIBS compliant performance. Now, the initial minimum period for which verification can be performed is 1 year of a firm's presented performance. So you might have done 5 years, but you might decide to do verification for only for 1 year at least, which is also still fine. For periods beginning on or after 1st of January 2011, total firm assets must be, so understanding the definition of total firm assets is also something I noticed as a testable principle. So total firm asset must be the aggregate value of all discretionary and non-discretionary assets managed by the firm. So what's the definition of total firm assets? It must include discretionary and non-discretionary. It must include fee-paying and non-fee-paying clients. And also, we should not confuse this with composite. I talked about composite previously and said composite is only for actual clients that are paying fee and they are discretionary, which is different from total firm assets, which includes both discretionary and non-discretionary, fee-paying and non-fee-paying. So then lastly, changes in a firm's organization must not lead to altercation of historical composite performance. So the fact that you change your structure along the way for the organization, or you change, organization process along the way, does not mean that you will not have to go and alter the historical composite performance. So we'll take a few questions before I close. I think I have about 2 minutes or 2-3 minutes. So the first question says, which of the following is this likely the section of GIBS? I talked about the 9 section of GIBS, and I said that we need to at least know those 9 sections, because there might question that might include like 2 or 1, and then ask which one is or which is not likely. Yes, you are getting the slides. So which of the following is this likely the section of GIBS? The first talks about input data, B says equity construction, and then C, presentation and reporting. So I can see a lot of B. The answer is B, equity construction. So input data is a section of GIBS, presentation and reporting is a section of GIBS. The next question says, which of the following action of investment management firm complying with GIBS is voluntary? Which of the following action of investment management firm complying with GIBS is voluntary? A, listing discontinued composite for 5 years. B, independent third-party verification. And then C, applying GIBS on a firm-wide basis. Which of the following is involuntary? So independent third-party verification is voluntary. So you might claim GIBS and decide not to go the next level, the next step of doing a verification. That's also voluntary. And then next question. It says, Victor Associates is a firm that claimed compliance with GIBS 3 years ago, the same year it got established. Last year, the firm decided to get its compliance presentation verified by an independent third party. While presenting 3 years of GIBS compliant performance data, the firm made the following statement. Only the last year of performance data has been verified by an independent third party. As Victor Associates most likely met the requirements of the GIBS standard? Options are A, yes. B, no, because verification needs to be performed for all 3 years. C, no, because such a statement claiming verification cannot be made. So the answer here is A. because you can claim compliance for gifts for 3 years and you can decide to do verification for at least a minimum of 1 year. So I'll take one last question and then I'll close the session. So Dental Incorporated has been in existence since 2001 and has decided to comply with the gifts in 2012. Initially, the firm must present gifts compliant annual investment performance for a minimum of what? 5 years. So gifts compliance is a minimum of 5 years, except your years of establishment is less than 5. Other than that, a minimum of 5 years, and then you build it up 1 year after, up to a minimum, up to 10 years. So I think my time is up. I'll share the slides, for those who are also interested in looking at the other question. Thank you very much for having me.
Thank you, Adiri. Well done. Thank you very much. The next class will be portfolio management, led by Bukola Akerele. She's trying to sign in with little network issues, so please bear with us for a few seconds. Hi, Bukola. Are you able to share your screen now?
Yes. Sorry about the issues. Yeah, I should. Yeah, I'm good.
All right, you have the floor.
Anyway, can I see my screen right now?
Yes.
Yeah, good morning, everyone. Sorry for the slight minute delay. I had issues with my network, but I believe I'm back in fully right now and then should be able to have a go. Yeah, I'll be taking you guys a quick review of portfolio management. So basically, my name is Bukola Akerele, sorry. And basically what we're going to be doing is just to highlight the key points of the learning outcome statement. And then also now going to now try to answer some free questions. So what we're going to do for the question aspect, when you see the questions on the board, just go to the chat room and chatting what you think the answer is supposed to be. So whatever it is, if you are right or wrong, I'll let you know. And anyone that needs clarifications, they're able to move ahead. So the first reading in your portfolio management is an overview of the whole investment process. We said that it's better for us to invest in a portfolio than to invest in a single asset, so that we'll be able to diversify our risk and ensure that we'll be able to have two investments. Sorry, just a minute, somebody's chatting.
Okay, can you please put your screen on slideshow to make it more legible?
Yeah, sure. Sorry about that because of the rush. I figured that's better now. So we're saying that it's better for you to have a portfolio of investment. That means you having different investments that have low correlation with one another. And when we talk about low correlation, we are saying that they should not be in the same industry and not be affected by the same rules or regulation, than for you to have one single investment. Because when you have a portfolio of investment, it's easier for you to get the same return as a single portfolio, but at a reduced risk, which means that if you have 5 assets in your portfolio and probably you make a loss on one, you have 3 others to actually help you to recoup the loss. As against when you have just one portfolio or just one investment in your portfolio, if you lose one, you lose all. So we are saying that it's better for you to have a portfolio, and that there are different steps in portfolio management. Talk about the planning stage, talk about the investment stage and all. We're not going to really bother so much on that. And then we have different types of investors. Now, the investors are broken down into two different types. We have individual investors and then we have institutional investors. Individual investors cannot be grouped together because different people have different reasons why they're investing. So you invest for each person according to his own risk and return characteristics. But under the investment, under the institutional investments, they're able to categorize them because they have similar characteristics and similar risk. And then that means they expect the same kind of return from their investments. So under the institutional investors, you have the banks, you have your defined contribution pension plan, you have your endowment funds, foundations and endowments, you have your sovereign wealth funds, and you have insurance companies. So we are saying that when you're going to look at all those ones individually, and then you're also talk about what their risk and returns are. For instance, out of the 5 institutional investors, the banks have the highest risk because theirs are demand deposits. So you have to ensure that the banks are invested in money markets or near money market instruments so they can easily convert it to cash. While under insurance, you have 2 types of insurance. You have the life insurance and you have the property insurance. Now we'll say that the property insurance have more risk ability than the life insurance. Sorry, less risk ability than the life insurance, because for life insurance, you have kind of like the number of years that the person you're insuring is going to stay. Unlike, sorry, I'm responding, sorry, just a minute. So your life insurance, because you have the period in which you're insuring a person, you can actually be able to take more risk than when you have property insurance, that the person can easily come to you at any time to ask you for their claims. So you have to look at that also in different aspects. And then under the defined contribution and defined pension plan, there's a difference, because under the defined contribution, what happens, like what we have in Nigeria right now, that you and your employer just invest in a pool of assets, and then the risk of that asset lies solely with you. But under the defined benefit pension plan, the risk and return of the investment lies with your employer. So when we're talking about the portfolio management approach, we're talking about the defined contribution and not the defined benefit plan. And then we all have different kinds of investment products that helps people to be able to achieve this portfolio in case they don't have enough money to do it on their own. So under that, we have the mutual funds. Now, your mutual funds can either be an open-ended mutual fund or a closed-ended mutual fund. An open-ended mutual fund is a mutual fund in which you can trade, buy and sell with the plan sponsor. But the price at which you are going to sell or buy will be set at the close of business, which is at the net asset value at the closing day. And your net asset value, as the case may be, is equal to the asset of the funds minus the liabilities divided by the number of shares outstanding. Divided by the number of shares outstanding. While under the closed-ended mutual funds, you don't trade with the plan sponsor. You trade on an exchange, buying and selling on an exchange. So at the end of the day, the number of shares of a closed mutual fund is static, while that of an open-ended mutual fund changes as the case may be. That's the overview I'm going to have on portfolio management. I'm going to go into questions now. So please just try and answer the questions in the chat room, and then we'll take it up from there, if that is fine with everyone. Yeah, sorry, for those that are saying my slides are overview, what I did was we're going to focus more on questions. So I'm just going to pick each topic and tell you exactly what you need to know in those topics, and then we'll move on from there so that our class will not be too bulky, and because we have just 1 hour to do this review. So sorry about those that are saying that my slides are still on overview. Yes, I have some answers. I'm having some answers. Yes, the answer is C. The main reason why you are trying to do a portfolio is for us to have more diversification. Thank you. Question 2. Yeah, I'm having a diverse of answers right now, but the consensus seems to be A, and A is the correct answer. The question says, what are you not going to be able to eliminate? And you cannot eliminate totally the risk of loss. What your portfolio approach to investing is going to help you to do is to reduce the risk of loss, but not totally eliminate it. Yes, you will be able to remove concentration in one security. So I'm going to just let you know that we need to actually read the questions to understand. What this question asking is least likely eliminate, not what you are going to eliminate. In the question I've read, what will the investor be able to eliminate? Then the answer will have been B, because you're going to eliminate concentration in one security. But the question is asking us what you will not be able to eliminate. So the answer is A, the risk of loss. Let's just take a second to actually ensure that we understand the question that is being asked of us. Question 3. Well, sorry, we've not touched on this, but okay, let's move on to question 4. Thank you. We already said defined benefit is not part of what we are looking at, so it's out of it. And charitable foundation has a higher risk tolerance than insurance companies. So the answer is A. For Judith, we just at Amarachi, defined benefit is not part of what we're talking about. I think I mentioned that because under defined benefit. Oh, sorry, I was not I made a mistake. Benefit is part of it. Is defined contribution that's not part of it, because defined contribution is under individuals, while defined benefit is for your employers, yes. But the answer is A, insurance company. Like I said, claims can come at any time, so you need to have majority of your investment in near cash instruments. Sorry about the mix-up. We'll take the last question, then we'll go to the next learning statement. The question says, which of the following is not parts of the execution stage? It's under the execution that determine the asset classes and then analyze securities. But under the performance evaluation, which is monitoring, is where you have C. So it is C that is not part of the execution stage. Assessing your performance is not part of the execution stage. A and B are what you do under execution. C is what you don't do under execution. Thank you for those that got the answer right, and I'm sure for those that got it wrong. they understand where they got it wrong from. So let's go to the next learning statement because we have just 1 hour and those are more concentrated. Yeah, so we're going to go to the next one. This is one part which a lot of students seems to have a lot of questions. These are the learning statements, and this is the summary of what we are going to be doing. Now, under this topic, which is portfolio risk and return part 1, basically what your curriculum is talking about is, okay, you have been able to achieve the portfolio. How do you know the return in which your portfolio is giving back to you? Now, there are different ways in which you can actually measure the return of a portfolio. You have the arithmetic mean. Arithmetic mean is what we all did in primary school, which is just simple average. Now, all these returns have some assumptions which we are going to be talking about. So I'm sorry, I didn't write this down, like I said, in my slides because of the 1 hour that we are given. So I just felt we'll talk about it, people will take notes and then we'll move on. Maybe for the next bootcamp, I'll try to add what all I'm saying into my slides for those of you that are asking for the slides. Well, Gloria will decide whether you can have a slides after class or not. That does not lie with me. Okay, so we're talking about arithmetic mean. Like I said, arithmetic mean is just an average of what they taught us in primary school. Add everything that you have, divided by the number of years that you are given, that you have your arithmetic mean. The second one is geometric mean. Now, your arithmetic mean does not put into consideration compounding of your returns. So it assumes that you have a particular amount of money at the beginning of every year. That is geometric, that is arithmetic mean. But under geometric, we agree that every day your return on your investments compound until you sell. So your geometric mean returns put into consideration the compounding elements of your return. So we're going to see a question. We're probably going to start asking questions on geometric and not really arithmetic, basically. So geometric mean is the return that you use to actually be able to determine the return, the performance of your manager. It's assumed that the same, like I said, arithmetic assumes that the same amount of money is invested over time and ignores the size of underlying assets. But geometric captures the compounding effects over time. And like I said, it measures truly your realized return over your investment period. So your geometric return shows a buy and hold strategy, which means that you bought an investment and you're holding it to maturity. What return do you have from when you bought it to when you sold it? So your geometric return can be for days, can be for months, can be for years, depending on how long you are holding that for. So your geometric return sometimes is what we call your holding period return. And to get your holding period return, we'll say that the formula for your holding period return is your ending value plus any income that you receive. That is, if you received interest or dividend during the period, divided by your ending value minus 1. I can also say that it's your ending minus beginning plus income divided by your beginning. What you have there is your holding period return. Holding period means the period in which you held the investment for. Now, they can now ask you to analyze your holding period return. When you have been asked to analyze your holding period return, you now ask yourself, how many times can this investment be replicated within a year? For now, if they say that you had an holding for a quarter, so you ask yourself, I'm going to analyze that return. That means I'm assuming that at the end of each quarter, I'm rolling over this investment. So how many times will I be able to roll over this investment in a year? So when you're saying quarterly, there are 4 quarters in a year. There are 3 months in a quarter. So that means for quarterly results, you're able to hold, we are able to turn over your investment over 4 periods. So whatever you have as a holding period return, which is your R, so you now be 1 plus R raised power 4 minus 1. So if your investment period is less than 1 year, so you have 1 plus R raised power 12 divided by N, N being the number of months within the period. For instance, like I said, if you're having it for a quarter has 3 months in it. Most times, candidates may take a quarter to be 3 times a year, as in 4 months, but there are 3 months in a quarter. So if you have 12 divided by 3, you have the 4 that I wrote here. If your investment period is over 1 year, is above one year, you have 1 plus R raised to power 1 divided by Y. So which means if I have 18 months, and I can still do 12 divided by N also, if I have 18 months, that means I have the period for 1.5 years. So I'm going to have to capitalize this for less than 1 year, which will now be what? 12 divided by what? 18. If you have it in years, you have 1 over Y. So if I have 3 years investment, I have 1 divided by 3 minus 1. That means what I'm looking for is just a fraction of what I have done so far. So that is how you're able to analyze your holding period return. Then also we have other period returns. We have what we call the money weighted return. The money weighted return is same as the IRR that you have in corporate finance. And that cannot be used to measure the performance of a manager because the investment owner has the right to determine when to bring in money and when to bring out money. So you cannot use your money market return to be able to judge which manager is performing better than the other. Then we have what we call our time-weighted return. Time-weighted return always assume if you have more than 1 year investment, assumes that if you have sold this investment at this period in time, what would be your income at the end of the day? And then this one goes about start talking about your 2-asset portfolio. Start division of your 2-asset portfolio. Remember, we said we are talking about portfolio. So that means at least you must have 2 minimum assets in your portfolio. So now talk about portfolio returns. Now talk about standard deviation of the portfolio. Your return of your portfolio will be equal to the weight of each of the assets divided by the return of each of the assets. The return of your portfolio is equal to the weight of each of the assets in the portfolio multiplied by return of that portfolio. So for instance, if I have 2 assets in my portfolio, one is giving me 7% return, another one is giving 10% return, and I divided my portfolio, 20% of my portfolio is in 7% return, and 80% of my portfolio is in 10% return. The return of my portfolio will be 0.2, which is 20%, times 7 plus 0.8 times 10. You have 1.4 plus 8. That means the return of my portfolio is 9.4. Is a simple weighted average of the 2 returns. But note something, your weights must always be equal to 1. Either you're doing it in decimal or in percentages, it must always be either equal to 1 or 100%, because we assume that all your investment forms a whole pie. And then when we're looking about the risk of the portfolio, we measure that by what we call the standard deviation. The standard deviation also has to do with the deviations of each of those assets, the weight of each of those assets, and the correlation coefficients between those 2 assets. One thing you should note, and one of the pitfalls that students face, is that when you see a question of standard deviation, they will give you the return, they give you standard deviation, they will give you the correlation. Sometimes some students make a mistake and add or include the return of the portfolio when they are trying to calculate a standard deviation. Please, when you see a question like that, just ignore the returns. You don't need the return to be able to determine what the standard deviation of a portfolio is. And standard deviation of a portfolio, remember, standard deviation is the square root of the variance. So you have to open your square root. Then you have the weight squared of asset A times the variance of asset A plus the weight squared of asset B times the variance of asset B plus 2 times the weight of A, weight of B, standard of A, standard of B, correlation between A and B. Now, some questions will give you covariance. Standard deviation of A times standard of B times the correlation is what is referred to as what? The covariance. So when you have covariance in your question, don't bother trying to find out what the correlation is. Just take it and know that it is all these elements. Now, some students also go ahead to make a mistake, and they will give them covariance. They'll use the covariance, and they will still go ahead and multiply the covariance by the standard deviation of each of those assets. We are going to get an answer probably that we'll see in your options, but your answer is going to be wrong. Note that your covariance is equal to correlation of A, correlation of B, and the correlation between A and B. Don't make that mistake. And then some questions will also give you variances of the assets. You don't need to start going to do for the square root first before you come back to square it. Note that standard squared is also known as what? Variance. So just plug in and move ahead so that you will not waste too much time in doing what you don't need to do. Then we're now going to go on to the graphs, which is the most important thing for me for students in level 1 because of the different kind of graphs that we have. But I think we should go ahead now and do some questions, and then we'll come back to the graph so I'll be able to understand that we are all in sync with one another. And for instance, if I've taught an LOS and there's some places that you think you need more clarifications that I mentioned that are not too clear or you want more, please kindly put it on the chat room so that we'll know that I'm trying to add value. Okay, so let's go on to this. Thank you, God, for the answer so far. Yes, as it becomes less risk adverse, the market price of risk decreases and the stock value rises. Thank you. The answer is C for all those that attempted it. Thank you. The demand for increased yield on bonds as credit increases is that evidence of your risk adverse behavior. So because you are taking on more risk, you need to be compensated for it. So the answer is C, is a risk adverse behavior. Thank you, everyone. I got the answer right. Lenovo, I want to assume that you're answering question 9. Thank you. Before we move ahead, I would like to just introduce, let's talk about, because I just realized that we've gone 30 minutes into, and not even done half of corporate finance. So let's talk about the graphs that we have in corporate finance. We have the CAL graph, we have the CML graph, and the SML graph. The CAL is known as the capital asset allocation, and the CML is a special case of the CAL, and then we have the SML, which is the graph of the CAPM formula. Now, when we are trying to find out what investment we should do for a particular investor, we draw what we call their indifference curve. The indifference curve is just a curve of their utility that measures what satisfaction they derive from each level of risk that they have taken. Then we draw up their indifference curve. Indifference curve have 3 different ways. For a risk adverse person, their indifference curve will be upward sloping. It's going to be a flat line, and for a risk seeker, it's going to be what? Downward sloping. Now, when we introduce the indifference curve, what we call the efficient Markowitz frontier. Now, on the efficient Markowitz frontier, we say that it lies only efficient assets. The line graph goes something like this. We said on this line we have efficient assets, and an asset is said to be efficient when there is no other asset that will give us a higher return for the same level of risk, or a lower risk for the same level of return. I take it again. An asset is said to be efficient when there is no other asset that will give us a higher return for the same level of risk, or a lower risk for the same level of return. Those are the only assets that will lie on the efficient frontier. So the efficient frontier graph is like this. It starts from this point. This point is known as the global minimum variance portfolio. And then it goes from here to this point. So your capital allocation line is a straight line that is introduced to your efficient frontier that starts from the risk-free rates and goes like this. It lies tangent. It lies tangent to your efficient frontier. That means every asset on your CAL line are efficient. And it's starting from the risk-free rate because it is assumed that your asset portfolio has a risk-free asset and one risky asset. So which is that if all your risky assets goes south, at least your portfolio will bring back for you your risk-free return. So your risk-free return is a straight line that is taken from the risk-free rate that lies tangent to your efficient frontier. Now, your inference curve is now introduced. So the most efficient or the optimal risky asset for any investor is that risky asset that lies where the indifference curves lie tangent to the CAL line. The optimal portfolio of any investor is that risky asset where the indifference curve lies tangent to the CAL line. Now, there are some things I need you to note in the CAL line. Number one, when you are using the formula since your CAL line is a straight line, we can use the simple straight line formula of y is equal to a plus bx. While your a is the intercept and your b is the slope. Your intercept is what happens to you when all this other part becomes zero. And like I explained earlier, when your risky assets go south, at least your portfolio will bring back for you your risk-free. So the intercept of your CAL line is your risk-free return, while your slope is your Sharpe ratio. The intercept of your CAL line is a risk-free return, while your slope is your Sharpe ratio. CAL lines are unique to individuals, as our indifference curves are unique to each of us. Now, your CML is a special case of the CAL line. It's a special case because under the CML, it is assumed that we all have homogeneous way of thinking. So which means that under this CML line, our optimal risky assets will be the market portfolio. Now, the only thing that will be different from each investor will now be what percentage of their investment will now be in that of the risky asset and that of the risk-free assets. So the major difference between the CML and the CAL is this. The CML is the same for everybody. The CML is the same for everyone, while the CAL is unique to individuals. But the intercept and the Sharpe ratio is the same for both of them. And you will only find efficient assets on this graph. You only find efficient assets on this graph. The CML is a special case of the CAL. I'm hammering on it because I know a lot of candidates always have issues with this. The CML is a special case of the CAL. They both have the same intercept and the same slope. The only difference between the two of them is that CAL believes that we all think differently. So our CAL line is unique to each of us. While the CML line believes that we have homogeneous way of thinking, that means we all think alike and we all pick the same risky assets, which is the market portfolio. Now, the SML, like I said, is the graph of the CAPM formula. And I know that all of us know our CAPM formula to be the RF plus beta into RM minus RF. Now, our RM minus RF, I know is also called what? Equity market return, right? Am I correct? Anyway, I know I am, in case even though you're not answering me. So now the graph of your SML line is also a straight line that starts from the risk-free rates. Remember, risk-free rates. Risk-free rates. Because that is the minimum that you will get if everything goes south. So your SML line also starts from the risk-free rate, is also upward sloping. But in this case, if you look at the formula, your risk-free rate is also the intercept. But in this case, your slope is your what? Your market risk premium or your equity risk premium, whichever one. They're all talking about the same thing. Because what this is saying is the excess return you are getting above the risk-free rate for you taking on the risk that you are taking. So your slope is your equity risk premium or your market risk premium, whichever name that you are comfortable calling it, while your intercept is a risk-free rate. What changes from portfolio to portfolio is your beta. And I know that you know that your beta is your what? The sensitivity of your portfolio of your risky assets to that of the market. And the formula for you to get your beta is the covariance of your asset and that of the market divided by the variance of the market. We can also be streamlined into the correlation of your assets with the market multiplied by the standard deviation of your assets divided by standard deviation of the market. That is a formula that you use to get your beta. Let me write it clearly for those of us that want to write it out. That is the formula to get. Now, because this is a graph of the SML line, you are no longer talking about efficient portfolio. Okay. Elim, I don't know which one you want me to say again, but let me just recap what I have said. I said the graph of the SML line is also upward sloping that starts from the risk-free rate. The risk-free rate is also your intercept. That is the minimum you will get when everything goes south. While the slope of the SML is your market risk premium, also called the equity risk premium. What differs the return of the risky assets for individuals is the beta, which is what we call the market risk. And your beta measures the sensitivity of your risky assets to that of the market portfolio. And I gave you the formula for beta on the board. Since we have short of time, let me just introduce also that when we're talking about risk, our total risk can be subdivided into two: systematic risk and unsystematic risk. Systematic risk is a risk that cannot be diversified away. You have no choice but take that risk as long as you are going into business. So the market will compensate you for that. Then the unsystematic risk are the risks that are peculiar to some certain investments. And you can do away with those risks by either not investing in those portfolios or looking for assets that have low or negative correlation with those assets. The market would not compensate you if you desire or decide to face unsystematic risk. So because the CAPM is used to price these assets, we would say that the assets that lie on the SML line are rightly priced assets. The assets that lie on the SML line are rightly priced assets and not efficient assets. So when you have assets that lie above the line, we will say that the lines that are above the line are what? Undervalued. While those that are below the line are overvalued. Assets that lie above the SML line are undervalued, while assets that lie below the SML line are overvalued. Because your SML is using only beta, the systematic risk, as its measure of risk, while your
Hi, Bukola, are you there? Hello, Bukola, are you there? Okay, I think she's probably having network challenges. Please hold on. Let me reach out to her. Okay, she's going to join us shortly. She's trying to dial in again.
Thank you, Glory.
So sorry about the
Bukola,
break.
okay.
I'm so
All
sorry. I
right.
didn't know that was out. Yes, I'm so sorry about that. Okay, so let's continue from where we stopped. So sorry about the network. I had to change my network source. All right, so let's look at this, please. So sorry. Can you guys see my screen?
Yes, I can see your screen.
Thank you. So can we try our hands on this question? I believe that we all know that the formula for utility is equal to the return of the portfolio minus half of the measure of risk aversion multiplied by the variance of the portfolio. Oh, sorry, my question moved. Okay, so we have utility to be equal to return minus half of the risk aversion measured multiplied by the variance. Now they are saying that there are two people, they have the same utility. And what is different is this risk aversion. Someone has a higher one, someone has a lower one. So for them to be the same, so it means that the person that has the lower risk coefficient would have what? A higher level of risk or a lower level of risk. You would definitely have a higher level of risk for the utilities to still be the same. So the answer is D. I'm just explaining the question for those that missed it out. Okay, so let's try this. Financial to divest in non-core assets, analysis and deviation of return is likely to rise to 30%, and its correlation with the market portfolio will remain unchanged. The risk-free rate and the market risk premium are expected to remain unchanged at this. The market portfolio standard deviation, however, is expected to decrease to 15%. So what is the expected return of the firm after the restructure? I'm sorry, let me go back for Olumayowa. By the time we have two investors, utility remains the same, but this for one is higher and the other one is lower. But at the end of the day, they both have the same utility. So that means the only thing that might be different is the risk and what? The return. So for this to be lower, that means you have what? A higher level of risk and return. Okay, beta formula is covariance IM over standard deviation squared of the market. Okay, the correlation. To solve this, since diverse answers, we are supposed to use the CFA formula. We have this to be given to us we have this given to us as 6%, but we're not given beta. So first thing for you to solve this question is you need to find out what your beta is. And our beta, like we said, is correlation of the asset to the market times standard deviation of the asset multiplied by standard deviation of the market, which is equal to 0.3 times 0.8 divided by 0.15. Can somebody tell me what the answer is? Can somebody tell me what the answer is? So somebody said it's 1.6. So that means we'll add 1.6 to our formula. So 1.6 times 8% plus 6% will give us 18.8%. So the answer for this is C. I hope we all understand. For you to solve this question, you need to get your beta first, which we're not given. So you have to use the formula of beta to get the beta. Then you now slot in the others and get your answer. Indifference curves, upward sloping. I have 5 more minutes to go, so let's quickly rush on. Let's see what we have not. Let us do this question. Let's do this question quickly before we leave. Okay, you have 100, 30.5 minus 34.5 plus 51.55 divided by 100 times 34.5. Whatever you get is the answer. So let me just go back to the last question because of who will be wondering. The more curved your slope is, the more your degree of risk aversion. Well, like I said, they're not always upward sloping because can have a flat and can have decreasing depending on the kind of investor that you have. So which gives you. So I guess I have to leave the class now. Thank you everyone for joining in. And thank you also to the Institute, Nigerian Society, for giving me the opportunity to tutor in this bootcamp. Thank you very much.
Thank you so much, Paula. Well done. The next class we'll be having is quantitative methods. Will be handled and facilitated by Ibrahim Salami, the CFA charter holder. Ibrahim, you have the floor. Please, can you share your screen and take over?
Hi, good morning. I'm trying to share my screen just so that. Can you see my screen, Amkola? Gloria?
Yes, I can see your screen. Gloria, yes.
All right, yes.
Okay, it's the second slide. Is this the beginning?
No, it's second slide. I'm trying to share my desktop itself.
Okay.
Rather than just that page alone. I don't know why it's that page alone is showing.
Okay, I can see the cover slide now.
Yeah. Okay, I will just try and manage. I was trying to share my desktop. I can see an option to share my desktop itself. Okay, good morning, everyone. So I'll be taking you on the QM. The QM basically has 6 readings, which we'll try and cover in this session. Sorry. Okay, so the first reading is on the time value of money, right? Under the time value of money, what you are required to know includes you being able to interpret what interest rates is. And we said interest rate can be shown as what? A discount rate, a minimum rate of return, or an opportunity cost, right? Those are the ways they can show you what interest rate is. Then you're supposed to be able to evaluate a future value of a single cash flow, frequency of compounding, effective rate, present value of series of cash flow, equal cash flows as ordinary annuity or annuity deal, and unequal cash flow. So those are things you're expected to know. Also, for a cash flow that runs for perpetuity, right, that runs forever. But the key things you need to understand here is that what you need to know that cash flows usually occurs what at the end of the period, right? So if the question is silent on when the cash flow is occurring, you should know typically that what that cash flow is at the end of the period, right? When you calculate the present value of a cash flow, right? That value you get, it's typically what at a period before the cash flow starts, right? And this is an example of that. So if I have a timeline that looks like this, and I have year 1, year 2, year 3, year 4, and I have my cash flow. If I calculate the present value of this, if the cash flow starts from year 1, right? Say I have 10, 10, 10, and I calculate the present value of this, the value I will get will be at what? Year 0. This is important for you to know, because if you have a cash flow that does not start from year 1, you shouldn't assume that whenever you calculate the cash flow, it's at year 0. No, the cash flow you calculate is at what? The period before. The present value you calculate is at what? The period before the cash flow starts. Also, you need to know that what? When you calculate future value, the future value you calculate is what? At the period where the cash flow stops, right? So when you calculate the future value, you should know that what? That future value is at the period where the cash flow stops, right? Then you should be able to differentiate between what? Cash flow occurring at the beginning of the period, which is what we call what? Annuity due, and what? Cash flow beginning at what? End of the period, which is what we call what? Ordinary annuity. And you have to know the relationship between the two. The relationship between ordinary annuity and annuity due is shown here, right? For both the future value and present value. The value of your annuity due is always higher than what? The value of your ordinary annuity for both present value and what? Future value, by the factor 1 plus R. Reason being that what we are saying is that what? If a cash flow starts at the beginning of a period as compared to end of the period, that means what? It's starting what? At a period faster. Because it is starting at a period faster, you need to what? Compound it for what? An extra period, right? And we'll try and demonstrate how to calculate this. But what you need to know is that what? There are 2 ways, major ways for you to calculate this. One is what? To change your calculator to a begin mode and use it and calculate it as if it was an ordinary annuity, or what? Do your calculation as if it was an ordinary annuity, then multiply by what? The factor 1 plus R. When you have unequal cash flow, what you have to do is what? You have to use the cash flow function of your calculator. We would demonstrate that in an example. right? For you to be able to follow your cash flows, you have to assign signs to them. So typically the cash flows you have will be what? At the beginning of the period, which is the present value, payments that occurs periodically, and the future value. So you need to know who is making what payments. So typically, if I was making an investment, say I was buying an FGM bond, so I will part because I have to pay now. So the money is leaving me as the investor. So I may term that as what? Negative. They will be paying me periodic coupons. So I may term that as what? Positive. And my future value, because they will have to pay me the face value at the end of the investment. So I may label that as what? Positive. So you have to be careful on the direction of your what? Of your cash flow. Otherwise, you will get either an error message or what? A wrong answer entirely, right? When you want to compare two cash flow, you typically what? Use their NPV. So you calculate the NPV of the two, whichever is greater will be what? The better, will have the better cash flow, right? Then for investments that compound for more than one period in a year, we say that what? The higher the number of compounding, what? The higher the what? The effective annual rate. The effective annual rate is what the investor would typically get at the end of the year, right? So if I have two investors who are both offered 8%, and one is compounding annually, and the other is compounding biannually, because the one that is compounding biannually is compounding faster, right? We expect that what? It will have a what? Effective annual rate. And the formula to calculate your effective annual rate is shown here, which is what? 1 plus the periodic rate. The periodic rate means that what? Rate per period. So if I was calculating for this, an annual rate of 8%, and I want to know the effective rate, what I'll typically do is what? 1 plus what? 8% divided by what? 2, because it's compounding biannual, raised by what? 2 minus 1. So you expect that what? This value to be higher than what? 8%, which is why we say that what? The effective annual rate is greater for what? Investments that have what? Higher level of compounding. We said that what? The effective annual rate is what? Is equivalent annual rate if compounded for what? A single period. We are saying that what? That is the rate that will be what? In play if we assume that what? Your compounding was just for a single year. Then when you give you nominal rates and you want to use the calculator, you have to first of all calculate it to what? Effective annual rates. Then the most important thing in this reading is for you to be able to what? Use your calculator effectively. Because most of the things you're going to do, to save time on it, you have to what? Be able to input the values in your calculator. Right, so important formulas for you to know. How to calculate your future value is what? Your present value into what? 1 plus r over raised to power n. So let's list out these values, these parameters, and say what they mean. So typically you have 5 major parameters, which is your what? Your future value, your present value, your payments, your rate, which is your I over y, and your what? Your n. So you need to note these things and you know the units they carry. Your future value is a monetary term, right? It's a value at the end of the period. Your present value is a monetary term, is the value at the start. Your payment is a periodical amount. So it is what? An amount per period. Then your interest rate is a return, is a periodical return, which is what? Return per period. Then your N is what? The number of periods. Note, these 3 must be consistent. If your payment if your period is a monthly period, then your rate return must be stated in what? Per month, and your payment must be stated in per month. The 3 must be what? Consistent. right? Then if you have a perpetuity, this is how you calculate your perpetuity. It is what? Payments, your periodic payments divided by what? Your periodic return. Okay, so let's look at examples to demonstrate some of this. So can you see my screen, please? Can you see the question?
Yes, I can see your screen.
Okay, all
Reading
right.
6.
Okay, reading 6, okay. Okay, so first, let's take 2 simple questions, then we'll come to the more difficult one. So the first question we'll take is this that I'm highlighting. It says that what? A consumer purchases an automobile using a loan. The amount borrowed is 30,000 euro, and the terms of the loan call for the loan to be repaid over 5 years using equal monthly payments with an annual nominal interest rate of 8% and monthly compounding. The monthly payment is closest to, so can we attempt this? Are we attempting it, or should I just go ahead and solve it? So while we are attempting it, I'll just go ahead and solve it, so you just compare our answers. Okay, so we have, so first thing is for us to what? List out our parameters and see what we have and know how to what? Calculate it, right? So we are given, they said at the amount borrowed. So if you borrow the amount, that means you'll be giving the amount today. So we said that what? Our present value is what? 30,000, right? And it said the terms of the loan is to be what? 5 years. So it's 5 years, right? Using equal monthly repayment. So if it's equal monthly repayment, that means what? There are 12 months in a year, and that would be what? 60 periods, right? Then our payment is what? Which is what they asked us to calculate, the monthly payment. That's what they asked us to calculate. We don't know that. Since it's a loan, it's assumed that what? You will have finished paying by the end of the term, right? So that would be what? 0. Then your rate, which is your I over Y, it is given as what? 8%. This 8% is per annum. So you need to what? Divide it by what? 12 to get your effective rate, your periodic rate. So for this, what we just simply do is what? Go to our calculator. On our calculator, on the third line of our calculator, we have our cash flow, our what's called annuity functions there, our present value functions. So let's impute it. The first thing we have is what? N. For our N, we have 60. So we press 60, enter 60 and press N. Then the calculator notes it. Then the next one is what? I over Y, which is what? 8 divided by 12, right? So I impute that. Then my present value is 30,000. So because I've said that what? When cash is leaving me, I denote that as what? Negative. So I put that as negative, right? Negative 30,000. I enter that as my present value. Payment is unknown, so we skip that. Future value is 0. Next is what? We compute our what? Payments, and that is 608.29, which is B. Right, so many people got B, so that is the answer, B, 608.29. Okay. So the next question will be, so let me just move the question up. So we are looking at question 2 here. If the price of a stock goes from $15 to $16.2 in 1 year, the continuously compounded rate of return is closest to So do I have people attempting this? So let me take the question again. If the price of a stock goes from $15 to $16.2 in 1 year, the continuous compounded period, compounded rate of return is closest to So for this question, typically, what we have to do is what? First of all, calculate the effective rate itself. If it moved from 15 to 16.2 in 1 year, so that would mean that what? Our effective rate will be what? 16.2 divided by what? 15 minus what? 1. And that will give us what? 16.2 divided by 15. That is 1.08. Right? That's 1.08 minus 1. That gives us what? 8%. So this is the effective rate. Next is to now determine what? The continuous compounded rate. So a trick here is this. Since we know that what? The effective rate is 8%. Trick. Since it is compounding continuously, we know that what? The nominal rate cannot be greater than 8% and cannot be 8%. So which means that what? The nominal rate will only be a value that is what? Lower than 8%. Because we said that what? The more you compound, the higher your effective rate. So, and you expect your effective rate to be what? Always greater than what? Your nominal rate, as long as you are compounding for more than 1 period, right? So so this is just a trick. I know 7.7 will be the answer, but let's calculate it. In calculating it, we have to use, there are 2 ways to calculate it. First is to what? Either use the calculator, input these values in your calculator. So you go to second function 2, which is interest conversion, right? Your nominal rate, that's what you want to calculate. You leave it, then you go to your effective rate, which is what? 8. Then you press enter. Then your number of periods, because it is compounding continuously, we put a very high number there, right? So let's say, for example, I put 8 million there as my number of period, I press enter. Then I go back to my nominal rate and compute. So I get what? 7.69, right? Which is almost the same thing as what? 7.7. The other one you can do is what? You do your EAR equals to what? Exponential, your nominal rate minus 1. Right? Then you calculate. Okay, the calculation function again. We've calculated our effective rate as 8%, right? So I put what? Second function 2 on the calculator. That is interest conversion. The nominal rate is what I want to calculate, right? So I leave that. Then I go to effective rate. The effective rate I calculated was 8%. So I input 8 and press enter. Then because I'm compounding continuously means that what? It is happening instantaneously, right? So that means it's happening almost immediately. That means that what? It's going to be for a very long period. So I put a very long period there. So you can choose any figure that is high, above, as long as it's above, say, 1 million, right? So I chose, say, 80 million or whatever. I just put a very high number. Then enter that. Then go back to your nominal rates and press what? Compute. Then you get 7.69, exactly as something, right? The other way is to what? Use, just calculate it arithmetically. So you have your AAR is what? Equals to what? Exponential of your nominal rate minus 1. So that would be what? 1 plus AAR is equals to what? Exponential of your nominal rate. That's what? 1.08 is equals to what? Exponential of your what? Nominal rate. What you need to do is what? Find the natural log of both sides. So I have 1.08 ln, and that's giving what? 0.0769. If I convert that to percentage, multiply by 100, that is what? No, if I convert that to percentage, I will get what? 7.69. So those are the 2 ways you can calculate it, right? The next one is, I want to do is this, is a more robust question, right? That kind of show so many things under the time value of money. So here we'll demonstrate. So we are looking at question 1. It says a couple plans to pay their child's college tuition for 4 years, starting 18 years from now. The current annual cost of college is what? $7,000, and they expect this cost to rise at an annual rate of 5%. In their planning, they assume they can earn 6% annually. How much must they put aside each year, starting next year, if they plan to make equal 17 payments? So we have a couple that are planning for the child's tuition in 18 years' time, and they want to start saving from next year, right? So if they start saving, so what we have now is, and what they want to use the money to do, they want to use the money to finance what? Their child's what? Tuition. So you're going to have a timeline that looks like this. So you're going to have a timeline that looks something like this. So they said the time is starting when? 18 years from now. So if this is 18, so that is where they are starting. And it's going to be for 4 years. So 18, 19, 20, and 21. So they need to pay this tuition for 4 years, right? And they said the tuition is what? Current annual cost. When you say current, it means as a what? Today, 7,000. So if it's 7,000 today, what would the value be in 18? Will it remain the same, or would it have changed? And they gave us what? That what? They expect cost to rise at an annual rate of what? 5%. So this 7,000 will have risen 5% annually until it gets what? Year 18. So that would be what? 7,000 into what? 1 plus what? The annual inflation rate, right? Raised by what? 18. So we'll get that value, and we'll do for the next one too, which will be what? 19, 20, and 21. So we'll get the full cash flow, right? That is one part. Then the second part is what? Is to now determine how much they need to save to be able to make this payment. So they need to save for what? 17 years. So from year 1 to year 17, they need to save. Whatever they save will be what they will use to finance this. That means whatever they save must be equal to what they are using to finance. So the future value of their savings must be what? Equals to what? Present value of what? The tuition. So let's list out the things we have for the savings. Under the savings, so we have our present value, future value, payments, period, and what? Interest rates. Our present value is 0. Future value is what we want to calculate. We don't know the future value. Payment is what they ask us to what? To calculate. Our number of period is 17. Our annual rate is what? At 6%. So there are 2 unknowns. So we can move ahead with this, right? So let's look at what? The other side, which is what? The tuition. Sorry, do you understand the timeline? I want to plan out the timeline so I can write it clearly. Yes, okay, all right, thank you. Okay, so let me write again. So for the savings, we have what? Present value, future value, number of periods, interest rates, and what? Payments. Our present value is what? 0. Future value, we don't know. Number of period is 17. Our interest rate is 6%. And our payment is what? Unknown. For the tuition, present value is what? Unknown. Future value is what? 0. Number of periods is what? 4. Interest rate, I over Y, is what? 6. Payment. Payment is not the same all through. So we need to calculate what? Our payment for the 4 years. Because payment is not the same all through, so we need to use what? The cash flow function on our what? On our calculator. Right? So for the first one, which is what? 7,000 into what? 1 plus I, which is 5%, raised by what? 18. Then we do this for the 4. So in doing this, now, to save yourself time in the exam, all you just need to do is what? Note these numbers when you do the calculation and store them on your calculator. So the first one is what? 7,000, sorry, 1.05 raised to power what? 18 times 7,000. That is your first one. So I'll just do what? I'll store 1 on the calculator. Although it's 16,846. For the second year, it's what? Times 1.05. So I'm taking it a period further. That will be what? 17,688. Then for the third period, times 1.05, that is what? 18,573. And for the fourth period, it's going to be what? 19,501. So now, next thing is what? I go to my cash flow function on the calculator. So cash flow function, I first of all clear all the work, then I input my cash flow. Year 0, there is no value there. So I go to what? CO1. My CO1 is what? So I just call up my calculator, recall 1, and I press enter. So instead of you writing it down, you'll have studied it on your calculator, then you recall it. Then I go to my what? CO2. I press recall 2. The value comes up and I press enter. Then I go to my CO3. I press recall 3. The value comes up. I press enter. Then I go to what? CO4. Recall 4. Press enter. So this is my cash flows I've entered. Next, I press what? MPV. I enter the discount rate. The discount rate is what? 6. Enter. Then I compute what? My MPV, which is what? So my MPV is what? 62,677. And from the timeline, we said that what? The present value of your tuition is what? Equals to what? Future value of your savings, right? So this value, I transfer it to my future value here, which is what I need here, 62,677. So this value becomes what? 62,677. Then I go back to what? The present value function on my calculator, and I input all this. So now my present value here is 0. My future value I've calculated. My N is 17. My I by Y is still 6. Then I need to calculate my payments, right? So here I enter this as my what? Future value. Then my N is what? 17. Then my present value is 0. My I over Y is 6. Then I compute what? My payment. And that gives me what? 2,221. Yes. Okay, all right. Ujoma is following, right? So I guess every other person is following it too. So that's that on the first reading, right? So now let's move on to the next reading. So on the next second reading is what? Statistical concepts and what? Market returns. So here you are supposed to know what? Nature of statistics. So let me just do a quick recap of the question again. So because of time, right? So you are told that a couple, they want to finance their child's tuition in future, right? So if they are going to do that finance, they need to save to be able to finance it. So whatever they save must be what? Whatever it is they need to use to finance it. That's why we said that what? The future value of whatever it is they save will be what? Equal to what? The present value of the tuition they need to pay. And they've given us that what? That the tuition is starting when? Year 18. So, and it's going to last for 4 years. That's what it's going to run for year 18, year 19, year 20, and year 21. That is 4 periods. But they said that what? The value of the tuition today, which is what? Year 0, is 7,000. So if the value for it today is 7,000, what would the value be in year 18? So we need to what? Compound the nominal value of it, because they gave us what? The annual rate, which is like your inflation rate, right? That was why he calculated the value, saying that what? For year 18, it will be what? The value now, which is 7,000, multiplied by what? 1 plus your rate, raised by what? The number of years, which is 18. And you do that for the 4 cash flows. Once you get that, because the cash flows are unequal, you cannot impute it as payments, right? Because payments only takes cash flows that are what? The same. So that was why we use what? The cash flow function on the calculator. And what you need to do on the cash flow function is what? Input year 1, year 2, year 3, year 4. Then go to the NPV, input your interest rate, then compute what? Your NPV. When you get your NPV becomes what? Equals to what? The future value of your savings. So on your present value function, you now put the future value as that value you've calculated, then input the other parameters. Lenovo, is that clear? Okay, so let's go back to our reading. So we are supposed to know the nature of statistics. Statistics are of 2 types. It could be either what? Descriptive or what? Inferential. Descriptive is more like analyzing, looking into the past. Inferential is more like forecasting and making estimates or judgments in the future. They are supposed to be able to differentiate what? Between populations and samples. Population is the whole, while sample is what? A subset of a population. You should know measurement scales. We typically have 4 measurement scales. Nominal, which just groups things, right? Puts things into groups. Like I say, types of animals. I say I have wild animals, domestic animals, birds, mammals. That's what nominal does. It just groups. Ordinal tells you which one is better than the other, but it does not tell you how better it is. So this is typically your what? Your credit rating scale, where you have a credit rating from AAA, your Fitch rating to like CCC. And from AAA, you move down maybe AA plus. You know AA is better than AA plus, but you don't know by what extent, right? Then next is what? The interval. Interval tells you which is better, and it tells you the interval, the gaps between them. An example is what? Your temperature scale. If I know 2 degrees Celsius, I know it's greater than 1 degree Celsius by what? 1 degree. But I can't tell their ratios. I can't say that what? 2 degrees Celsius is twice as hot as 1 degree Celsius. So I can't do a ratio calculation for them. That is what interval does. But in ratio, so we say that what? Interval does not have what you call a true zero. But for ratio has all the qualities of the 3 above, plus you can do ratios. So an example is what? Your asset returns, right? So if a manager makes 10% and another manager makes 20%, I can tell you that what the manager that made 20% made twice as much as the manager that made 10%. So that is what you can do in ratio. And in ratio, there is a true zero. So that means if you made 0%, it means that what? You did not make any return, right? But in interval, if I say the temperature is 0 degree, it does not mean that what? That water does not have any heat, because 0 degree is still what? Hotter than what? -1 degree. So just understand that. Then you need to know how to summarize your data using histogram. The histogram plots what? Your interval against what? Your frequency, right? So the height of each of the bars on your frequency, on your histogram represents what? Represents your frequency. Then your frequency polygon plots what? The middle mark. So if you have an interval that is 2 to say 5, if you are plotting this for histogram, you plot the interval using the value 2 to 5. But if you want to plot frequency polygon, what we use what? You find the middle number, which is what? 3.5, right? That is what we use to plot against what? The frequency. Note, you are still plotting against the frequency, but now you are using what? The middle value as against interval histogram that uses what? The interval itself. And in histogram, each bar has what? Equal what? Width, because the width is what? The size of what? The size of the interval, and the size of the interval must be the same all through. Then in cumulative frequency distribution, it plots what? The midpoint, just like the polygon, against what? Cumulative frequency. And you know that what? Your cumulative frequency must add up to what? Your total data number, right? It must add up to it. Then you also have what we call what? Relative frequency. Your relative frequency is what? Your frequency for each data divided by what? Your total frequency. So note that that is your relative frequency. And your relative cumulative frequency is what? It's just the addition of each of the relative frequency for each class. And your cumulative relative frequency must what? Add up to what? 1. So note, your cumulative relative frequency must what? Add up to what? 1. While your what? Cumulative frequency must add up to what? Total frequency. So that is the difference in the two. Then we talked about, you're supposed to have learned measures of central tendency, the mean. So the mean is typically what? The sum of your data divided by what? Number of your data. That is what the mean is. Then you have the median, which is what? The middle number. So if you have a data of 50 sets, what will be the middle number? So if you divide this by 2, which is the middle number, you are going to have 25. But because this is an even number, that means this data has been divided into 2 equal parts, 1 to 25 and 26 to what? 50. Because these 2 parts are equal, we can't say 25 is the middle number. So the middle number lies between what? 25 and 26. And that's going to be what? 25.5. Right? So that's how you calculate for median. Then the mode is what? The most frequently occurring. So the one that occurs the most, that means the one that has the highest frequency, is what? The mode. If you are using this on the histogram, it will be what? The ones that has what? The highest bar. So if I have 3 bars like this, one is like this, one is like this, and one is like this, the mode will be what? The one that is the highest. So if I have A, B, and C, so B will be what? The mode. Then other concept of mean, geometric mean, harmonic mean, and weighted average. So we have to calculate this. So we look at examples. Then location of, you have measures of location, your quantiles. So typically you have, the common quantiles are what? You have your what? Quartiles, you have your deciles, you have your quintiles, you have your percentiles. So percentile, like we say, 1%, that means what? It measures every 1%. Your quintile is what? 20 quint. So it measures what? Every 20%. Your quartiles is what? 1/4. A quarter measures what? Every 25%. And your decile is what? 10. 1 divided by 10. That measures what? Every 10%. So if I said, what is your second quartile? That would be what? 25 plus 25. Right? If I say, what is your fourth decile? That would be what? 10 plus 10 plus 10 plus 10. And that will give me what? 40. And this is how you calculate what? Your location point. It is what? Your number of data plus 1 multiplied by what? The quantile you are looking for. So we'll look at an example on this, right? Then you should also know the effect of what? Quantiles and investments. Also, particularly for us, we should be interested in what? Quantiles in what? Students pass mark in CFA. So most of you will have gone to your practice materials and you'll have seen that what? It shows you your current quantile, where either it's 90th percentile, 80th percentile. So that is and what? A use of what? How you use quantile to show you what range or what class you belong to within a population, right? Next is what? Measures of what? Dispersion. So generally, measures of central tendency measures what? The average amount, whereas measures of dispersion measures what? So we say that what? Central tendency typically measures what? Return, whereas dispersion measures what? Risk, right? So the things we look at are what? Range. Range simply means what? The highest value minus what? The lowest value, and that's the range. Your range only considers what? Extreme values, so it doesn't look at what is in between. So most times, your range does not give you a true reflection of your data itself because it's only considering what? Extreme values. Then to get above that, we look at what? Mean absolute deviation. So in calculating the mean absolute deviation, what you need to do is what? Each of your data sets minus what? Your mean as calculated, they find the absolute value. Reason we need to find the absolute value is this. If you find dispersion deviations around your mean itself, it will always what? Sum up to what? 0. Deviation around the mean will sum up to what? 0. In order to avoid that 0 summation, so we use what? Absoluteness. We remove the signs and just calculate the values and divide by what? The number of data. That is what? Our mean absolute deviation. Then you calculate population variance and standard deviation. The formula for population variance is this. It is what? The sum of what? Your mean, your sample, your data minus what? Your mean, all square, divided by what? Your number of data. That is your what? Variance. Then to calculate standard deviation, you need to do what? Find the square root of this, and that gives you your standard deviation. If you are calculating your sample variance, because of degree of freedom in sample variance, you have to what? It will be what? Your data minus what? The mean, the sample mean, all divided by square, summation of it, all divided by what? N minus what? 1, right? And if you're calculating the standard deviation, you will have to do what? You will find the square root. Are you following, please? Okay, right. Thanks, Sadiq. Okay, next is what? Chebyshev's inequality. What Chebyshev's inequality is telling us is what? It's telling us what? Within some standard deviation away from our mean, how many of our data is contained within that distribution at the minimum. So, and this is the formula. But note, to do this, your K must what? Be greater than what? 1. Because if your K is greater than 1, this value becomes 0. So your K, which is the number of steps away from your mean, right? So typically, if my K is, say, 2, so I'm saying 2 standard deviations of my mean, how many of my data should be contained within that distribution space. It will be what? 1 minus what? 1 over k square, which is what? 1 minus 1 over what? 2 square. And that is what? 1 minus what? 1 over 4, which is what? 0.75. That's on 5%. It's saying that what? If I have my mean and I take 2 standard deviations, I have 2 standard deviations to it, plus or minus, this data should contain what? At least 75% of my total data. That is what Chebyshev inequality is telling us. Then next is what? Coefficient of variation. Your coefficient of variation measures what? The amount of risk you are taking per return. So I want to see for the return you made, for each return you make, how much risk have you taken? That is what? It is what? Risk per return. So because risk is the numerator, which is what we don't want, right? So to compare, so coefficient of variation on its own does not say anything. For you to measure it, you have to compare it to something. So if I want to know between two investments, which one is better, I will look for what? The one with the lowest what? Risk per return, right? The lower risk per return, because the risk is in the numerator. So I want to be what? Taking less risk for a greater return. So when you are doing coefficient of variation, you are looking for what? The one with the what? Lower coefficient of variation. Then skewness. Next is what? Skewness. Skewness means what? How our data is shaped. So typically you have a data that looks like this. So if I have a data that looks like this, so I see that what this data is what? Symmetric around the middle. I mean, what you have to the right is also what you have to the left. What this tells you is that what in a normal data, approximately your mean, median, and mode should fall within the same points, right? In the middle here, all these three should fall within the same point for a symmetric data. That means the data is not, that does not have any skewed, that is not skewed. But we can have variations to this. So we can have a data that is what? Skewed to the right, or one that is what? Skewed to the left. What we are saying is that what? When you have a data that is skewed to the right, that means that what? We have what? Extreme is, there is probability of what? Extreme positive values. That means the probability of getting extreme positive values is high. Whereas the one that's negatively skewed, that's what? The probability of getting what? Extreme negative values is high. For positively skewed, because we have high probability of getting what? Extreme positive values, that means that what? It moves your what? Mean towards the right. So your mean shifts away from your median. So your mean becomes what? Greater than your median. Then for the one that's what? Negatively skewed, it moves your what? Mean to the left. That means that what? Your mean becomes what? Lower than what? Your median, right? Then we have kurtosis. Kurtosis shows what? The concentration of our data. Is our data concentrated within the middle or far? So we can have a data that looks like this. Whereas you have fewer percentage of your data in the middle. And we have 3 types. So we can say that what? We have leptokurtic, we have mesokurtic, and we have what? Platykurtic. But leptokurtic means that what? It is thin. How to measure our kurtosis typically is, it has a value, but what we actually measure most is what? Excess kurtosis. And in measuring excess kurtosis, we subtract what? 3 from it. So for a symmetric data that does not have any kurtosis, the kurtosis is expected to be what? 3, and the excess kurtosis is expected to be what? 0. For your leptokurtic, you expect what? The kurtosis to be what? Greater than 3, and the excess kurtosis to be what? Greater than 0. Then for platycotic, you have kurtosis will be less than 3 and excess kurtosis will be less than what? 0. So let's look at some few questions under this reading. Sorry, can you see my question? Gloria, can you see my question, please?
Yes, I can see your screen.
Okay,
Reading
so
7.
Reading 7. Okay, all right, thank you. Okay, so first question. Published ratings on stocks ranging from 1, which is strong sell, to 5, which is strong buy, are example of what type of measurement scale? So what type of measurement scale is this? Published ratings showing ranging from what? 1 to 5. 1 shows strong sell, 5 is what? Strong buy. What type of measurement scale is this? Okay, so I've seen 2 people responded and they say what? This is. So I've seen, so everybody has said ordinal. So this is ordinal, right? Because what? It only shows strong sell and strong buy. It doesn't show you what is this gap between the 2 of them, or what you have to do to move from what? Strong sell to strong buy. All right, thank you. Next, so let's look at this table. This table says that what? The interval containing the median return is closest to what? So I hope you can see this. The interval containing the median is closest to what? A, 3% to 8%, B, 8% to 13%, C, 13% to 18%. Are we attempting it? So for those attempting it, please type in your answer. For others, let me just walk you through. So this is an example of what? An histogram. And we said that what? For histogram, you plot what? Your frequency against what? Your interval, right? You plot your frequency against what? Your interval. So to get the median will be what? The one line in the middle. For this data, they said is what? For 50 years. So our middle point will be what? 50 plus 1 divided by what? 2. And that will be what? 25.5. So we want to look for the data that is what? On 25.5. So we add up the frequencies until we get to what? 25.5. The first one has a height of 1. That means that the frequency is what? 1. The second one has no height. That means the frequency is 0. The third has a height of 1. So can you see? This one here has a height of 4. That means the frequency is what? 4. This has a height of 3. That means the frequency is 3. The height is 2. So you can see how we determine the frequency. We use the height. So to get our what? Median, we just add up. This will be what? 1 plus 1 plus 1 plus 1. That is 4. Plus 4. That is 8. Plus 3, 11. Plus 2, 13. Plus 7, 20. Plus 4, 24. Next is 6. So if I add 4 to this, I'll get 30. So this is 24. Everything here up to here is what? 24. And everything up to here is 30. That means what? 25.5 is in this point. And that is what? 13 to what? 18%. And that is C. Next question. He said what? The third quartile percentage of total returns is closest to what? Note, when you are doing quartile, you have to arrange your data from what? From the least to the highest. So look at this question. It has already been arranged in ascending order for you. So the third quartile is what? And we said that what? So for those attempting it, please write your answers. For others, we said that what? Quartile is what? Is N. Is what? N plus 1 multiplied by what? Our quartile over what? 100. When they say third quartile, we say quartile is what? 25%. So third quartile is what? Third quartile is what? That's 3 times 25, and that's 75. Our N, we have what? How many data sets here? 1, 2, 3, 4, 5, 6, 7, 8, 9. Sorry. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 data. Yeah. Okay, so the moderator will take that. Okay, so we have 10 data. So that would be what? 10 plus what? 1. That is 11 times what? 75 over 100. So what is your answer? So when you calculate this, the value you get is what? 0.75 times 11. That is 8.25. Then you go to your data. You go and look for the 8.25 data. So this is your 8th data, and this is your what? Your 9th data, which means that what? 8.25 is in between the two. So in an exam, I don't have to calculate. I know this is 19.42, which is 8. I know this is 20.45, which is 9. So I know the value in between is what? 20.43. But for the sake of the class, we will just have to calculate it. And we'll say that what? If 8 is what? 19.42. And what? 9 is what? 23.45. What is what? 8.25. So I can see that what? If this thing is divided in quartiles, that means there are 4 quartiles from year to year. All I need to do is what? Divide the space from year to year into 4 too. That is what? 23.45 minus 19.42 all divided by what? 4. And that's what? 1.02. Then I will add what? 1.02 to 19.42 plus 19.42. And that gives me what? 20.44, which is what? 20.43. Right? So I'll take one more question under this. He said the company's compound, so we have this table and say what? The company's compound annual growth rate in revenue is closest to what? So we have this chart and say it calculates what? The annual growth rate. In calculating the annual growth rate, you need to compare what? The last value and what's the first value. So we are on the next, on question 5 now, please, for those attempting it. So it will be what? 392,008 divided by what? 250,738. Then I'll find what? The end truth. So for the end truth, how many periods? 1, 2, 3, 4. So I'll find what? The 4 truths and subtract what? 1 from it. That's what? 392 divided by what? 250. Then if I find the 4th truth of this, that will what? Raised by what? 0.25. That is 1.118 minus 1, and that will give you what? 11.8. Please, for those getting C, it is what? The final value divided by what? The initial value. Then to what? End truth. End truth means that what? The number of space, not the number of data, the number of space periods. That is from here to here is 1, 2, 3, 4. That's 4 periods in between. Then subtract 1 from it. All right. So let's move to the next reading. So the next reading is on probability concepts. So the things you need to know here, you need to know that what is an event. You said the event is what? A set, an event is what? Specified set of outcomes. You know the probability of an event it's what? A value that ranges from what? 0 to 1. That means 0 meaning that what? That event cannot occur, and 1 meaning that what? That event will definitely occur. In between it, you are not sure to if the event, so you have what? A degree of likelihood. So in between 0 and 1. So 0 is that what? It can never occur. 1 is that what? It is certain that it is going to occur. In between 0 and 1, what? It has a degree of likelihood that it will occur. Then we have types of probabilities. It could be subjective, which is what? Depending on people's biases, right? So it's just your thoughts, what you feel it should be, not backed by any what? Scientific data or logical reasoning. That is what? Subjective. Then your probability could be what? Empirical. By empirical, we say that what? You are what? Evaluating what? A set of data. So you have records. And for priori, you are what? Making decision from what? Logic. So you're making logical inference. Empirical and priori are termed what? Objective. Because from people to people, when they do empirical and priori, they should get what? The same outcome, approximately the same outcome. Whereas subjective is based on what? Your personal bias, right? And subjective differ from what? Person to person. Then you can have what? Probability stated as what? Odds. And we say that what? When you have probability stated as odds, we say that what? The odds for an event, odds for an event, E, is what? Probability of that event over what? 1 minus what? Probability of that event. That's how you calculate the odds for an event. And if you're calculating odds against an event, it is what? The inverse of this. And that will be what? 1 minus probability of an event over what? Probability of that event. That is what? Odds against. So it is the inverse of odds for an event. Then to convert from what? Probability, from odds to probability. So if you have odds of an event given as what? A ratio A to B, we say that what? The probability of that event is what? A over what? A plus B. So let's look at an illustration. If I toss a coin, there are two possible outcomes. I can either have what? Head or tail. So if I say what is the odds of getting, so the probability of getting what? Head is what? Is 0.5. Right? That's the probability of getting head or getting a tail. It's 50-50. So if I say, so what is the odd of getting head? It will be what? Is 0.5 over what? 1 minus 0.5. And that will be what? 1. So if I write it in this form, it will be what? 1 over 1. What this means is that what? I have two possible outcomes. One is supporting my outcome, one is against it. So this is how you write your odds, right? 1 against 1. So if you add the two together, it should give you what? Your total possible outcomes. So 1 plus 1, that is 2. And that's the total possible outcomes you can get. You can either get head or what? Tail. Okay. Next is what? Unconditional probability, or what you call what? Marginal probability. This is what they call what? A standalone statement of probability. So if I say what's probability that it will rain, it is what? A standalone probability. What I can also say is what? Is unconditional, or what? Is a marginal probability. Next is we look at what we call conditional. Conditional is what? When the probability is what? Dependent on something else. If something else has occurred. So we say that what is the probability of A given that B has occurred? So that's what? A conditional probability. Then multiplication rule of probabilities. So the things you need to know. Multiplication rule of probability is what? If for A and B, if you have two events A and B, what is the multiplication rule? Is that what? It's probability of what? A, given that what? B has occurred, right? Multiply by what? Probability of what? B. And that gives you what? The joint, the multiplication rule, which is also what? The joint probability of what? A and B, right? Then additional rule for probability. For additional rule, so in multiplication rule, the action word is what? And. Whereas in additional rule, the action word is what? Or. So if I say what is the probability of what? Getting A or B. In getting A or B, that means I can either have A alone or have B alone, then I can have A and B occurring together. And reason why we do this is why we subtract probability of A and B is this. When you look at a typical Venn diagram, if I say how many students do I have in a class, if I have this, if I say I have 10 students taking QM and 10 students taking ethics, then 5 students taking ethics and QM, I see how many people do I have in the class. What we are saying is that what these students taking ethics and QM together are already also taking QM alone, and they're also taking ethics alone. So when I've counted this 10, I've already counted them, and I've already counted them is this 10. So I need to take them out. So what we are simply doing is what? So what is left here is what? 10 minus 5. And what is left here is what? 10 minus 5. So if you add this together, what we have is what? 10 plus 10 minus 5, which is what we reduce to what? Probability of A plus probability of B minus what? Probability of A, B. So please let's take note of that. Then multiplication rule for independent events. When we say events are independent, that means that what? They do not depend on each other to occur. That means that what? In the case where you have independent events, so it changes the general form of our, so this is the general form of our multiplication rule. Probability of AB, which is what? Probability of what? A giving B, multiplied by what? Probability of what? B. If we say these two events are independent, then probability of A giving B reduces to what? Probability of what? A alone, because A and B do not depend on each other. Therefore, the multiplication rule for independent events are what? Is what? Probability of A and B is what? Probability of A multiplied by what? Probability of what? B. Please, let's take note of that. Then total probability rule. So total probability rule, this is the formula for total probability rule. Let me just explain total probability rule. Let me just look at an illustration to try and make it clear. So we have students in this class today, so writing the CFA exam. So there are people that are doing the revision class, and there are people that are what? Not doing the revision class. Of these people doing the revision class, we're going to have many people that are going to pass, and say some people that will probably not scale through. Then of people that did not come for this revision class, we have some people that will still pass and some people that will still not scale through. And if I say, what is the probability of the people that pass? For you to pass, there are two ways for you to have passed. Come for the revision class and pass, or don't come for the revision class and pass. To calculate this, you have to say what? Probability of what? Pass will be what? Probability of passing, given that what? You came for revision, multiplied by what? Probability of what? Revision, plus probability of what? Passing, that you did not come for revision, multiplied by what? Probability of what? Not coming for revision. So that is what the total probability rule is saying. That when you want to get the probability of an event, you have to multiply what? All the lines that leads to that what? Event, all these conditional probabilities, and add them together. That's what total probability rule is saying. Right? Next is what? Expected portfolio return. Then we look at what? We look at an example on how to calculate expected portfolio return, which is simply what? The probability of that event multiplied by what? The outcome, right? Then we look at what? Covariance matrix. So we look at an example of covariance matrix. For a covariance matrix that has 3 assets, so let's look at an example. If it has 3 assets, which is what I have here. right? I hope you can see it, A, B, C. There's going to be what? Total number of covariances you're going to have is going to be what? N squared. That's the total number you're going to have. And that's what? For 3, that's what? 3 squared. And that is 9. And you can see that what? We have what? 9 data here. 1, 2, 3, 4, 5, 6, 7, 8, 9. Right? The number of covariance terms is going to be what? N squared minus N. Because what? We are going to have what? N number of what? Variance terms. So we are going to have a covariance. So this first one that says that what? Covariance of R ray against R ray is the same thing as what? Variance of R ray, right? So if you take out all the variances, then we have what? N squared minus N covariance terms. Then number of unique covariance terms. If you look at this thing, you'll see that what's this value here, B, this value here, covariance of R ray, RB, is same as this value here, covariance of what? RB, RA. So that leads us to what? Number of what? Unique covariance terms. And we say number of unique covariance terms is what? N squared minus N divided by what? 2, which is also what? N into what? N minus 1 all over what? 2. So take note of this. Then what is, how do you interpret covariance? Covariance shows what? How two or more data sets move with respect to what? To their what? Expected value. If they move in the same direction or if they move in different directions. Now, because covariance does not really have real mean life interpretation, because covariance is a what? A squared value, which is not easily interpretable. We reduce it to what? We reduce it to what? Correlation. So we use correlation mostly in substitute for what? Covariance. And how do you calculate correlation? Correlation between 2 items, let's say I and J, is what? The covariance of what? I and J divided by what? The standard deviation of I and standard deviation of what? J. And this gives us what? The correlation of I and J. Correlation ranges from what? -1 to +1. -1 means that what? They perfectly move in what? Different direction. +1 means what? They perfectly move in what? In the same direction. In between it shows that what? They have some sort of relationship, right? Is 0, we mean that what? They don't have any linear relationship. So limitations of correlation. 1, correlation does not mean what? Causation. That things are correlated does not mean that what? They cause each other to happen or is the same thing that is causing them. Then your correlation can be what? Spurious. That means it can be out of chance. Then correlation only shows what? Linear relationship. So if they have a non-linear relationship, correlation will not show that for you. Then other topics in probability, Bayes formula. Bayes formula is what? We say is what? Probability theory of what? Learning from experience. So if you have a probability of something occurring, right, then you get an information. So let's say now you said that what? Nigeria participating in Olympics, that the probability of us winning a medal, say is what? Let's say it's 0.5%. That has the probability that we win a medal at the Olympics. So you set your probability. You now get an information that half of the athletes, of Nigerian athletes, were banned or we have been disqualified in the Olympics. What will that say is that will you still retain this your 0.5? No, you probably have to go and update it. So and in updating it, you use what we call what? Bayes formula. And this is the formula for Bayes formula. Is what? Probability of an event giving a new information. Is what? The probability of information giving the event multiplied by what? Standalone probability of the event or prior probability of that event divided by what? Unconditional probability of what? The information. Right? That is Bayes formula. So we'll look at an example on Bayes formula. Next is what? Principle of counting. In probability generally, to know the probability of something happening, you have to know what? Number of times that thing can happen over the total number. Now, for us to know the total numbers that can happen. So if I say, if I throw a die, what's the total numbers? It's 6, so I can count that easily with my hand. But sometimes you can't count with your hand, so you need some mathematical expressions to be able to count. So the first counting rule is what? Multiplication rule. What multiplication rule is simply saying is that what? If I have a way of doing things, then from that thing I have, say, so let's say for example, I have 2 ways of doing things, of taking a first step. Then second step, I have another 2 ways of taking a second step. And I say in all, how many ways can I take? So this is it. So first step, I can take 2 ways, 1, 2. Then second step, I can take 2 ways. That will be what? So I'll take the first step first, then I'll take another 2 ways. Or if I take the second step, I'll take another 2 ways. That will be what? 1, 2, 3, 4. So I can count this. But mathematically, what it simply just says that what? Multiply what? The number of ways you can take. It's just what? 2 times 2, and that will give you 4. So that's the multiplication rule. Then next is what? Labeling problems. So imagine I have 10 people and I want to group them into 3 places. And I'm asking myself, in how many ways can I group them? So I can, let's say I want to group them into 3, 3, 4. As long as anybody can be in these 3, you don't have to, I don't have to concern about how they are arranged. What I will do is what? Is what? 10 factorial, which is the total number, divided by what? 3 factorial, the number in each groups. 3 factorial, 4 factorial. Note, the summation of all these groups must be the summation of this. So 3 plus 3 plus 4 is 10, right? Must be the same thing as 10 here, right? And that is what? Labeling problems. The next is what? A special form of labeling problems, which is what? Combination rule. If my total group, I'm grouping them is what? Just 2. Then I will have something that looks like this. It becomes a combination problem, n combination R. It's going to be what? N factorial divided by what? N minus R factorial into what? R factorial. Note, if I add n minus 1 R factorial and R factorial together, I will still get n. So this is a what? A special type of what? Labeling rule. And here we say combination when what? The order does not matter. Then the last one is what? Permutation. The difference between combination and permutation is what? In permutation, the order matters. So if I do try and select 3 people from 5 people, so where I have 5 combination 3, when the order does not matter, that will be what? Combination. But when the order matters, that will be what? 5 permutation what? 3. And mathematically, your permutation must always be what? Give you a greater outcome than what? Your combination. So let's try it. If you go to your calculator, 5 second function combination. Combination is the second function of your positive sign. 3 is what? 10. But 5 second function permutation. Permutation is what? Your negative sign. Second function of your negative sign. 3 is what? 60. So you see that what? Your permutation will always be what? Greater than what? Your combination. So let's look at 2 or 3 examples under this reading. So question 6, under reading 8. It says that what? A fund manager would like to estimate the probability of a daily loss higher than 5% on the fund he manages. He decides to use a method that uses the relative frequency of occurrence based on historical data. The resulting probability is what? Yeah, so that's C, empirical. All right, thanks. The next question, it says that what? You apply both valuation and financial strength criteria in choosing stocks. the probability that a randomly selected stock from your investment meets your valuation criteria is 0.25. Given that a stock meets your valuation criteria, the probability that the stocks meets your financial strength criteria is what? Is 0.4. What is the probability that a stock meets both your valuation and financial strength criteria? Please type in your numbers for this question. Type in your numbers. So I'll give you 10 seconds, then I'll start the calculation. Okay. Okay, so I've seen 2 answers which are correct. So for the rest of us, what we are doing is what? So we said that what? You have 2 criteria, valuation and financial strength. So he said that what? The probability that what? The stocks meet your what? Financial your valuation is what? Is 0.25. And he said that what? Given that a stocks meets valuation, so we say given that it meets valuation, the probability that what? The stocks meets the financial strength. So this is it. Probability that what? It meets financial strength, given that what? It meets valuation is what? Is 0.4. So they now say that well, what's the probability that it meets both? And that's your words, your classical words, multiplication rule. So that it means what? Probability of what? F and V. And that will be what? Probability that it meets financial strength, given that what? It meets valuation, multiplied by what? Probability that what? It meets valuation. And that is what? 0.4 times 0.25. And that's what? 0.1. So for those that chose 0.1, that's correct. Okay. So next question. US and Spanish bonds have returns standard deviation of 0.64 and 0.56 respectively. If the correlation between the 2 bonds is 0.24, the covariance is closest to what? So you have 10 seconds to answer this. You are giving US bonds and Spanish bonds, and they've given you what? Their covariances, their standard deviations, and they've given you the what? The correlation, and they say she calculates what? Their covariance. All right, so I've seen A, so that would simply be what? Correlation will be what? Covariance is what? Correlation times standard deviation of 1 and 2, which is what? 0.24 times what? 0.64 times 0.56, and that is what? A. All right, next, which statement is most accurate when considering a multivariate normal distribution for returns on 10 stocks? There are what? 45 distinct correlations not equal to 1, 90 distinct correlations not equal to 1, 100 distinct correlations. Right? So this, for those solving, please type in your answer. We said that what? The total number you have is what? N squared, and that would be what? 100. But they are talking about what? Distinct. This 100 is not distinct. So in your correlation, in your correlation matrix, the diagonal is always equal to 1. So they're saying that what? How many is not equal to 1? All the one above the diagonal is not equal to 1. But what is above the diagonal is what? Equal to what is below the diagonal. So what number of distinct is what? N squared minus what? The diagonal, which is n, divided by what? 2. And that's what? 10 squared minus 10 divided by 2, and that's what? A. So they said distinct. So the answer is A for distinct. So let's look at this. There's this long example. So let's just look at it. Right, let's solve this long example. So it says that what? An analyst produces the joint probability function for a foreign index and a domestic index. So he has the returns. RD1 and what? RFI. Then he has the probability distribution. So this is the probability distribution in the diagonal. So it says that what? So the question is asking is so the question is that what she calculates the variance. No, this yes. What was the question? The question says she calculates the standard deviation of this portfolio. Yes. So what we will do is what? To solve this question, we'll go step by step. So I purposely chose this question just to be able to demonstrate the step-by-step way of calculating this. Okay, the covariance. So first thing is what? You calculate what? So you have something that looks like this. First, you have to calculate what? The mean of each one. In calculating the mean of each one, so you have RFI and RDI. Then this is the probability. You have what? 0.25, 0.5, and what? 0.25. Then for RFI, you have what? 25, 15, and what? 10. And for RDI, you have what? 30, 25, and 15. First is what? Calculate the mean. In the mean, you're calculating what? The expected value. And that will be what? For the first one, the what? 0.25 times 25 plus 0.5 times 15 plus what? 0.25 times 10. Then the second one is what? 0.25 times 30 plus 0.5 times 25 plus 0.5 times 15. So let's calculate the expected values for each one. So first one, 0. So that was 0.25 times so you're giving the answer for the first one is what? 16.25, and second one is what? 23.75. So this is 0. This is it, 0.25, 0.5, and 0.25. Right, so, and what? This is what? 27.5. So this is the expected value. Next is calculate your what? Your covariance. In calculating our covariance, it will be what? X. So we take the first one minus what? The mean of the first one, right? Then the second one. So let's time this one y minus what? The mean of the second one, right? And that will be what? For this first one, it will be what? 16.25. No, sorry. It will be what? 30. So the what? Sorry. 25 minus what? 16.25, right? Multiply by what? 30 minus what? 23.75. Then you do that and multiply by what? Its probability. So whatever answer you get, you multiply by what? Its probability, and you add 43. So do you get that? So what you're doing is, so let me just try and clean it and tell you what exactly it is. So what we are doing is what? For each one, you subtract, you multiply, you do the joint multiplication of their differences or their deviations from their mean. For the first one, what? 25 minus what? 16.25. And the second one is what? 30 minus what? 23.75. Right? This answer, you multiply by what? 0.25. Then you do for the second one, which is what? 15 minus what? 16.25. Then the second one, 25 minus what? 23.75, multiplied by what? 0.5. Then the third one, then you sum up the answer, and that will give you your what? Your variance. So because of time, I'll just let you do the addition. No, you won't be able to use calculators because you have, what's it called? These probability functions, right? And that would affect, because this probability function would affect your calculation. There's no way, I don't know, you can input this in the calculator, right? So, and that will affect. All right, so you just need to finish the calculation. So I've shown you what to do to calculate the variance, right? Multiply this by the what? So when you multiply this, you multiply by this. Then when you multiply this second line, you multiply by what? The probability of 0.5 and so on. Then you add your answers together. And that will give you the variance. Okay, so we are looking for the variance of the portfolio, the variance of this portfolio. That's what we are looking for, the variance of the portfolio. So sometimes they call it covariance of the portfolio too, because what's it called? They interact, but it's interchangeable. It's either the variance of the portfolio or the covariance of the portfolio, right? So like I said, sometimes they say covariance or variance of the portfolio because you have more than one asset there, right? Okay. So let's take this other example, this next example. A firm will select 2 of 4 vice presidents to be added to the what? Investment committee. How many different groups are possible? So they want to choose 2 of 4 vice presidents, right? So they did not tell you that what there is an order in which they have to choose them. So we say that what there is no order, and they want to choose 2 out of 4, and that is what 4 combination what 2, and that will be what 4 factorial over what 2 factorial, 2 factorial, right? And the answer will be what 6. So you can just press this simply on your calculator, 4 combination 2. All right. So now let's move to the next reading. So this is on what? On distribution, on probability distribution. So we have 2 general types of probability distributions. You can even have either a discrete data, or you have what? Continuous data. The difference in the 2 is that what? In discrete, you can count what? The number of your what? Outcomes. And so when you are calculating your probability, it should just be what? The probability of your what? The expected outcomes over what? Total outcomes. And that will be your probability when you are doing for discrete. But for continuous, because you can't count and it's infinite, we use what? We will use what? The area under a chart or under a graph, which is an integration formula, right? But the way we simply do that here is what? So we assume that what? The whole distribution is like a line. Let's say I have a line AB, and I want to find the probability that what? It will be what? Of falling in BC. It will be what? The distance of BC over what? That's C minus B. The distance of BC, which is what? C minus B, divided by what? The distance of what? AB, which is what? This is what? Sorry, let's say this. So let's say this is D. Sorry. So let's say AD. So this will be what? D minus A. And that's how you calculate what? Probability in what? A continuous distribution. Then note, in a continuous distribution, if you have a single number or a point, the probability of a point in a continuous distribution is what? 0, right? Then we have Bernoulli random variable. We said the Bernoulli random variable has what? 2 possible outcomes, right? And you have more than one trial of a Bernoulli random variable, then you have what you call what? A binomial variable. The mean or the expected value of a Bernoulli is what? P. And what? the variance is what? P into what? 1 minus what? P. P is what? Comes what? Probability of what? Success. So for example, if I roll a die, the probability of success is what? So I can either have head or tail. So the probability of getting head, if I term head as my success, will be what? 0.5. So P here is what? Probability of success. But if you have a binomial random variable, because we say what? A binomial random variable is what? N trials of Bernoulli. So your mean or expected value in binomial, it becomes what? NP. And your variance is what? NP into what? 1 minus what? P. Then we have what we call what? The normal distribution. We say that what? Your normal distribution is what? The properties of your normal distribution, that it is what? It is symmetric, right? Around its mean. Its kurtosis, its excess kurtosis is what? 0. It ranges from what? Negative infinity to what? Positive infinity. So we can plot a normal distribution data, right? And we can do evaluations on it. But because we have different data sets, so it will be difficult to keep plotting different data every time. So there's something we call what? A standard normal distribution. So we standardize our normal distribution. And by standardizing our normal distribution, what we are simply doing is what? We are reducing the mean of our distribution. So a standard normal distribution has what? A mean of what? 0 and a variance of what? 1. So this is the expression of what? Of your normal distribution. Your normal distribution is described by what? The mean and the variance. We say that what? It has a skewness of what? 0, a kurtosis of what? 3. And that will make excess kurtosis what? 0. Then we say it is what? Unbounded. That means it's from what? Negative infinity to what? Positive infinity. Then, but if you have more than one variable, so let's say in an asset, in a portfolio where you have more than one asset, then to describe your normal distribution, you need an additional description apart from your mean and variance, and that is what? The covariance between the assets, right? Then we learn how to draw what? Confidence interval. Your confidence interval is what? Is upper limit and what? And lower limit of what? Your mean, from your mean. So you have your mean in the middle, then you have to the upper, to the right, you have what? Your mean plus what? K standard deviation away from it. Then to the left, which is the lower limit, you have your what? Your mean minus what? K standard deviation away from it. And this is what? Two-sided. How do you get this your value K? And we get this K from what? This our standardized distribution. So whatever you calculate as your value of your Z, yeah, is what you use as your K. Your Z is what? X minus mean divided by what? Standard deviation. And that's how you calculate your Z. One of the application of your normal distribution is what? Is shortfall risk or shortfall ratio. And is what? Expected value, expected return minus what? Your minimum return divided by what? Your standard deviation. If your minimum return here is becomes your risk-free return. Let's say if I put this minimum return, I change it to risk-free. This formula changed to what? Your Sharpe ratio, right? If I change this my minimum return here and I replace it with what? Risk-free rate, and that becomes what? My Sharpe ratio. Then we also have what? Log normal distribution. Because there are some distributions or some data sets that cannot range from negative infinity to plus infinity, e.g., the price of an asset. The price of an asset does not have a negative value. So you cannot plot the price of an asset as what? A normal distribution. So we use what? A log normal distribution for it. It starts from what? 0. So it is bounded to the left by what? 0. So Next, we have what? Monte Carlo simulation and historical simulation. By simulation, what we simply means that what? We are using computer to what? To generate some values, right? In Monte Carlo, what we are simply doing is what? We are making some assumptions and we are using what? The computer to generate what? Our distribution for us. So in Monte Carlo, that means you can what? Look into the future. You can estimate, you can make what-if analysis and create scenarios that have not existed before. However, in historical, what you can only work with is what? Is past data that you have and you are simulating it. So in historical simulation, you cannot do what-if scenarios, and you cannot incorporate things that have not happened in the past, right? So that's the advantage Monte Carlo has over historical. In Monte Carlo, you can simulate for what has not happened in the past and do what-if scenarios. Okay, so there's this place I jumped, right? When calculating the probability of a binomial variable, it is given as what? Nx, which is what? N combination x, multiplied by what? The probability of success raised to power what? X. Then 1 minus probability of success raised by what? N minus x. Note, your x here and n minus x was what? Equal to, the summation of the two must equal to what? N. And your total number of possible outcomes you will have is what? N plus 1. So those are the things you should note. If your probability of what? Success is what? Is 0.5. That means each outcome have equal individual chance of occurring. Note, is the outcome itself that has an equal chance of occurring, but they may have different number of times that they occur. So this will make what? If it is what? Is 0.5. If your probability of success is 0.5, this will make your data looks like this, something that looks like this. And we'll say that what? It will be symmetric, right? Okay, so let's look at examples under this reading. So question 9, a discrete uniform distribution consists of the following 12 values. So these are the values. On a single draw from the distribution, the probability of drawing a value between -2 and +2 from the distribution is closest to what? So like I said, for discrete variables, right? So if you have the answer, you can type in your answers. For discrete variables, what you need to do is what? Count the number of possible outcomes over what? The total number of outcomes. And here they said that what? From -2 to 2. So all I just need to do is what? Count the values that are what? Between -2 and what? And 2. So if I look through it, I have 1.4 and 0.8. Those are the values alone. So that means I have 2 possible values. Whereas my total value, data value is what? 12. So that was 2 divided by what? 12. And that was 1/6, and that was 16.67%, right? Next question, the value of the cumulative distribution function, where x is a particular outcome for a discrete uniform distribution, what? A sums up to 1, B lies between 0 and 1, C decreases as what? X increases to 1. So what is the value of the cumulative distribution function, where x is a particular value? So I can see people typing in A. So I want to believe, is this A for this new question or the previous question? So I have Funto type B, Ceci B, BN B. Okay, all right. So what we are saying is that what? If you have a cumulative frequency distribution, your cumulative frequency distribution sums up to what? 1, but that is what? The total cumulative frequency distribution. The question here says for what? For a particular outcome. I will say that what? For any outcome, your probability is what? Between what? Is 0 and what? 1. So that is your answer. When it sums up to 1 is what? When you are considering all But here they say that what? A particular outcome. So let's be careful on the keyword. For a binomial random variable with 5 trials and a probability of success on each trial of 4.5, distribution will be what? So I think I've mentioned this in the example. So let's move on this. So let's go to the next question. For this, I said the answer will be what? It will be what? Symmetric, right? So let's move on to the next question. Investors should be most attracted to what? To be most attracted to returns that, return distributions that are what? As an investor, which return distribution will attract you the most? And we say that what is what? Positively skewed. Because when it is positively skewed, we say that what? The chances of having what? Extreme positive values are higher. So you want to what? Invest with the opportunity of getting those extreme values, right? Next, the confidence interval is most likely to be what? Wider as the sample size increases, wider as the point estimate increases, narrower as the reliability factor decreases. So question is this, how do you calculate your confidence interval? So let me just note that to calculate your confidence interval, you need your what? Point estimate plus or minus what? Your reliability factor times what? Your standard error. How do you calculate your standard error? Your standard error is what? Your standard deviation divided by what? Square root of what? N. So let's look at what are the things that affect your confidence interval. So the higher your standard error, the higher your confidence interval. The higher your reliability factor, the higher your confidence interval. But what are the things that affect your standard error? The higher your standard deviation, the higher your standard error. The higher your N, the lower your what? Standard error. If you see the relationship, because it's in the denominator. So your confidence interval is most likely to what? A, wider as the sample increases. No, because as the wider sample increases, your what? Your confidence interval becomes what? Smaller. Wider as the point estimate increases. Your point estimate has nothing to do with the size of your what? Confidence interval. Narrower as the reliability factor decreases. So we say that what? As the reliability factor decreases, your confidence interval becomes what? Narrower. Okay. So let's move on because of time to the next. Okay, so let me just solve this one question. Let me solve the next question because I purposely put the next question there. The following table. Okay, so let's solve this question, please. The following table shows the forecasted price movement of a stock that's currently priced at what? 40 and does not pay a dividend. So the probability of upward movement is 65%, probability of downward movement is at 5%. If it moves up, it gains 10. If it moves down, it loses what? 10. Using the what? The binomial model, the probability that the stock price will be 39.6 at the end of the 2 periods is going to be what? So you have at your first period is what? Yeah, it's 40. It's starting from 40. So it moves. So it moves by 10% when it moves up. So when it goes up by what? 10%. That will be what? 44. And that when it goes down by 10%. That will be what? So minus 4, that will be what? 36. Right? Then so for the second period, it's going to be what? Move up again, then move down. When it moves down here, it will be what? 39.6. Right? And here will be what? 4.4 plus 44, that's 48.4. Then here, when it moves up here, it will be what? 39.6. And here, this will be what? 36 minus what? 3.6. So these are the two things we are considering. It's going to be what, 39.6 in two places. First, it moves up here, which is what, 0.65. And here, it moves down here, which is what, 0.35. Then here, it moves what? Down 0.35. And here, it moves what? 0.65. So what you need to do is what? Multiply the outcomes. Yeah, since these outcomes are the same, 0.65 times 0.35, 0.35 times 0.65. What you need to do is what? 0.35 times 0.65. That would be what? 0.275. And because it's 2, multiplied by what? 2. And that would be what? 45.5. Okay. Okay. All right, so we move to the next reading because of time. So in the next reading, we are looking at what? Sampling. So what by sampling, we mean what? When you cannot estimate your total population, right? And so you decide to go for what? A subset of what? Your total population. Imagine you want to know the average height of people in Nigeria. We can't do that, right? So we can take the average height of some people and measure it. That's what we call what? A sample. To determine your sample, you need to have some sort of what? Randomness in it. And to get those randomness, there are ways we use. We call one simple random or systematic random. Those are the two ways we use. Another one is what? Stratified random. In stratified random, what we do is what? We try to keep the structure of our population. So we divide our data, we break it down into sub-sectors or sub-segments to reflect what? The characteristics of what? Our population. Then we now randomly select from those stratas. Then your data can come in two forms. It can either be a time series data, whereby you have what? A data measured what? Across time. Or it can come in what? Cross-sectional, whereby you have a data measured what? Across different points or different observations. So for example, if I want to know the profits of GT Bank across the years, that will be what? Time series. But if I want to know the profit of Nigerian banks this year alone, so their time is constant, that is what? Cross-sectional. Then we have central limit theorem. The central limit theorem is what? Say given any population distribution, note any population distribution that has a mean and that its variance exists. If your number of sample is sufficiently large, right, then the sampling distribution we have what? A mean of what? That is approximately equal to the mean of your population, and the variance will be what? Your population variance divided by what? Your sample size. That's what your central limit theorem says, right? And to calculate the standard deviation, all you just need to do is what? Find the square root of your variance. And if you don't know your population variance, you calculate the sample variance and what? Use it to calculate what? The sample standard deviation. Then we look at what? An estimator. We said that what is a sample statistic or an estimator is what we use to what? Estimate a population parameter. So we say what are the properties of a good estimator? We say it must be what? Unbiased, it must be what? Efficient, and it must be what? Consistent. Sorry, give me. Sorry. Hi, Gloria.
Hello, Ibrahim.
And I have one more reading after this. Can I take 15 minutes extra, please?
Okay. Okay.
All right, thank you. Okay, so we said that what for a property of a good estimator, it must be unbiased, it must be efficient and consistent. By unbiased, we said that what the expected value of our estimator must be what? Equal to what? To the parameter we are trying to estimate. Then by efficient, we say that what our estimator must have what? the lowest variance, right? And by consistent, we are saying that what? As we increase the number of samples, our what? Estimator should be what? Become more accurate, right? So now, what is a point estimator? It said it's a what? A single value of your parameter. Confidence interval for the population mean. So now we need to, so we look at examples how to check our Z values and our T distribution. But what are the properties of your T distribution? Your T distribution, just like your Z, is what? Is symmetric. Its skewness is what? Also is 0. Right? But it has what? Positive kurtosis. And it has what? It is what? Described by what? Degree of what? Freedom by n-1. So the difference between the Z value and the T value is what? The Z value has just one table, which is what? A one-tailed table. But the T table, it has different T tables for what? Different degree of confidence, right? But your T value tends to be what? Normal as n increases. So we are saying that what? As your number of sample increases, your T table begins to look like what? Your Z table, right? And we say that what? Your T distribution is much more what? Conservative than what? Your Z. That means that what? For the same parameters, the interval, the size of the interval of your T distribution will be what? Larger than that of the Z distribution, because your T value will always be what? Greater than your Z value. How to know what to use, either to use your Z or your T. So just follow this. When you have a distribution that is normal and your population variance is known, and the population sample either large or small, you can use your Z. But if you don't know the population variance, right, then if your sample size is small, you have to use your what? Your T distribution. But if your sample size is large, you can use either T or Z. If your population distribution is not normal and your population variance is known, but your sample size is small, then you can't estimate this under this topic, right? It's outside of this topic. But if your sample size is large, then you can use what? Z distribution. But if your population is not normal, you don't know your population variance, and your sample size is large, then you can use either T or Z. Like we said, the T is much more conservative, right? So in real life, typically you don't know your population variance, so we tend to use T more. Now you need to know what your degree of confidence is. Degree of confidence is what? The probability that what? The real value will fall into the what? The confidence interval that you've constructed. And the level of significance is what? Probability that what? It will fall outside of it. So the relationship between your degree of confidence and confidence interval is what? Your degree of confidence is what? 1 minus what? Level of what? Significance. So we said that what? In my previous example, I've shown you how to calculate confidence interval, which is what? Point estimate plus reliability factor times standard error. What are the things to consider when selecting a sample? The precision that you require, the cost, the data, sample data integrity. So you don't want to choose between two different sample ranges, right? You want to stay within a population, right? Things you should be concerned about when sampling: data mining bias, which is why you keep mining your data until you get a particular result that you want, or sample selection bias, when some data are not available. Because of that, you can't choose from them. That will bias your data. Look ahead bias, when you're estimating a data that is not available at the date of data. Example is what? Your PE ratio, whereby earnings are released some months in the future, whereas the PE ratio is for a particular date in the past. Then time period bias, when you are getting data from two different time periods, whereby maybe the economic conditions or has changed within those two periods, right? So let's look at one or two examples under this topic. Okay, so let me take question 26 first. For a sample size of 65 with a mean of 31, taken from what? A normally distributed population with a variance of 529. the 99% confidence interval for the population mean will have a limit lower than what? A lower limit closest to what? So you have a population size of 65, and it is normally distributed, and what? The variance is known. So what do you use? First, you have to first of all decide what table you are using. And if you go to the table, you see that what? Your normal distribution is normal, your population variance is known, and what? Your sample size is large, because for sample size to be large, we consider what? 30. So for this, we have to use what? The Z table. So yeah, we use the Z table. So for your Z table at 99%, so let me tell you something about your Z table. Your Z table is what? A one-tailed distribution table, right? Your Z table is a one-tailed distribution table. But when you're constructing your confidence interval is what? Two-tailed. So you have something that looks like this. So you're saying you should calculate what? 99%. So 99% will be within this, your region of interval, right? 99%, which means that what? 1% is outside of it. If 1% is outside of it, that means what? 0.05 is outside there, 0.05 is outside there. But your Z table is what? A one-sided table. It shows only values less than or equals to a particular value. So your Z table is something like this. It shows you everything to the left here. So if I want to read for 99% on my Z table, what I'll go and read is what? 99.5%. Please take note of that. So if I go to my Z table and go to read for 99.5%, the value I will have will be what? I have something that is close to 2.57 or thereabouts, right? Sorry. Sorry, please, what screen can I show? Can you see, please?
It's a table. Well,
okay, all right. Okay.
Numbers.
Okay, thank you.
Yeah.
Okay, so that was my Z table I was trying to show, right? So if I check for my 99.5%, so my 99.5 is somewhere, this is 99.47, and so let me just show you, this is 99. So this is 99.49, 99.506. So 99.5 lies somewhere between these two. So I can simply say what? My Z value was 2.5, 2.50, 2.51, 2.52, 2.53, 2.54, 2.55, 2.56, 2.57, 2.58. It's somewhere between 2.57 and 2.58. So I can just go with the approximate figure and say 2.58, right? And use that in my calculation. So I say that what? My Z value is what? 2.58. Then, so I know my Z value as 2.58. Then I need to calculate my lower value. So for my lower value, it should be what? My mean minus what? My reliability factor times what? My standard error. My mean is what? 31. My reliability factor is what? 2.58. And my standard error will be what? The square root of my variance, which was 529 square root, which is 23, divided by what? Square root of what? Of my data, which is what? 65. So square root of what? 65. So 65 square root inverse of that times 23 is what? 2.85. So if I subtract that away from my mean, sorry, 23 65 square root, right? Inverse of that times 23, that's 2.85 times 2.58, that's 7.36, right? And subtract that from my mean of what? 31. That's 23.6, so that's A. Right, so the answer is A. Okay, all right. So this is the only question we'll solve there. Then we'll move to the last reading. Which is what? Hypothesis testing. So in hypothesis testing, okay, so these are the things you just need to note in hypothesis testing. Know that what you have what? A null hypothesis and what? An alternate hypothesis. The null hypothesis, that is what? The hypothesis you want to test. Right? The hypothesis you want to test is what? The null hypothesis. The null hypothesis is denoted as what? H naught. It is what? Considered true unless what? Evidence suggests otherwise. It is also known as what? The hypothesis we would like to reject. Then second alternative is what? Is your alternate hypothesis, which is what? HA. It is what? The complement of H naught. So that means your H naught and your HA must be what? Exhaustive. Then it is the hypothesis we would like to accept, and it does not have what? An equal sign. Your null has what? An equal to sign. So let's look at forms in which they can take. Your null hypothesis, if it's an equals to null, so if you have a null that is what? Equals to a particular value, then your alternate hypothesis will be what? Not equal to that value, right? And we say that what? When you have an equals to null, then you have what? A two-tailed test. If your null is what? Less than or equals to value, then your alternate will be what? Greater than. If your null is greater than or equals to, then your alternate will be what? Less than. And this two is what? One-tailed, because it's just two, your alternate is just taking one side. So let's look at it. Your null, if your null is equals to a particular value, let's say 2, that means your alternate can either be what? Greater than 2 or less than 2. So your alternate will take two sides, right? And that's why we say that what? This part is what? Two-tailed. But yeah, if your null is less than or equals to a particular value, your alternate will be what? Take only one side and say, we say what? It is one-tailed. Then if your null is greater than a particular value, yeah, okay, I'm rounding off. Okay, so note the common distributions to use. When you're testing for mean and mean difference, you use the words either T or Z distribution. If you are testing for what? The value of a variance, you use the word chi-square, and which is as this formula. Then if you are testing for F distribution, which is difference between two mean, you use what? If you are testing for difference between two population, the variance, difference of variance between two populations, you use what? The F distribution, and which is calculated as this. S variance 1 over what? Variance 2. Note, variance 1 must always be what? The larger variance, whereas variance 2 must be what? The lower variance. Then level of significance is also known as what? Your type 1 error, which is what? When you reject a correct null, that is what you call what? A type 1 error. the power of a test is called what? The probability, that is what? 1 minus type 2 error. And type 2 error is what? When you fail to reject a wrong null. That is what? A type 2 error. And that's the power of the test is what? 1 minus your type 2 error. So we said that what? Type 1 error is what? Probability of incorrectly rejecting the null. Type 2 error is what? Probability of what? Not rejecting a false error null. And your confidence level is what? 1 minus what? Type 1 error. And power of test is what? 1 minus type 2 error. Right? The format of your test statistic is what? Sample statistic minus what? Hypothesized value divided by what? Standard error of your statistic. Then you need to what? Know p-value. You said what? P-value is what? The smallest value in which what? Your null can be rejected. So if your p-value is say 5%, so any value, any level of significance that is greater than 5, you will reject your null. But if it's less than 5, you will not reject it. Right? And you should also be able to what? Determine your what? Your rejection point. So we'll just look at one example, and that will be the end of this. So let's just look at one example. A two-tailed test of the null. So I'm looking at question 37. A two-tailed test of the null hypothesis that the mean of distribution is equal to 4 has a p-value of what? 0.0567. Using a 5% level of significance, the best conclusion is to what? A, fail to reject the null. B, increase the level of significance to 5.67. C, reject the null. So like I said, the p-value is the smallest value where you reject, right? So if you are rejecting as 5.67, if your level of significance is 5, 5 is lower than 5.67. So you will what? Fail to reject the null, right? So that's for the QM class. Hi, hello, Gloria.
Thank you very much, Ibrahim. Yes, I can hear you clearly.
With the class, if they have any further questions to ask.
Yes, that's fine. That's fine. Thank you very much for a wonderful session. Yeah, so we'll be going on a short break to reconvene at 1:55 for the afternoon session to begin. Okay. So feel free to stay online or just maybe log back in later, but we are going to be on until we resume at 1:55. Thank you, everyone.
All right, thanks. That's my number. Okay, sorry, I'm trying to drop my number, please. Okay, so that's my number. You can reach out for any clarification.
Awesome.
Okay, so I should stop sharing, right? Or you take host from me?
Yes, please. You can stop sharing.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance, and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further. Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.
Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Good afternoon, all, and welcome back to the Level 1 Revision Bootcamp. This afternoon session will be kicked off by Chuka, the Society's Vice President, who is going to give a speech to welcome us back into the session. Thank you.
Hi, Chuka, you should be able to unmute yourself now.
Yeah. I don't know. He's online. I've sent him
Yes.
a text.
Hello.
Okay.
Yes, we can hear you.
Okay, great. Thank you. Yeah, so it's really great to be here, and for wanting to join the field of finance or improve your competence. Kinds of things that people, there are all kinds of distractions. And I would say that what has worked over time is that the two critical success factors.
Chuka, I think we lost you for some seconds.
Okay, great. Yeah, sorry about that. So what I was saying is two critical success factors that worked for me. One is preparation, and second is belief in myself. And the reason I say this is because during the time I prepared, there were all kinds of information on the internet, people sharing their thoughts, and it was really scary. So one is if you're not giving enough time to prepare, you're going to fail. That's what I mean is if you're not giving enough time by your employer, you fail. The second, one of the other things I kept hearing is if you get married during while you're preparing for the exams, you're going to be distracted and you'll fail. Third is, if you're a nursing mother or nursing father, you're going to fail. So there are all kinds of things that scare people on the internet, and you choose to believe what you want to believe. And I'll give a very good example. During the final, during my preparation for the final level of the CFA exams, my wife gave birth within less than a month to the exam, and we were living together. So it wasn't a situation of I was in a separate place where I could concentrate. No, I was faced with that distraction. The second is that I wasn't given leave by my employer. I was only given 2 days to basically go and 2 days to allow me to travel to the UK, because that is where I wrote the exam. I was in Nigeria, but I wrote the exam in the UK. So just enough time to travel to the UK to write the exam. And the third is that I don't wear wristwatch. I don't wear jewelry. So on the day of the exam, I didn't have a wristwatch. I took a friend's table clock, and at the center, they seized it. They said it's contraband. And at the UK center, there were no clocks, right? So I wrote at least the morning session of the exam without a timer. But I was determined that nothing was going to stop me, right? And of course, with divine providence, I passed. So the point is, believe in yourself. If you've prepared hard, you just believe in yourself. At this moment, don't let anything, stay away from success. And I would seize this opportunity to thank our sponsors, and to thank our the facilitators. The facilitators have sacrificed their time, and they're giving back, to the community. So I want to thank everyone. I also want to thank you for your time. And on behalf of the board of the CFA Society Nigeria, as well as our members, we wish you success in your exams.
Thank you very much, Chuka, for the short pep talk. Next facilitator.
Yeah. Okay.
Shegun Jimo, you can go ahead.
Shegun, you have the floor. Mr. Chair, you have the floor.
What's his device name? Because I don't think he'll be able to himself, except to make him host.
Okay, yeah, good afternoon. Now you guys have muted me now, right? Can you hear me?
Yes, Shegun.
Yes, we can hear you.
Okay, good. So let me know when you guys can see my screen.
I'm seeing your screen too.
Fantastic. All right, good afternoon, guys. This afternoon session is on equity. We'll run through this equity and hopefully we'll capture all the needed system. So my name is Shegun Shimo, guys. So before we start, I would like to take you guys through how the new structure is. I've discussed with the society as well. This slide on the new structure to be shared with you guys. So let me quickly just use 2 to 3 minutes to tell you how the new structure will be. And I'm sure you guys have seen the new pass rates for May. It was 25% and the lowest since 1963. So one of the numerous factors that caused that failure is because of the new structure. In the past, what happened is when you go to the morning session, you will see questions distilled or generated by modules. Like you will see 1 to 18 ethics, 18 to, so it's sequential. So when you go to number 1 to 18, you will see the ethics there. When you go to 20 to 24, you will see quant there. However, the new structure now is that you will not see this kind of sequence. What you will see now is what we call functional areas. So the functional areas are now divided into 4, which are ethics and professional standards. We have tools, we have portfolio management analysis, and we have assets. So under that, so ethics is straight, right? When you see the functional area on ethics, you just see that everything is there on ethics. But the complicated part is when you now to the functional area number 2, which is tools. The tools comprise of your quants, economics, and FRA. Now, the questions will not follow any sequence. So let's say the functional area for tools is 20 questions. You will not see 1 to 5 quants, 6 to 10 economics, 10 to 20 FRA. No, it will all intertwine. So you might see number 1 as quant, number 2 can be FRA, number 3 can be economics, number 4 can be FRA. So it will not follow any sequence. So that is one of the key things that makes people to fail in May because they were not prepared or they are not aware, or some of them do not research properly to see the new structure that the exam is going to go. So you will see that the bulk of the courses come under assets now. So under assets, you have equity, fixed income, derivatives, and alternative investment. All these 4 modules or courses, they will now fall under the functional area called asset. Like I said, the questions will not be in any sequence, but you will see all the questions for all these courses there. So that is one. The second part is you will see where I put the weight here, right? The weight is just like a guide for you. You will see that the 5 FRA, ethics, equity, fixed income, corporate finance, they are like 62%. So if you look at it properly now, you will now see that assets carries all the weights. So equity 11, fixed income 11, that is 22. You have another 12 there, that's about 30 something. So asset is carries more weight, followed by tools. Tools is about 15, another 20. And so you will see that there are 3 modules or the 3 functional areas that is very key now, which are tools, assets, and ethics, if you may look at it that way, right? Because you must pass your ethics. That doesn't mean that portfolio management analysis is not compulsory. It is. Now, another twist is if in the morning you see functional area on ethics and professional standard and tools, in the afternoon, you will not see any question that relates to those functional areas again. What you will now see in the afternoon will probably be portfolio management and analysis and assets. So prepare your mind. So because you might have read, you might have been prepared, but all these little techniques can make you to fail. So that is the first 5 minutes that I want to use to guide you guys on that. So now let's move to the topic of the day, or the course of the day, which is on equity investment. Your equity investment has 6 headings there. They are divided into equity 1 and 2. The first one on equity 1 is on market organization and structure, security market indexes, and market efficiency. While the second one is overview on equity, introduction to industry and company analysis, and equity valuation. So I will quickly run through these 6 headings just to give you guys the key or salient points that you need to remember them. Then we'll follow by questions and answer. I have prepared about 26 questions that we're going to look at. Hopefully we'll be able to finalize it within a time frame. All right, so, but if you don't get any of if my voice is there, please drop a chat. Huh? So now, let's start. The first one is overview on equity. What this really wants you to understand majorly is that we have common shares, we have preference shares. The common shareholders, there are some things that they have that the preference shareholders don't have. And also, you also need to look at it from the company's perspective and also from the investor's perspective in terms of returns and risk. Which one has the highest risk? Which one has the highest return? But there's a basic concept in finance that I want you to have, that the higher the risk of an investment, the higher the expected returns. Expected. So if we say this investment has a higher risk compared to the other one, I'm expecting to have a higher return. All right, so the first one, who are common shareholders? They are your regular shareholders, right? They are the owners of the business. They own what we call the residual value of the company. What do I mean by that? In the event of liquidation, I'm sure you must have read your pecking order theory, right? In the event of liquidation, who gets what? So it is the debt holders, the debenture holders, the preferred stock holders. They are settled first if company is going into liquidation. Who is settled last are the equity holders. That's why he said that they have the residual value of the company. That means that their risk, the risk of that investment as compared to other is what? Higher. So in that case, they're expected to have a higher returns as compared with debt holders, right? So your common shareholders, they have, like I said, they have the residual value of the company. They share in the operating performance of the company. They perform in the governance process because they are the owners of the business. That is, they have the voting right, they have the claim on the net asset of the company. However, when they are voting, right, it depends on the company. The voting can be by proxy, the voting can be statutory, or the voting can be cumulative. Proxy is simple. It means that I, as a shareholder, if I don't have time to vote in a particular company at any particular point in time, I can actually appoint someone to vote on my behalf. In practice, it is usually the investment managers that normally vote on behalf of their clients, right? So now, another thing is statutory. Statutory is saying that one man, one vote. That is one share, one vote. That one is simple. So it means that if you want to vote like 3 directors out of 10 directors, it means everybody, one man, one vote, one share, one vote, right? It will vote. However, in a cumulative, we can say that instead of having one share, one vote, he will say that one vote per share per each director. So this means that if I want to vote for 3 directors, if I have 10% shares of the company, it means that I have access to 10% voting for each director. So I can decide to cumulatively say, since I have 10% and I want to vote for 3 directors, I have 30% vote. I can decide to vote all these 30% for one single director. So that is the difference between statutory and cumulative. The main benefit of that is just that it gives non-controlling interest a voice. So they can decide to come together, accumulate their votes, and vote and have a representation in the board. Unlike the statutory is usually the majority have their way. They will just go right. Or in cumulative, majority can have their way. However, the non-controlling interest group can also have a representation. They can also have a say in the board. All right, so that's a key thing that I know that it might be tested because it's confusing, but just know that cumulative is when you accumulate all your votes instead of voting for individual. You just decide to put all your votes in one particular issue that is being voted for. All right, so who are the preference share holders? Like I said, they rank above the common share holders. Their dividend are paid from the company operating performance, right? So it means that they get their dividend first. You must pay them their dividend. So, and in theory, we normally say preference shareholder behaves like debt and equity, in the sense that they have a fixed dividend that they must get, and they have to be paid. And at the same time, they don't have a voting right, except it is agreed at the inception. They don't participate in the operating performance of the company like equity does. However, you can have that shares till perpetuity. So it means that it has a characteristics of equity on one hand, that is having the funds till perpetuity, and on the other hand, it also behaves like debt by having their constant dividend and also not participating in the operating performance of the company beyond the dividend that they have given them, and they don't also have a voting right. All right, so now, after that, let me quickly run you through. So after I've explained that, so let's look at what private and public equities are. So public equity are the ones that you can easily go to the stock exchange and buy. It's there. But however, we also have a private equity investment, such as your venture capital investment. Your venture capital investment, they normally invest in seed companies, that is startup. They provide your early financing. So a new company, venture capitalists normally comes, they provide funds for them. In fact, there's another space called business angels, right? Where they give you early funds, where you invest to seed companies. So they help startups, right? And also we have leverage buyouts. Leverage buyouts are mainly MBOs, management buyouts, leverage buyouts. So they normally buy companies that are already not startup, but they are already matured companies that they are struggling. So leverage buyout, they will just take them from public to private. That is, they buy them off the stock exchange, they structure them, and they can now sell them back or sell them to a third party. Also, we have what we call PIPEs. PIPEs is private investment in public equity. So there might be an arrangement between two publicly listed companies in which they own individual shares. So off the market. So that is there. So that's what we call PIPEs, right? So now, if you look at public equity, there are some things that public equity investment have that the private equity investment does not have. And these are testable areas. If you look at it, majority of all the public companies, their management, they focus on short-term performance. You know why? Because if you look at any stock exchange, you will see that they normally announce quarter earnings, quarterly performance. They want to benchmark the performance of the quarter versus the analyst forecast. So like now, the what is it called? The Q2 result is out. Everybody is comparing with the forecast, the analyst forecast, to see whether the company is improving or not, whether they are meeting the forecast or not. Also, before you become listed, there are some costs you will pay, like listing fee, so anything to meet the requirements of the exchange. In fact, in some cases, there are some requirements that will cost you so much, like having internal audit department, having investment relations department. All these things cost money. But in private, you don't need to have such, or you don't need to incur such expenses, right? And also in the private company, they focus on their long-term objective, and the management are closest to the owner. So it means that in the private company, the managers are closer to the owner, but in the public company, the closeness is not that there. And that is why the investors, or let me say the owners, they incur what we call agency cost. So I know in your corporate finance, you must have seen agency cost. So one of the reasons why you are incurring such cost is because owners want to monitor the management of the company so that they can have what we call a goal congruence. That is, they can align objectives. Because if you look at management, they are basically on their salaries, they want to collect their bonuses. So they might be making some decisions that is short-termism, right? And might negatively impact the owners in future. So that's why you incur those agency costs, where you have external auditor, you have this, so all those agency costs is just be able to monitor the activities of the management. And I've talked to you about cost of investors relations too, where you have a department that is dedicated to investors relations. So in the public company, there's so much cost that you incur. In fact, to raise capital, you incur so much cost. However, you have access to huge capital markets as a public company, but a private company does not have such. The public scrutiny is so high in the public company, but not that in the private. However, the corporate governance in a public company is robust when compared with private, because everybody is looking at them. Everybody wants to see what they are doing, right? And that's that. So now, also, we talk about you investing in equity, right? Hello? Hello? Wow. Hello? Hello? Wow. Hello?
Hello, Shagun.
Yes, am I still on?
Yes, you are.
My laptop just, okay, my laptop just went off, so I'm not sure. All right, so let me just go on. So also in, so we talk about you investing in equity, right? So for you to invest in equity, you can either invest domestically, that is buy your domestic company's equity, or buy foreign equity. So it's easy. If you want to buy your domestic, like in Nigeria, it's easier for you just to approach any broker, etc., to help you to buy. However, if you want to invest in a foreign non-domestic equity, it is not so much easy, right? Why? Because in some countries, they place controls on foreign investors. That is, they might not want the foreign investors to come and overrun the affairs of their domestic companies. They might not want for foreigners to have majority shareholders. In fact, some countries don't like the volatility of capital inflow and out, because it affects their exchange rates. However, some companies might say no, some countries, they might say no. What they need is foreign companies should just come and have a minority stake. They want their indigenous companies to still run the show. So all these might prevent you from buying shares or investing in not domestic equity, right? However, if you cannot invest directly, you can invest indirectly. Indirectly is this through what we call depository receipt. Forget the various dimensions. All you just need to understand is the basic concept. What is the concept here? Like CFA society in Nigeria can decide to want to structure what we call a DR. They will go to US, buy the shares of companies listed on New York Stock Exchange, bring it down to Nigeria. All these shares will be in a basket. So they will value the number of shares. Then they will start issuing ownership on that basket. So let's say if the value of the shares is 1 billion. So if you buy 10% of that 1 billion, it means that you pay 100 million. So that means that you have 10% ownership in that basket. So whatever dividend whatever capital gains that they have in that basket, you have 10% of it. So that is just the structure. And I know a bank in Nigeria did such a similar thing a few years ago, right? So the point is that depository cannot be structured anywhere. It can be sponsored or unsponsored. Sponsored means that the companies that CFA Society in Nigeria bought their shares, they are aware of this arrangement. If they are aware of this arrangement, it means that people that are buying into the basket, they will have almost the similar right as the original shareholders in US. That means that they can even vote in the affairs of the company. Unsponsored means that the companies that owns those shares not aware of it, they are not participating in such arrangement. It means that it is only CFA Society in Nigeria that they recognize as their shareholders. So it's only CFA Society in Nigeria that will be able to vote and exercise all other shareholders' rights. So as long as you understand that basic concept, every other thing is simple. If they say global depository receipt, it means that you are buying global shares. You are buying shares all over to put it in that structure. If they say American depository receipt, it means that you are buying American shares in that structure. Same thing, global registered shares. Same thing, basket of listed depository. So basket of listed depository means that you are now buying different interests in different DRs and structure it in a single basket. So that is what you just need to know there. So after this, you just need to know that in ADR, American Depository Receipt, we have like 4 levels. We have level 1, we have level 2, we have level 3, and we have rule 14.4E. Why I'm giving you this is in your curriculum, right? But all you just need to know is number 1, level 1 and rule 144. Yeah, level 1 and rule 14.4A, they are not listed. Since they are not listed, they will behave like a private company most times. While the middle ones, level 2 and level 3, they are listed. That is why they will have high listing fees, because they will have to pay those fees, right? And if you check, you'll see that level 1 and rule 14.4A, they are traded over the counter. They're like a private offering, we sell. Just like I said, just know that level 1 and the rule 144A, they are not listed. So majorly, the characteristics of a private company will apply to them. While level 2 and 3 are listed, and they will behave like a public listed company. Those are the key things that you have to understand there. And now, if you talk about the risk and return of equity, we have 3 major types of returns, right? Dividend, price returns, which is your capital appreciation, and currency return. Currency return in the sense that if you are investing in non-domestic equity, like if a Nigerian company is investing in the shares of American company, the exchange rate between Naira and dollar, it will be a return to you. Just take, for example, if 5 months ago, you bought shares valued at $5, 5 months ago, and the exchange rate was about let's say 385. Now it is 500 and something. That means that for each dollar, if you should sell that shares now at the same $5 without dividend or without price gains, it means that you'll be having a $200, a 200 Naira on each dollar. So times 5, that means that you have already made a currency gain of about $1,000. So that is your currency return step. So that one is only applicable to non-domestic shares. That is, if you're not investing in your domestic shares, right? So another thing that you might see in the exam is comparing common versus preference share, which I've dealt with extensively there. So just know that common, they have the residual, preference have the preference shares, they rank before common share, cumulative and non-cumulative. Touch base on this. Cumulative means that it's a type of preference shares that if your dividend is not paid this year, next year, you must pay what you were owing nil last year before you pay your common share holders. Non-cumulative reverse is the case. If it is not paid next year, you don't need to pay me before you pay your common share holder. So what the examiner will want to ask you for here is, from the investor's perspective, which one do you think is more risky? Is it cumulative or non-cumulative? You will agree with me that it is what? It is non-cumulative, right? Because cumulative, you still get your money. Also, putable and callable. Putable means that there's an agreement that I can sell back the shares to you at an agreed price. Callable means that the company can buy the shares from you at an agreed price at the inception. So the risk is, the examiner will not just ask you straight that what is callable, what is putable. You have to understand from the question, from which angle that the examiner is asking you for. Is it asking you from the investor's perspective? From the investor's perspective, you will agree with me that the one with the lesser risk is putable because the guy has a guaranteed flood value. But from borrower's perspective, that is from the company's perspective, the one that has a lesser risk to them is callable. So they can be able to buy and resell at a higher price, right? So yeah, another thing that you should know here is how management increase equity value. Your equity value, look at equity value in two ways. Look at the market price. If you look at the market price of an equity, just know that that represents the optimism, the perception of investors in that market, what they believe that the company is worth. However, if you look at the book value of a company, it represents the prior performance of the company. Because if you check your FRA, you'll see that the book value of an equity is your what is your premium, your value, your retained earnings. So retained earnings increases the book value, right? And your retained earnings is gotten from where? Your P&L, that is your income statement. So it is basically the past decisions that have been made, the past performance of the company. It is what is represented in your book value of equity, while your market value represents the optimism of the investors in that company. So yeah, so you should be able to distinguish between the two. And when you are being asked, you should be able to know what to say there. All right, so let me quickly run you through the second thing here is on industry analysis. How do you, because if you want to invest in a particular company shares, you just don't say, I want to go and buy GTB shares. No, you will look at the banking industry. You will do your analysis first before you invest. So doing your analysis might mean that there are two ways. You can do what we call a top-down approach or a bottom-up approach. A top-down approach means that you look at the macroeconomy, you look at the micro, which is the industry itself, then you do what we call company analysis. So to be able to see, so you look at what the general economy is saying, you look at the industry that the company is operating in to see what the industry is like before you now choose to invest in which of the companies in that industry you expect to outperform. So this is all bottom up in the case that you analyze the company first, you go to the industry, then you look at the external environment. So this analysis is looking at your top down. So from your top down, we exclude the macro environment. So we are looking at the micro in the sense that you want to analyze the industry. So if you analyze the industry, it helps you to have an understanding of that industry. It helps you to do company analysis. It helps you to understand the business environment that the company is actually operating in. What are the potential for growth? What are the competitions that they have? What are the risks in this industry? And as a credit analyst, it also helps you to have so many information about the firm, whether you want to give the firm a credit or not. So all these industrial analysis will help you to see whether the industry is actually profitable, they are making profit or not, right? So, and also in an active management strategy, industrial analysis is good because that will help you to see that whether the industry is actually performing properly or not. All right, so also we call something performance attribution. Performance attribution is that you want to see where the good performance is coming from. You want to be able to distill where the good performance are coming from. So industrial analysis will help you to see whether it's the sector that is actually giving you the good performance, whether it's actually the skill of the active manager that is giving you the good performance. All right. So how do we classify industry? There are three basic ways in which you can classify industry. You can either classify them by the product or services that they offered. You can classify them by their sensitivity to business cycles, or you can use what we call statistical method. Statistical method it has numerous disadvantages. That is why it is no longer done, right? Like your QM, I'm sure you just did your QM around level to 1. There's something we call covariance and correlation, right? Statistical method, the use of cluster analysis, is saying that it wants to see how two companies move together. So it is their movement that it will use to categorize them in an industry. However, the correlation that you see in the last 5 years or in previous year or historically might not be correlation for future. That is why statistical method is not good for grouping companies into sector or industry. However, if you group firms today, they might differ across time and countries. Like if you are saying that Dangote was is under manufacturing industry in 15 years ago. Now, Dangote does not fall into that category anymore. Things have changed, right? So also, statistical method is not that intuitive, right? And it's susceptible to statistical error. So that is why grouping industry has been centered around only looking at the firms, about their sensitivity to business cycles, or looking at them by the product services that they offered. So now, by product services that they offered, you can look at pharmaceutical company. Let's look at how all these guys, they sell drugs, blah, blah, blah. Then you look at the hospitals, they are the ones that administer it. So both the hospitals and the pharmaceutical companies, you can now group them into what we call health sector. Just like your telecommunication as well, you can look at people that are manufacturing phones, SIMs, even the service providers like MTN in Nigeria, they sell data to you. So all of them can be grouped into the same sector. So now, this industry classification, we have two classifications. One is commercial, the other one is government. And you will agree with me, anything that is commercial, it is meant for profitability. So, and government, they are majorly grouping industry for tax purposes. They want to be able to know which is doing this. So that is why if you see most government classification, they don't take the exact composition into context, right? However, commercial providers like Standard & Poor's, Russell, what they do is they will provide you the identity of the constituent firms. That these are the firms that make up this industry. These are the firms that does not make up this industry. Also, government classification systems are less or are updated less frequently. But commercial, because they are making money from it, they update it frequently, right? So, and also governments do not distinguish between small, large firms, profit or non-profit organization, or public or private. However, the commercial, they ensure that that classification is needed, right? So that's that. So let's look at what is cyclical and non-cyclical. If you cyclical from the word, it means that that company or that industry, their earnings behaves in line with the business cycle. So one of the industry that you can look at now, there are many, because this COVID has even ensured that it seems all the industries are cyclical, right? But if you look at oil and gas, for example, the earnings varies with the business cycles, right? But non-cyclical companies are companies that their earnings are not really affected by the business cycle. If you look at, let's say, like your food and beverages, right? Their earnings are not really affected. However, in fact, during COVID, I think some companies that are producing alcohol, their earnings, their sales also increases, they did, right? So you can look at that. And the same definition goes for defensive and growth stocks. It's just telling you that defensive, their earnings are less affected. Growth stock, in fact, they even grow during your downturn, right? So in your industry analysis, like I've explained earlier, look at the macroeconomic environment, look at the different approaches, look at the forecast of the industry, etc. So now, how do you do industry analysis? Your syllabus is just saying that you have to do industry analysis in two ways. As of now, as at your level 1. The first level is you have to use Potter's 5 horses. Potter's 5 horses, like the name implies, it has 5 horses. The 5 horses, let me see the chart. Sorry. Okay, so the 5 horses is just saying that these are the 5 things that can affect the profitability of the industry. That's it. The number 1 is rivalry among existing competitors, threat of entrant or barriers to entrant or entry, threat of substitute, powers of buyers and powers of sellers. Rivalry, if there are so many players in an industry and they are all fighting for market share, you will understand that you will agree with me that there will be something we call price war. Price war means that everybody will be dropping their prices in order to gain market share. Also, if customers are sensitive to prices, then there will be price war. Now, let me give you example of iPhone and Samsung. If you look at it, because iPhone wants to continuously have that market share, so they are trying to ensure that the switching cost is so high. How? If you buy iPhone, if your iPhone cannot use any other stuff, right? You can only buy iPod, iPhone Watch or iPod Watch, iPod, everything is II, right? It's from the iPhone category. It cannot work with every other thing. Now, if you now say you don't have money, you want to switch to an Android phone, all the things that you have saved in your iPhone cloud or everything, it will be difficult for you to migrate them. You will have to download one software to migrate it. So you might not want to go through that stress. That stress is what they don't want you to go through. That's why they are increasing that what we call the switching cost. They don't want you to switch. So they are giving you all the comfort. There's another one now. What is that one? Clubhouse. So iPhone introduced Clubhouse so that you guys can go to Clubhouse, you can chat, you can gist. So what they are trying to do is they are trying to portray the users of iPhone as exclusivity, right? Like the highs in the society, so that you will see yourself as in that club, and it's difficult for you to switch to Android. They're just creating switching cost. Like before in Nigeria, you remember that MTN SIM used to be the most expensive. I think it was 60,000 naira when it was introduced. At the point it dropped to this. Now with the ports, you can port from year to year. The switching cost has disappeared. So I can even buy a SIM from MTN and port to it is allowed. So what I'm saying is that even if you create a switching cost now, government regulation can erase that. So watch out for those little details in your exams, right? So that's that there. Don't let me dwell too much on that. There's so much to discuss there, but you can just give you the straight thing. Another thing is barriers to entry. What we are saying is that the players in the industry, they will create a barrier so that they don't want new guys to enter the market. You know, if new guys should enter the market, it means that it will increase the participants in the market. Increasing market participants means that you will now have a price war. So they will create that barriers to entry. Like now, if you want to enter, let's say, a building industry in Nigeria, it will be difficult for you, right? Because you will need so much funds, or let's say auto industry. If you can enter auto industry, there's so much funds that you need to build. Do you have that funds? So that is a barrier. Threat of substitute is saying that people can even get satisfaction from an alternative product, right? If that is present, then it means that the profitability of the industry has dropped. Remember, what we are doing basically here is that we're analyzing that industry to be able to check or to determine whether that industry is profitable or not. So don't lose sight on that, right? So powers of buyers is that, do you have a concentrated buyers? If you have only 20 buyers and they can form a collision, and because buyers, what they want is lower cost with high quality. So if you have a set of buyers that controls your sales, then it means that that industry will not be profitable because they will be using the bargaining power to ensure that the prices are dropped. And also, bargaining power of suppliers is that suppliers, they want to supply you cheap products at a high cost. So it means that that will increase your cost of goods sold, and that can reduce your profitability. So in that case, it means those suppliers, they can actually affect your cost negatively, increase your cost. And if buyers are also particular about prices, then your revenue will drop. So that means that the profitability has dropped, right? So in a full analysis, which is not required from your level one, you might be able to assess whether you should be able to assess each of these forces to see whether in that industry, is it high, low, or medium. So in totality, you should be able to determine whether that industry is profitable or not. However, there's a key point in your curriculum, right? And these are where the questions might come from. High barriers. If there's high barriers, you should expect that that industry will be profitable. It means that they've put in so much barriers that it's difficult for a new entrant to enter the market, right? Concentration of firms. We are saying that if we have two major players and the shares are equally distributed, there will not be profitability in that industry because they will be fighting. The price war will be so intense that the returns will drop. However, if you have myriads of participants, so many participants, but we have one or two major players that have the largest shares, yes, that industry might be profitable because it means that they will control the pricing in that industry. And also, if that industry has what we call unused capacity, I use an example of an auto industry now, right? When Tesla came on board, the likes of Toyota, Volkswagen, they don't know what it's them. They can't exit the industry. You know why? They have plants everywhere. To close those plants means that they have to spend huge amount of money to take off their footprint there. And those plants, those machines that they have a constant depreciation that they are paying. They have leases in some cases that they need to pay. They need to meet their obligations on those plants. So in that case, what will happen is that they want to cover this fixed cost somehow. So that means that they might be selling at a ridiculous prices. So that kind of unused capacity means that that industry will not be what? Because what they want to actually do is that they just want to cover the fixed cost of those unused capacity. Another one is there is stability in the market. If there is stability in the market, it means that the market will be profitable as against when there is volatility. So, and I've mentioned to you too, customers' price sensitivity. If customers are price sensitive, then it can also affect the profitability of that industry. So that is Potter's 5 horses. The second analysis or model that you can use to analyze an industry is what we call life cycle model. This model explains 5 stages that companies or industry go through. The first stage is the embryonic stage, where there is slow growth, the prices are high, your large investment is required, the risk of failure is so high. These are the stages that we say that your venture capitalists normally come in and invest, right? They invest at the early startups, the seed stage. Yeah. So you have to look at it. If that industry is at the embryonic stage, do you want to invest in an industry that has high risk of failure, slow growth, high prices, or you want to look at it if they have a growth, if the industry is at the growth stage. At the growth stage, there's a rapid growth, there's limited competitive pressure, prices are falling. Why? Because of economies of scale. So it means that their cost of goods sold is dropping. So in that case, their profitability is what? Increasing. Or is it an industry that is at the shakeout stage? The shakeout stage means that growth has started slowing down. There's an intense competition because there is no rational human being that will see an industry that is growing with good profitability. Everybody will want to go there. Just look at the madness that we saw some months ago on crypto, right? When everybody was saying, oh, crypto is growing up, this is good, there will be influx. There will be influx. So that happens to industry as well. So if you see that this industry is growing, then everybody will start jumping in. If you are jumping in, you will also bring in your investments. And you want to make money on that investment. Then there will be intense competition. You want to make your money. Then profit will start declining. Then you start having overcapacity because huge investment is going into that industry. Then that's when you now start seeing companies now doing what we call restructuring. Restructuring is just they want to cut costs. That is, they will just want to fire people, do so many things. So, or do you want to invest in a matured industry where the barriers to entry is so high, the pricing are stable, the bigger firms are acquiring the smaller firms, however, the growth is slow. And so this kind of matured industry, they're the ones that we normally categorize as value stocks. If you remember your value stocks, they might have low PE ratio, but their dividend yield is high higher as compared to the growth stocks, right? Or the industry, how do you know that you look at it? Is this industry having negative growth? Are they having excess capacity? Is the competition so high? So meaning that industry is what? Declining. So these with Potter's 5 horses can give you an idea of how the industry is behaving. So you will know whether that industry is profitable or not. So after you have done this thing, you can now look at the external or the macroeconomic factor, the inflation rate, the interest rate, the technology, the demography. Like now, I saw some guys, they want to start these elderly homes. They came to me and said they would need some analysis on it. And I told them, do you think elderly homes will sell in Nigeria? They said, why do I ask? Over 70 to 80% of the Nigerian population, they are less than 30 years old. So who are the elderly that you want to put in that kind of homes? If you want to set up an elderly homes in Italy, in Spain, yes, it will go because majority of the population are aged population. And you know, in those environments, it is man for man, or let me say it away. in Nigeria, I would love to train my kid up to any level because that is my own insurance. In fact, I would love to even train my niece and nephews because they are my insurance. But in the advanced economy, they take their self-insurance seriously. So I don't even need to train my kids. When he gets to the university level, he or she can get university loan and start his own life. He can leave the house at 17 or at 18 or at 15. But it's not. So those guys came up with a very robust pitch. They were so all over the place. And I told them, I'm telling you, 70 to 80% of your population that you want to target out of the 200 million, they are below 30. So if you now look at 40 to 55, maybe you take another 15% or 20%. So where in the states, in Nigeria, do we have the aged people? You have to look at that first. Secondly, the average lifespan of a Nigerian is 55 years. So who are you putting in the age homes? So these are the things you need to look at before you invest in any particular industry, right? So now, after that, after looking at those external environment, the social influence, the culture, like I said, the culture, I don't think any Nigerian will want to take his or her elderly mom or dad to age home. The mentality can change in future gradually, but not at immediate, not a decade. So it will change, but not now. All right, so after you have done that, then you can look at the complaint itself. You want to analyze the complaint. Analyzing the complaint, you have to use two things too, right? You have to look at cost, leadership, and differentiation. There's a third level we call a niche player. Cost is that, is the complaint competing as the lowest cost producer, like Swatch, like Techno phone, which other phones, all those phones, or is it competing as a differentiator, like Rolex? Not everybody can afford Rolex, right? They said they don't only tell time, they tell the distance. So they are a differentiator. Just like if you want to buy your car, you can go and buy your Toyota Yaris and stuff, but Rolls Royce, a differentiator. The car will take you from point A to B, but there's a differentiation right there, right? So niche player can be that, are they targeting a particular segment as a cost leader, or are they targeting the market as a differentiator, right? So if you look at the Samsung and Apple, Apple is like a differentiator. While Samsung is still telling you that, yeah, he is a differentiator, but can also be a cost leader as well. So I like the strategy that Samsung is using recently. What they are doing is that they have this S series, S21, S10, S9, that is competing with the likes of iPhone 10, 12, whatever. That is, they are participating in that differentiation market. However, they also have all these, they are A1, A, whatever, which is also like participating or competing with those technos in a cost leadership environment. So these are the things you will look at. Look at the demand for their product. Look at the overall governance, the strengths, weaknesses of that company. You can also do some financial issues that you were taught or that you have read in FRA, like your quick ratio, current ratio, etc. So you can also use that to do what we call firm valuation. And that's that. So let me quickly run you through the third topic. I'll be done. I want to be. So this is one of the key topics in your equity anyways. It talks about equity valuation. So you can value the equity based on three ways. That is, you can use the discounted cash flow, you can use multiplier, or you can use asset-based method. Your discounted cash flow is divided into two, which is your dividend growth rate and your free cash flow to equity. This is testable, highly testable. And the second one is your multiplier, which is you are using your sales, your PE ratio, your price to sales ratio, or you're using your EBITDA ratio of enterprise value to EBITDA. And the last one is your asset base, that you want to value a company based on their total asset minus your total liability and preferred stock. So let's quickly run through this. The thing that I want you to understand in dividend growth are just basically three things. Number one, in the question, the examiner will usually give you the dividend as at now or dividend next year. Look at that statement. If the examiner is saying that the dividend now is this, then in using your formula, ensure that you include growth. If the examiner says the company will be paying so dividend next year, it means that the examiner has already given you D1. So in your formula, this formula that you are looking at down there, don't use G anymore. Just put your D1 only. The second thing that I want you to understand is, in the exam, the examiner will want to play with how versatile you are. The examiner might likely give you two growth rates. That is, a high growth rate period, which might not last for more than 2-3 years, which is practicable. Because if a company should start now, the company will usually have a period of high growth rate where their product is still new, people want to gain acceptance or all those things. Yeah. So at the end of that initial high growth rate, whatever you have there is what you should use to calculate your perpetual value. What do I mean? If the examiner said that your growth rate will be 8% for 3 years, at the end of year 3, the dividend that you are getting at the end of year 3 is what it is what you should use to calculate your perpetual value. And that perpetual value that you have gotten with that year 3 dividend, make sure you add it to year 3 value so that you can discount both value at year 3. Don't go and discount the perpetual for year 4. So the things you should know is that you should use the last year dividend to calculate your perpetual. Use also the last year discount rate to discount your perpetual value. This is very key, please. So what are the assumptions of dividend growth model? It's saying that dividend is an appropriate measure of wealth. It's saying that dividend are constant growth rate. However, what you should know is that that model is susceptible to the denominator. If the denominator, let's go back, if G is higher than KE, it means that the denominator will be what? Negative. Then you will have no value. It means that the value will not make any sense. I have seen this in some mocks, and I believe that examiner usually play with this a lot. You might not be given dividend, you might not be given this. Examiner just say growth rate is 10%, KE is 7. Your denominator is already 0. Can dividend growth model give you the following value? 10, B, 20, C, not applicable, because so you have to be careful about that. So also to estimate growth rate, you have to use 3 methods. The first one is the Gordon's growth rate. The Gordon's growth rate is saying that you should use retention rate multiplied by your ROE, or you can use the dividend growth model itself, or you can use what we call extrapolation method, which is talking about your last dividend or your latest dividend divided by your base dividend, square root, number, -1. However, I don't expect the examiner to kill you on that. I expect the examiner to set based on dividend growth model. So the same thing, the same concept of dividend is what you should apply to your free cash flow to equity. It's the same thing. However, like you are being given dividend in the exam, the examiner might not even give you the dividend straight. The examiner might say the earnings of the company is 10, the dividend payout is 40%. So that means that you will have to do 40% of 10 to get the dividend of 4 for that year. That calculation that you have done, the counterpart of that calculation in free cash flow is that if you want to calculate free cash flow for any year, you will have to use that formula. That is net income plus your depreciation minus your increase in working capital minus fixed capital investment minus your net debt, which is your principal repayment plus new debt, right? Net borrowings. That is just what you will use to calculate annual. That does not mean that that is your free cash flow to equity value. No, that is like equivalent of dividend when you are using dividend growth model, which you should now still use to your formula to discount to present value it is. So if you like, look at it this way, that the value of anything, the value of the security, the value of the shares, the value of human being itself is the present value of the future income. The future income you get from shares are your dividend, your capital appreciation, etc. So the value of anything is the present value of the future income. So that is why even if you are valuing your bonds, etc., you use the interest and capital repayment to bring them to present value. So even if you want to value human beings, we call it human capital. That is the present value of what that guy will be earning till he dies, like salary increase, etc. That is what you bring to present value. And that is the value that we normally advise investors to take insurance on in case they die. But that is the value that the insurance will pay, right? That is, you are mitigating what we call mortality risk, right? That should be part of your portfolio. You will see that in your portfolio management as well. So that's that. Please note that if the examiner now says, what is the dividend capacity? Or the examiner can even say the dividend capacity of the company is 10. Use this to value the company. The examiner is simply giving you free cash flow towards equity. Free cash flow to equity of the company is the dividend capacity of that company. That is what the company can actually pay out as dividend to all its shareholders. So on the price multiples as well. Okay, so this second valuation method is price multiples, right? Which you can use a PE ratio, price to sales ratio, etc. However, in the price multiple approach, there are two things you should know. You can value the company based on fundamentals using price multiples. Based on fundamental is that formula that I've given there. It's saying that your D1 divided by your E1, both divided by KE minus G. If you check well, D1 is talking about dividend. Dividend, E is talking about earnings. So what this equation represents is simply what we call dividend payout. So what it means is that if you are using your price multiple approach to value a company based on fundamentals, and the examiner is asking you for justified PE ratio, what you simply need to do is payout ratio divided by cost minus G. That's all. That's all about all these things. And the examiner, so based on that, your justified PE ratio, it will be higher if your dividend payout ratio is higher, if your growth rate is higher, and if you have a lower required rate of returns, your PE ratio will be higher. Also, you can also do your price multiple based on comparables. That is, you can compute them based on historical average, which we call time series, or you can compare them based on industry average or similar stocks, which we call cross-sectional comparison. Also, in your price multiples, like I said, we have something we call EV, that is your enterprise value divided by your EBITDA. Your enterprise value is just saying that what's the value of your common stock plus your preferred stocks plus market value of debt minus cash and short-term investment divided by your earnings before interest and tax, depreciation and amortization. What this is simply saying is that if you check free cash flow, if you check your earnings, if you check your dividend growth, they all have their disadvantages, which we will talk about quickly. However, EBITDA of a company cannot be negative. If the EBITDA of a company is negative, it means that the company does not have business to be in that business. EBITDA is simply saying, I sell a bottle of water for 10 naira how much did I bought it for? Did I buy it for $8? 10 minus 8, I should have 2. So every other expense can now make that EBITDA to be negative or positive at the end of the day to have your net income. But the point is your EBITDA, which is like your gross profit. That is your cost of goods sold minus your revenue should not be negative. If it is negative, you should not be in that business. All right. So, and the last one is your fair value of asset minus fair value of liability. This model provides what we call the floor value. It is the least value when you are doing asset valuation, right? It gives you the lowest value. So it's now for you to compare it with other models to see whether the company is viable or not. All right, so these are the advantages and disadvantages. Advantages of discounted cash flow, which are your dividend growth rate and free cash flow. It's easy to compute, is well accepted. Free cash flow model can be used if the company does not pay dividend currently. Gordon's growth model is useful for stable, mature, non-cyclical firms. We also have multi-stage. That multi-stage is what I explained. That is, you don't have a constant growth in which you have a period which there is growth on which the growth is higher than the other period that the growth is not, that it will not become stable. For dividend, for discounted cash flows, they are susceptible to the input. That is, if the input is not right, then the valuation will not be right. And also, they are sensitive to the denominator. Like I said, if the denominator doesn't make sense, the value will not make any sense. And also, the required rate of return, it assumes that it is constant. So, and for dividend growth, it's assuming that the company pays dividend, and the company will pay dividend into perpetuity, which might not be the case. So, for price multiples, it's accepted as well. It is widely used. The calculation is easy. You can use it for predicting stock returns. You can use it for cross-sectional or time series comparison. EBITDA is mostly useful when you are comparing firms that have a huge capital, that have different capital structure, or when earnings are negative. Yeah, so the disadvantages is that the denominator for what is called for multiples based on fundamentals can be negative. If it is negative, it will not make any sense anymore. Also, when you are comparing with firms, some firms, especially international firms, like now, a Dangote can be experiencing recession in Nigeria, while the same Dangote might be experiencing a boom in Japan or Zimbabwe. So if you now want to compare, it might be difficult, especially for international firms. So for asset base, it provides a flow of value. It's mostly reliable if that firm is mostly tangible. At least they have is an asset-based company, not that all these intangible like your floater wave or all these guys. How do you value them? Basically intangibles, right? So you can use all those free cash flow for those kind of guys or for those kind of companies or dividend growth, right? We also have a model to value intangibles anyways, but it's outside the scope of your syllabus. So we also have, so the disadvantage is that it provides the flow of value. In an hyperinflation economy, the value will not make any sense because it might be difficult for you to estimate the fair value. You might not know what to use to estimate it, right? All right, so, and that's that. So the fourth topic is on market organization and structure. So yeah, it's talking about Sorry, guys, for the break in transmission. It was due to unavoidable network glitch, right? All right, so can you guys hear me now? Can somebody else confirm that you can hear me?
Yes, we can hear you, Sergeant.
Thank you. Okay. Let me go on with my slide. All right, guys, so we are on functions of the financial. We are on the function of financial system. So what I was saying is that people use the financial system for 6 main purposes. They want to save for the future. Like if I have immediate consumption for the fund, I will not want to buy bonds or invest. So, but because I'm investing means I don't have immediate need for consumption, right? So I want the financial system to help me to be able to save for the future. If I don't have money for some investment, I want to borrow. I want to raise capital. I want to manage my risk. I want to be able to exchange assets for immediate and future deliveries, or I want to trade on information that I have. So these are the purposes why people will want to use the financial system. So, however, the financial system should be able to facilitate this so that people can achieve their purpose. I'm sure you have seen or you have heard about the madness in Nigeria FX rate. The CBN stopped funding the BDC. Then suddenly the following day, dollar jumped to 530 or something, pounds is 710. If people does not trust the financial system, if the financial system is not helping them to achieve these purposes, they will want to go to the black market to achieve this, right? And that is not good for the financial system or the country as a whole. So the financial system should also help to allocate capital based on best use. And the financial system should also help to discover rate of returns that will equate savings with aggregate borrowings. What we are talking about here should be able to help with the equilibrium rate. So having said that, there are so many assets and contracts in the financial market. You have the financial assets, which are your bonds and stocks. We have the real estates. We have the primary market and the secondary market. The primary market is where you issued your IPOs and your seasonal stocks. The secondary market is where participants continuously trade, right? I've explained the private and public. We have the financial and physical delivery. We have the spot market, where the delivery are immediate. You have the money market, you have the capital market. So if you buy fixed income, if you buy equity, what you are simply done is you are simply say there's a contract between you and the company. So we also have pooled investment like your mutual funds, your ETFs, all these your American depository receipt that we talked about today are pooled funds, right? Hedge funds, your asset-backed security. We also have your currency like your forward futures in the market. So now we have various players too. We have your brokers, your dealers, your exchange, also include your electronic communication network, your investment bankers, your securitizer, deposit institution, insurance arbitrators, clearing, and these are your. So you also have positions that you can take. You can take long. Long position means that it gives you the right to buy. Short means it gives you the right to sell. We also have a position called short sale position, where you borrow a particular shares from an individual. You simultaneously sell that shares, then you use that money to invest in another thing. So it means that when the person says he wants back his shares, you go and buy that same number of shares back to the person, right? What you are betting on in that case is that the share price of that company that you're taking, it will drop. At least if you borrow 1,000 shares at $10 now, you are selling, so you are believing in future, the $10 can be $5. However, you will have invested the 100,000, gain some dividend, and buy the shares back to the individual, to the investor, or to the seller. However, The seller, you will also have to pay the seller the dividend. You also have to share in the profit with the seller and your investment banker as well. Leverage position is when you are using borrowed funds to buy an asset. Notes, I've seen in many questions, the examiner will ask you for a return on your equity position. If you should use a borrowed fund, when you're calculating your returns, you have to remove that borrowed amount. It is only your equity portion. Your equity portion means your own money, right? Is what you must use to calculate your returns. In the gains, you must remove the interest on the borrowed funds to be able to calculate the returns to you. So those are the positions. We also have different orders, right? Market orders. You are saying go and sell in the market at this rate. We have limit orders. We are saying don't sell or buy at so rate. We also have a valid instruction. You can say this order is good till it's cancelled. You can close out this order when is this. So those are various things. Like I said, primary market is used for your IPOs and seasonal offerings. You use your investment bankers to help you to do that. So you can also do a private placement in your primary market. You can do your shelf registration. You can do your dividend reinvestment plan. You can do your right offerings. You can raise money at the primary market at a lower cost. While secondary market is where trades take on consistently. So the trading session can either be called market or continuous market. So the type of market structure that we have are basically three. We have the quote-driven. No, it's basically two. We have the quote-driven and we have the order-driven. The quote-driven is saying that you place your stock, you transact with the dealers are the market makers. These are usually applicable to the bond market, right? So while the order-driven is saying that orders are executed based on rules, right? The rules are usually price, priority. They will execute the orders with the best prices. They will then follow another rule, which is non-hidden orders. You just want your orders to be transparent, and they will now look at earliest arriving orders. That is first come, first serve basis. All right, so there's also market information. The players, they want the market to be transparent. Investors, they want to obtain pre-trade information, whether it's quote-driven or order-driven market, at considerably no cost. If cost of getting information is high, it means that that market is not efficient. We will talk about that when we get to market efficiency. So in a well-functioning financial market, investors should easily move money from present to future at a fair rate of returns. Borrowers should be able to obtain funds. Hedgers can easily trade away or offset their risk. Traders can also easily trade currencies. A well-functioning market has a complete market that is operational and informational efficient. That is, the price reflects the fundamentals. Also, a well-functioning market they have financial intermediaries that will organize the trades, the venues, etc. So if you have a good functioning market, savers, like now, if I buy bonds, if I buy commercial papers, if I keep money in my bank as a fixed deposit, what I'm simply doing is that I'm funding entrepreneurs, because the entrepreneurs can go to the bank and borrow those funds to fund their ideas. But if the market is not functioning properly, investors will rather move their money abroad or they will consume it now. That is why in a country, you have to look at the rate of consumption and investment. If the consumption is so high than investment, that country is in trouble. So what we're saying that the financial market should help to fund the ideas of entrepreneurs. They should be the information should be, the market should be informationally efficient, and they should be able to allocate capital in a more productive use. All right, so market regulation, if you don't regulate the market, the players can be susceptible to fraud, theft, insider dealing, etc. So what we normally do here is that we have to protect the unsophisticated investors. So meaning that the investor should trust the probity of the market. The regulators should have sound and robust rules, regulations in place to prevent any insider dealing, to ensure proper reporting. And also, in this case, the regulators might not be government only, because government at times, they give it to groups, to the industry groups. We call them self-regulatory organization, so that they are delegating their regulatory authority to the players in the industry that understand that industry. So because if we have a good functional system, the financial market will function very well. There will be liquidity in the market. Projects will be funded properly. Ideas will be funded, and economy will grow. But if we don't have that, then the economy will be in shambles. Ideas will go unfunded, etc. All right, so let's quickly go to the market efficiency. Market efficiency is just saying that the market that we are operating in is efficient. So we have major three types. So what are the things that contribute to market efficiency? Market participants. If market participants in that market, if there are many, it means that arbitrageurs will force the market to be efficient. But if few analysts are following that market, it means that the market might not be efficient. So information availability too and financial disclosure should be strong. If it is strong, the market will be efficient. If you limit arbitrageurs or short sellers trade, that market is not efficient, because the arbitrageurs, the short sellers are the ones that force the market to be efficient. Also, the transaction and information cost should be minimal. If it's too high to obtain information, that market will not be efficient. So there are three types of market efficiency according to market efficiency hypothesis. We have the weak form. The weak form is saying that all information about that stock, in terms of the price, the past prices of volume, they have already been reflected in the price of that stock. It means that if you are trying to do technical analysis to gain any positive risk-adjusted returns in that kind of market, you cannot achieve such. If you have seen all those people that are playing Baba Jebu in the past, you will see that when they want to play the game, they normally look at the price, the past prices. They will be looking and say, in 1964, this price was this. So what they are simply doing is that they want to say that the past prices or volume will represent the future price. But we are saying that in an efficient market, that will not be the case, because the security has already reflected all the past information. In a semi-strong, is saying that the security has already reflected the past information and the currently available information. So you using your fundamental analysis, using your dividend growth model, free cash flow to see whether you can achieve a positive risk-adjusted return will not work. So in a strong form efficiency, we are saying that the market already reflects past information, security information, publicly and private information. However, insider dealing is found out, so we say that no market is strong form efficient because nobody has a monopoly to any information. So so we are now saying that, okay, so if you now say that the market is efficient, so meaning that portfolio managers, they don't need to be active anymore, right? You trying to buy superior stock so that you can get superior gains will not work in future. So what we are saying is that people can easily invest in an index, because the index has already reflected the sentiment of the market. and you are saying that you cannot even achieve positive risk-adjusted return in the market. So I don't need to actively manage my portfolio anymore. I should just passively manage it. So we are saying that in future, the role of portfolio managers will be more of advisory than doing active management. All right, so another thing is on the anomalies that is experienced in the market. We are saying that if the market is efficient, why are we having all these anomalies? Like all these time series anomalies, cross-sectional anomalies, where in January, prices might not go up, or on a Friday, prices will depress. On Monday, price will depress. On Tuesday, price will start going up. So what is known is that all these anomalies, they are not saying that the market is not efficient. In fact, the anomalies are as a result of efficiency of the market, because they are saying that all the anomalies that you have experienced, they are not a violation, but rather they are a result of statistical methodologies that is used to detect those anomalies. So yeah. So also we have behavioral finance, which is talking about why people don't behave rationally, the things that make people not behave rationally. We have loss of action, why people are so this behavioral finance, it is all the observed behaviors that we have seen that will make people not to act rationally. So like now, loss of action, people are more pained when they lose like same value that they gain. So if you lose $10, you are more likely to be pained than the joy that you experienced when you gain $10. So they don't want to close their loss position. They just leave it there. Adding behaviors means that people are just following trend. You follow everybody. Overconfidence is when you so much believe in your own ability and you think your ability is the best. So that can also affect not to behave rationally. Also, we have mental accounting, where people are dividing their monies. Like you all have different bank accounts. You say, let me spend the one in GTB. I will not spend the one in Stanbic IBTC. You are simply doing mental accounting. Everything is still your money, right? We also have narrow framing, when you are just mimicking your ideas. When you try to cascade them down, you are just narrowing them. All right, so the last topic here is on security market indexes. So the index is like a basket, like your New York Stock Exchange Index, Nigerian Stock Exchange Index. We have S&P 500 index, S&P 200 index. All these indexes, they're a constituent of stocks. So like I said, if the market is efficient, you don't need to actively manage your portfolio. All you just need to do is just to mirror your portfolio or benchmark your portfolio against the index. Invest in all the things that the index has already invested in. So the index is a basket of securities, and these are being These are being put together by who we call index providers. So these index providers, they have a lot of decisions to make. They want to see what is the weight that they want to, the target market that they want the index to cover. Will it be Nigerian market? Will it be US market, etc.? Which securities they want to include there? What is the weight of these securities? How often will they rebalance it? And when should the selection or weighting be re-examined? So you have a lot of decisions to make, and the index weighting, that is where you might likely see one or two questions in your exam. You have price weighting, we have equal weighting, we have market capitalization weighting, float adjusted, and fundamental weighting. So all these weightings, they are different from when the examiner is asking you what is the total return of an index. So they can ask you what is the price return of an index, what is the income returns of an index, or what is the total return of an index. So the total return is a combination of both the price and the income. So I've seen some confusion where the examiner will say, what is the price return of the price weighted index? The examiner is not asking you for what is the total return of that index. The examiner is simply asking you what is the price returns of that index. So how do we do price returns? All you just need to do is do the sum of all the prices of the stocks, of the constituent stocks, divided by their number. You have to adjust for split. I don't expect that to be too much of an hassle in everyone. What is the advantage of this? It's so simple and straightforward. However, the disadvantage is that the high price stocks, they will have more weight as compared with the lower price stocks, right? For an equal weighting, what they are simply doing is that they are simply giving all his stocks an equal weight. The advantage is that it's also simple. However, the major disadvantage of equal weighting is that you have to periodically rebalance your portfolio. Why? Because the weight will change as the prices of the constituent stocks changes. So what you need to do is you have to consistently sell or buy to mirror those weights. Buying and selling will increase your transaction cost. That your transaction cost will have a negative impact on your returns. That is the main disadvantage of that. So market capitalization is just giving weight based on the market capitalization of that stock. That is the current stock price multiplied by the number of stock. Then they will now use to give weighting to those stocks. However, there's another variant of market capitalization, which we call market float or free float, which is simply saying that you have to adjust for the number of stocks that are available for investors. Like if you check Apple or some stocks, or let's say Facebook, it is not 100% of their stocks that is tradable. The owners, they might have like 25%, 30% somewhere that public investors cannot access. So in that case, you have to adjust the number of shares to the number of stocks that can be accessed by the public. That's just the difference between the market capitalization and the free float. Yeah, the main disadvantage is that it will overvalue, definitely, high market cap stocks, and tend to undervalue the undervalued stocks tend to give a low weight, while the overvalued stocks, they will definitely get a higher weight. All right, so we normally say that if you are owning a portfolio that track value index, this kind of market capitalization index, you are following what we call a momentum strategy. That is, successful stocks are given greatest weight, while the poor performing stocks are given lower weight. Fundamental weighting means that you are giving weights to the constituent stocks based on their fundamentals, like their earnings, their dividend, their cash flows, etc. All right, so now the thing that you need to understand here is, why do we use market index? Market index is it's a reflection of the market sentiment, like I said earlier. You can also use it to benchmark managers' performance. You can use it to measure market returns and risk. You can also use it to measure better risk-adjusted return, etc. So what are the types of equity market index? We have the broad market index that is invested in all the equity market. We have the multi-market index. We have the sector index. We have the style index. Now, another thing you should understand is the difference between rebalance and reconstitution. Rebalancing means that the index providers, they are adjusting the weight of the constituent stocks. So rebalancing is when you, as a portfolio manager, you are adjusting your weight of your portfolio to mirror the index weight. And you, like I said earlier, this is more a problem in an equal weighted index. Reconstitution is what the index provider does. They will add, delete securities that make up the index. So when they are deleting, when they are adding, you will also be what? You will be rebalancing. Because so many things can make them to rebalance. The firm might be bankrupt. The firm might be expressing some corporate issues. The firm might be delisted from the listing, or it might even be at the subjective judgment of the community, of the committee, to either remove that stocks or add it, right? So that is one of the costs that you're going to incur when you are tracking an index, right? So for fixed income index, it's the same thing like equity index. It's created like equity index. But the issue is we have so many fixed income and their issuers are different. Their coupon rate, their maturity, their default risk, fixed income index. However, you would agree that like equity, you can hold it to perpetuity, but fixed income, they have a mature date. So it means that as soon as that maturity lapses, that fixed income is gone. So it means that the index provider, they have to continuously add and delete based on their maturity. So that is why there is a lot of reconstitution, let me put it out, in fixed income index, because they have high turnover rates. So people, as they mature, they have to replace it with another one. So that is why a fixed income index, it has a high transaction cost. It has a high turnover of constituent of security, and form is usually dealer's market. That is, it is illiquid. It is not like equity that trades off. So because of the liquidity of it, the high turnover rate, the transaction cost because of the high turnover rate, it makes fixed income index to be more expensive and very difficult to manage and replicate by portfolio managers. This is one of the key things that you should know about the difference between equity market index and fixed income index, right? So another index that we have is the alternative investment index, which talks about the commodity index. This represents commodities such as the grains, the hive stocks, etc. We also have our REIT, that is your real estate index. We have our hedge fund index as well. So there are so many indexes that you can see. We have Dow Jones, how they are being constituted. Like Dow Jones average, it is 30. The number of stock is 30. The large US stocks, they use price weighted, etc. So this is also in your curriculum. It's just there just for your knowledge sake. All right, so we are done. Then we are moving to the question session. So please, guys, the questions here are many. I want you guys to answer them and let's see. And if I see anything, I'll be able to explain further to you guys. So let's start with number one. The behavioral bias in which investors tend to avoid realizing losses, but rather seek to realize gain is best described as. So just put numbers and the answer there and let's see. I can see only 2 people answering. Okay. Okay, I can see a lot of C. Yes, you guys are right. The answer is C. Number 2, return from a depository receipt are least likely affected by which of the following? Number 2, least affected. Least affected. Least affected. Just put the number. I see a lot of C. I see a lot of C. I see A as well. Wow. Okay. Sadiq said is B. Okay. Guys, I don't know why most of you are picking C, but you will agree with me that if analysts recommend that a particular depository receipt is bad, you will agree with me that the price it will definitely affect the returns of that depository receipt. Your exchange rate movement too will affect, just like an example that I gave. If you bring in the stocks in US down here, because you bought those stocks at 385, if they are now 530 when you sell his stocks, you will agree that it will affect the returns, right? But the number of depository receipts will not affect the returns. It will not. The number of them will not. So the answer here is B. Number 3. Who wants to try number 3? Which of the following statement is least accurate with respect to fixed income? I think I just explained this, right? Many of the underlying security index tends to be illiquid. The index are susceptible to turnover of the underlying. Compared with it, it is easier and less expensive to replicate. What do you think the trade is? I think it's something that I just explained now. It is because of A and B, that is why your number C is there. Because of the high turnover, the illiquidity, because it's a dealer's market, that is why it's more expensive to replicate fixed income index. Number 4, which of the following is most likely one of the main functions of financial system? Number 4, put number behind your history, right? Or beside your answer, put numbers beside your answer. Main function is most likely the main function. So for people that are picking B, I know where your confusion is, right? You say which of the following is most likely one of the main functions of the financial market? Determine an equilibrium rate, ensuring that markets are informationally efficient, ensuring that all investors projects are receiving sufficient funding. Which of the following is most likely one of the main functions? They are basically, okay. So let's break it down. If the market is functioning properly, then information will be efficient. If market is functioning properly, projects will be funded. However, for market to be functioning, the market should be able to determine the equilibrium rate. Let's go back to this thing, to this slide here. Let's go to functions of markets. Can you see here? Let's see market functions. Okay, so these are the reasons why we want to use financial markets. So the main function of financial markets is that they want to facilitate people to use it. They want to ensure that people are achieving their objectives, right? They want to set the equilibrium rate. They want to be able to allocate capital to best use. If they are able to do this, right, then it means that, just like the conclusion that I gave you guys here, when they do not, if they're able to do that, it means that they will function properly, liquidity will improve, projects will be funded, ideas will be funded, economy will grow. It will grow. If they are unable to do that, that is when you will have all those things there. All right, so don't worry, CFA Society, I will introduce Fola in the next 5 minutes. Fola will be taking derivatives by 4. So I still have about 11 minutes to go. So Fola, please. Huh? All right, so your number 4, the answer is actually not B or C. Your answer is A, because you should be able to determine the equilibrium interest rate. Number 5. Number 5, let me take this off. put your number beside your answer, please. An equity analyst follows two industry with the following criteria. One, industry one, a few companies with proprietary technology products with unique features, high switching cost, and minimal regulatory influences. Industry two, a few companies producing relatively similar products, sales varying with disposable income, employment level, high capital cost, and investment in fiscal plan. Rapid shift in market shares of competing firms and minimal regulatory. Based on the above information, the analyst will most likely conclude that, compared with industry two, those in industry one will potentially have what? What do you think they will have? What do you think they will have? Okay. Okay. I can see C's, yeah. I can see it. Okay, well, Africa Business Radio. I don't know your name, but you put Africa Business Radio. Why do you chose B? Why B? Okay, okay, that's fine then. Also, the answer is C. Jesu Tofumi Ibukun. Yeah, the answer is C. Number 6, for a US investor, which of the following statements concerning the investing in depository receipt is least accurate? What do you think? I think I explained this during the course of our listing. Investing in DRs could provide appreciable opportunity and entail investors in unsponsored DR will have the same voting right as the direct owners of common shares. Okay. Sponsored DR are subjected to greater. Okay. Okay. Yeah. Yeah. I see a lot of answers on B there. Yes, the answer is B. That's good. Number 7. Number 7. Okay. 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 That's fine. Yeah, that's fine. That's fine. That's fine. Yes. Number 8. Yeah, the answer for number 7 is C. Number 8. Number 8. Yeah, I think we discussed this as well, that yeah, a secondary market is a continuous market. Number 9. Can you quickly do this number 9? The fastest finger get a gift from CFA Society. So the difference between this number 9 and some question that you might see in the exam, you might see this type of question in the exam, or that your expected stock value at the end of year 3, you might be asked to calculate it in the exam. That's when you calculate your terminal value or your perpetual value, right? But if that is not the case, the examiner might give you perpetual value. And like I said during the class, that perpetual value, you must add it to the last year forecast of your forecasted revenue, right? To be able to discount at that proper year. So don't be using year 4 or the following year discount rate to discount it, right? You should use, so you might make a mistake if you do not discount that perpetual value or if you do not add it to the last year dividend value to be able to discount to present value, right? So what you should do is your D1, you have your current dividend, you have your historical annual growth rate. The examiner has given you expected annual dividend for the next 3 years. So you have to grow that $3 dividend by 8% for 3 years. That is 3 times 1.08 in year 1. In year 2, it will now be 3 times 1.08 raised to power 2 in year 2. In year 3, it will now be 3 multiplied by 1.08 raised to power 3. Whatever you have in that year 3, you have to add 33 to it. Then the examiner has given you the required rate of return, which is 15. So you have to discount year 1 dividend forecasted by 15%. Year 2, 15%. Year 3, by the year 3 forecasted dividend plus your 33. That is how you can get the value there. And this is highly testable. Huh? Use your calculator properly. Use your calculator properly. Yeah. Ibrahim, you have to check the use of your calculator properly. The answer is B, but the difference is why some people I chose A or C will be because of the discounting that I just mentioned, right? So check your calculator and ensure that you have the technique right? Number 10, let's see if we can do the number 10 before we round up. It's on equity index. The equity index. So now look at the requirement. It's saying the price get total returns. The examiner is asking you for total return. So it's easy. Remember to calculate your price of an index, whether beginning or end, for a price weighted index. What you need to do is the sum of the value divided by the number of stocks. So if you look at the beginning period, it is 10 plus 20 plus 30. That should give you 60. Divided by 3, that should give you like 20. So the price of that index is about 20 at the beginning of the period. The price at the end is 9 plus 21.5 plus 33. 33 plus 21.5, that'll be 53, 54.5. 54 points. That'll be about 64. Yeah. Hold on. Hello? Hello, what do we have? I'm waiting for your answer. Just put your this thing beside it. Yeah. So your end of period is about 64. Had it been the examiner has asked you for price returns, it will just be 64 divided by 3. Your price at the end of the period will be 21.33 minus 20. That will have given you a return of 1.3, and in percentage, it will have been 1.3. It will have been 1.3 divided by 20. Then your price return will have been 6.7. But in this case, the examiner is asking for total returns. So you will have to add the dividend with 1 plus 8 plus 6, that will be 2.4 divided by 3. Yeah, that should give you like 0.8. So if you add your 0.8 to 1.3, 1.3 plus 0.8, that will be about 2.1, divided by that, yeah. Okay. Yeah, I can see a lot of this thing there, yeah. Yeah, so your answer is A. All right, guys, we are at the end of equity. Thank you so much. But a piece of advice in 30 seconds before I go, please don't fast on the exam day. Eat very well. You have to hydrate yourself as well. You have to ensure that you have enough fluid. And in the afternoon, before you go for the afternoon session, please eat. Eat. If you don't have any medical condition, you can take Coke so that you are sharper than honey. Because from experience, afternoon usually seems difficult than honey, but in the real sense, it's not difficult. But because brain fatigue setting, that is why you might see it very difficult. So when you have the break, eat very well, do as much as you can, practice as many mocks as you can, and the society will also send the slides on that thing that I sent to you, and I'll send them his slide as well, which can guide you on your revision. Thank you so much, and have all the best. All the best. All right, guys. Bye. Fola, over to you, huh?
Thank you. I think that some ads are going to play.
No, you can go ahead, Fola.
Great. Everyone, just give me my screen. Right. Then you can confirm that you can see my screen and you can hear me clear.
We can't see your screen, but we can hear you.
Just a caveat. You get the sound of children making noise. Ignore it. I apologize for that. That's fine. Hopefully the screen should come any moment now. But before that, I'll just give an introduction. Basically, this is derivatives and good thing about that is 6% of the list with
Sorry, Fola, we can't hear you.
is,
We can't hear you clearly. I think your network is kind of touchy.
All right, let me. Yeah. Yes, please, can you hear me now?
Yes, we can. Tola.
Right, let me share my screen again, and apologies for that. Hold on. Right. So yeah, so my screen should come on or should be on now. And so I was saying before that derivatives carries one of the least weightings in level 1. And the other good thing is that it's not calculation intensive, unlike level 2. So that's a good thing. If you look at the LOSs, it's more of a background course or a background module. So all the LOSs talk about defining, contrast, and comparing, determining, describing. So you don't have anything that says calculate, except for 1 or 2 concepts. But I think the basic of it is for you to just understand the dynamics of derivatives. And yeah, so another thing I would like to say is that practicing is very, very important. I know a lot of people that did not really spend time reading derivatives, but spent more time practicing the questions, and they were able to scale through. In fact, they got very good scores, despite the fact that they did not spend time reading the curriculum. So let's just quickly go ahead. So what I'll do is I'll quickly scale through all the important points, and then we'll take about 12 questions, and then we'll call it a day. So if you have any questions or you have any comments, you can just pop them in the chat box, and once in a while I'll check on them. So for reading 48, I'm not sure if this has changed, but these are the things that you're expected to know. And the first thing we need to talk about is, the first thing that comes to your mind when somebody asks you what a derivative is. A derivative is a contract. That's the first thing that should come to your mind. It's derived from another asset class. So it's derived from another security, from the spot market. So it's derived from either equities, fixed income, commodities, or even whether, and it's derived from something. Just, that's the first thing you need to know. And one thing you need to know is that they are similar to insurance. They transfer risk from one party to the other. So if you have an item and you fear that the value of the item will fall, you can always enter into a contract to lock in a price to say, okay, I'm going to sell this item to you in 1 year's time, meaning effectively you have hedged yourself. You have avoided the risk of the value of this item falling. So that's basically what a derivative is in a short sense. And another thing is that when you are a buyer, you are long, and when you are a seller, you are short. And this is what is going to be used. So this is just one of the nuances you need to remember as you go along through the 3 levels. Now, the 2 types of derivatives are forward commitments and contingent claims. Just remember that forward commitments, contingent claims. Forward commitments, the difference between the 2 is that one of them is more of an obligation between the buyer and the seller. So for the forward commitments, both the buyer and the seller have an obligation to do something. But for the contingent claims, you have one person who acquires a right, and then you have another person who sells an obligation. And we'll talk about this in the next slide. The major types of forward commitments, forward contracts, futures contracts, swaps. Contingent claims, you have options, which is the primary type of contingent claims, and then you have credit derivatives. So why derivatives? These are some of the points you need to remember. First of all, they can be used to create strategies. It's difficult for you in Nigeria, for instance. You can't take a GT bank and say you want to short a GT bank. So short means selling something you don't own. You can't take a GT bank and sell it and buy it. There are there are laws, there are constraints depending on different jurisdictions. And sometimes even when you are allowed to short, the cost of shorting might be very high. So derivatives allows you to do that. You can create strategies, you can short. It has a relatively high degree of leverage. What this means in this context just means that you are doing little with more. So for a forward contract, the cost of a forward contract at the beginning of the period is zero. So you're not necessarily paying any money. Your cost is zero. It is when the contract expires or the contract matures, that's when you start to exchange money and do transactions. And also the transaction costs are lower compared to spot markets. They offer a simple low-cost transfer of risk. Essentially, they help you to manage risk. Now, one key caveat is that for derivatives, it does not mean that you are eliminating your risk. You are essentially managing risk, not necessarily eliminating risk. And what do I mean? So if I gave an example of you having an item or a security, and you fear that the security is going to fall in future. If you enter into a contract, let's assume you enter into a forward contract, and you decide that I am going to sell this item to you at 100 naira in 1 year's time. If the price of the item in the market goes up to 200 naira, it's still a risk. It's an upside risk because there's an opportunity cost. You've lost out on the gain of that of the rally of the item in the market because you have locked yourself into a contract that allows you only to sell at a limited price. So there's a price ceiling for that forward. So that's the kind of risk that you would have. And then there are other similar risks for options and the other types of derivatives. Now, so this diagram just kind of explains everything in a nutshell. So you have the futures forward contracts, you have the swaps, you have the options, you have the credit derivatives. Now, the difference between the futures and the forward contracts is that the futures and forward contracts are somewhat similar, except that one is traded on an exchange. The futures contracts are traded on an exchange. The forward contracts are over the counter, meaning that you trade them outside of an exchange. For both of them, you have an obligation. If you are the buyer of a contract or the seller of a contract, you have an obligation. There's a predetermined price, and then there are other nuances to this. Now, swaps as well. Swaps involves an exchange of a series of cash flows. You might have a situation where you want to exchange fixed interest rates with floating interest rates, depending on how the yields move in the market. Now you have options. Options are contingent claims. Options are contingent claims in that they give you the right to exercise. They give you the right to exercise to buy or to sell, depending on the type of an option. So an option can either be a put or a call. A call is an option to buy, and a put is an option to sell. I'm just repeating all these things. I assume that a lot of us already know these things. And then we have credit derivatives. The major types of derivatives is a credit default swap. And a credit default swap is similar to insurance in that if you have a bond, for instance, a corporate bond, if you buy a corporate bond and you are scared that tomorrow the company is going to default, what would you do? You would go and meet a CDS, a credit default swap dealer, and you would say, my concern is that they will default. And what happens is you would pay them a premium, and if the corporation defaults on interest or principal payments, what happens? The CDS dealer reimburses you for that amount. And the difference between a credit default swap and insurance is that for insurance, you have to have insurable interest. But for credit default swap, you don't necessarily have to have insurable interest. And what do I mean? I don't have to own a corporate bond for me to buy a credit default swap on that bond. Let's say Nigerian Breweries has issued corporate bonds, and I don't have the corporate bonds. I can go and meet, let's assume we are in an advanced market. I can go and meet an investment bank and say, I want you to create a credit default swap on Nigerian breweries. If Nigerian breweries default, I will get this amount, but if they don't default, you continue to earn the premiums. And we enter into an agreement and that happens. The riskiness of the company, so the likelihood of the company defaulting determines the price or the premium that I will pay to that company. So that's the major difference. And I don't know if any of us remember, and that was what happened with AIG in 2009, 2008, when a lot of companies were selling credit default swaps on subprime mortgage ones because they didn't think that there were going to be defaults, and because a lot of people that bought the default swap did not have insurable interest, their liability claims, that's insurance companies, their liability claims ballooned, and that created like a crisis. Now moving on. So we talked about this. We talked about options, and we said an option is either a call or a put option. And we said, and now the next point is that an option can either be an American style option or a European style option. Now, an American style option means that you can exercise the option at any period in time, but European style, you can only exercise at expiration. Which one do we think will be more expensive between the American and European? Which one is more expensive? Let me just see if people are following. Where is the comment box? I can't find the comment box. Hold on. Okay, chat. Okay, American, good. So I'm happy everyone can hear me. Now, the next thing is an option can either be in the money, out of the money, and at the money. So first of all, we are probably now familiar with the notation that the value of a call is a maximum of 0 ST minus X. That is the value to the buyer. And if ST is greater than X, so ST is the price of the underlying, X is the exercise price. If ST is greater than X, you are in the money. You are out of the money if it's the opposite. You are at the money if this is equal to this. Now, I'm going to rush through a lot of the slides because I want us to solve the questions. So I want to leave enough time for the questions. Now, the profit to the buyer is the maximum of either 0 and ST minus X minus the cost or the premium you pay for the option. The premium you pay to buy the option. The profit to the seller is this equation here. However, you see that there's a positive here, meaning that the seller earned the premium. So in most cases, the maximum profit that the seller would likely earn is the premium. And that's because if ST for a call option, if the call option is not in the money, then the seller of the call pockets the premium. However, if the call option is in the money, this call seller loses some amount in the sense that the seller would have to sell at a price that is lower than the underlying price. Now, a put option is the opposite of a call option. So if ST, I think I made a mistake here. Okay, right. Let's move on. Okay, so for a put, if ST is greater than X, you have out of the money, less than X in the money, equals to X at the money. And this is the profit to the put buyer, profit to the put seller. Now, let's quickly look at the benefits of derivatives, which I feel might be testable. So you have the risk allocation, you have transfer, you have management. You can manage risk with derivatives. And I've used the example of you having an asset and you're scared that it might fall. What can you do? You can either buy an option or you can enter into a forward contract. There are cost implications to both approaches. However, they help you to manage your risk. There is also that price discovery. So if you look at the futures, S&P futures price, for instance, when people are trying to speculate on the S&P index, for instance, they look at the futures price, which is a derivative, as an indication of where the stock market might likely head, and they take position based on that. There are also operational advantages. There are also operational advantages such as a lower transaction cost, greater liquidity, and you can easily go short. And then you have the market efficiency. Now, the major criticisms of derivatives, they can be too risky if you have limited knowledge. There was this new wave at some point called binary options. It looked very sexy, and the people selling binary options were downplaying the risks. However, it's a very risky asset, so if people don't understand these instruments, it can be very risky. And because of the high leverage, you might lose a lot, because there can be high payoffs, and some people liken them to gambling, and they can be complex. So how many of us have heard of Black-Scholes model? It's a very complex equation, and it was what some company called Long-Term Capital used to make huge billions of dollars. But I mean, it was a very complex model. Right. Another point before we end this reading, one point to talk about is arbitrage. The curriculum seems to place a lot of emphasis on this, and arbitrage is just riskless profit. So what happens if you have two exchanges, if you have NASDAQ and probably New York Stock Exchange, and Microsoft is trading at $50 on NASDAQ and $70 on the other exchange? What can you do? You can buy on NASDAQ and sell on the other exchange, or sell on the other exchange and buy on NASDAQ. So basically, what you are saying is that arbitrage opportunities arise when assets are mispriced. So what happens when there's a mispricing, like I mentioned? People start to buy to take advantage of arbitrage opportunities, and then the prices move back to equilibrium. And in well-functioning markets with low transaction costs and a free flow of information, the same assets cannot sell for more than one price, and this is called the law of one price. So have this somewhere at the back of your mind. There's a reason why this has been emphasized. Is there a hacker on my system? I'm seeing like a red. Okay. Right, the next reading is the last. So there are just two readings, and this is the last reading. And I'll quickly breeze through it because some of the things that are here have been said in the first reading. So now, please give me a second. I need to charge my phone. Right, I'm back. Okay, now, let's move to the types of investors. And I'm sure you've seen this in risk management. We have the risk neutral investors, the risk averse investor, and we have the risk loving investor. Now, so the risk averse investor does not like to take risk. However, if they are going to take risk, they would like to be paid a risk premium for taking the risk. A risk-loving investor would take more risk for less returns. A risk-neutral investor does not really care about risks. Would require no risk premium, would take a risk without even taking a risk premium. Now, The reason why I'm mentioning all this is that you need to remember something. When you are pricing a derivative, when you are pricing a stock or a bond, for instance, what do you use? You don't use the discount rate you use is not a risk-free rate. The discount rate you use is probably a risk-free rate based on CAPM. So you use a risk-free rate plus some risk premium if it's a stock. Sorry, if it's a stock or a bond. Now for derivatives, you use risk-free rate because derivatives assume risk neutrality. So remember that derivatives assume risk neutrality. Why? Because when you are engaging in a derivative, you are somewhat eliminating, not eliminating, but you are somewhat reducing your risk to the risk premium. And what do I mean? Imagine if you have a stock and you enter into a forward contract to sell the stock. You've locked in a price, meaning that if the price of the stock falls drastically, you are still hedged. You still have a situation where you can sell your stock at the forward price. Now, in this sense, you have effectively, you have a risk-free asset. So the asset at the position time zero and a short position in a forward contract will give you the risk-free return. Why will it give you the risk-free return? Because when you are coming up with the forward price, you use the risk-free rate to actually come up with the forward price, and you see that in the formula. So the first thing you need to remember is you need to remember this equation here. So you have a situation where you have your S, you have your F is equal to your R. Now, and this is also called arbitrage. It's also called replication, actually. And why did I call this replication? You are, rather than buying a risk-free asset, rather than buying a government security, you go long an asset, you go short a derivative. Basically, you have the same as the risk-free rate. So you are supposed to have the same as a risk-free rate in an ideal market. When you are long an asset and short a derivative, what you get is the risk-free rate. If you have more or less than that, there are arbitrage opportunities. If you then rearrange the equation, what happens is, for instance, if you move this long risk-free asset here to the other side, what happens is you have minus long risk-free assets, which then turns to plus short risk-free assets. So because the minus long turns to short, so when you have minus long is equal to short, and then you have the short derivative moving to this side of the equation, and let me see if I can annotate. So what happens? You have this coming here. You have this. Where is this? Long there. Okay, sorry. You have this one coming here. So you have long turns to short, and then but the first thing you need to remember is you need to first remember this first equation. And how do you remember it? If you have an asset and you short a derivative or you short a forward contract, you effectively have a risk-free rate. And then you can then use this to derive the other equations. And the reason why I'm saying this is it can be testable. You can have a question where it says that under the replication approach, what is a long derivative? And you get options like a long derivative is the combination of a long asset and a short risk-free asset, or they can give you this as well. So that's why I'm explaining this. Let me see if I can erase all this. Right. Sorry, hold on. I don't know what's wrong with my phone. Okay. Now, so let's look at pricing and valuation of forwards. Let's quickly look at that. Now, the formula for a forward contract is the forward contract, sorry, the price of your underlying compounded by the risk. Remember, this is a risk-free rate. We said use a risk-free rate for a forward contract, and for derivatives, you ignore the risk premium. Now, there are also some costs associated with the forward contract. So if it's a commodity, for instance, you might have a situation where you will have the cost of carrying the assets. So the costs can be insurance, can be storage costs. And what happens? You add this to the forward contract, when you add this to the underlying price when you are coming up with the forward contract. Why is that? Because the person selling the forward contract, the person who is going to receive the forward price, which is the short forward, would have to bear this cost. But then, because you are buying, you've already effectively locked yourself into this contract. You as a buyer would have to pay this cost. So that's why it is implicitly in the forward contract. Now, this stuff that looks like Y are benefits. So this is a dividend or convenience yield, for instance. If there's a convenience yield for the seller of because the seller is the one that would hold the item or the asset till maturity. So what happens? This convenience yield is taken out. So like dividends, like interest rates are taken out of the equation so that you pay an amount that is less this convenience yield. If the benefits, so this is another important point, if the benefits exceed the cost, then the forward transaction would return less than the spot transaction. So all you need to do is just look at the formula and see if this Y is greater than this theta, what happens to the whole formula. You don't need to cram this. Okay, I wouldn't spend so much time in forward rate agreements, but there are agreements that that effectively allow you you can buy forwards on interest rates. So they're usually based on LIBOR or euro dollar time or Euribor, sorry. And you would see more of this in level 2, and I don't think it's accessible from a level 1 standpoint. Pricing and valuation of futures contracts. Key things to remember with futures contracts. The first is the futures exchange, they provide a guarantee, a credit guarantee, meaning that for forward contracts, because they are OTCs, if the contract matures, the other side of the contract can actually abscond or can default, and you will have to go through different means to try and recover your proceeds. But for this, the futures exchange provides a guarantee. So in that sense, you can say that default risk is zero for futures exchange. So also, in terms of valuing the futures contract, for forward contracts, you can value the contract anytime during the contract period. But for futures contract, every day the price resets to zero. And why is this? Why is this? One point you need to know is that whenever you come into the futures exchange to buy or to sell a futures contract, you are effectively going to bring forward a margin. So the first margin is your initial margin. So what happens? You have an initial margin of $20, for instance. If based on the price movements on a daily basis, your margin falls below a certain amount called the maintenance margin, what happens? You have to bring up an amount back. You have to bring up some cash to bring your margin back to the initial margin. And sorry, the other thing is that if futures prices are correlated with interest rates, futures contracts are more desirable to the holders of long positions than forwards. Why? Because if interest rates rise, and so there's a positive correlation, interest rates are rising, your futures prices are rising as well, meaning that your margin balance continues to increase. As your margin balance increases, the money is just not sitting in your margin account. The money is kind of being invested at some risk-free rate. So it means that you are earning money in your margin account and you are earning some interest rates. And at the same time, when interest rates are falling and your futures futures prices are falling, then yes, you are losing money from your margin account. However, the opportunity cost from investing that money in interest rates means that, because interest rates are falling, you're not going to get much anyway. So people prefer futures contracts when there's a positive correlation. However, people prefer forward contracts when there is a negative correlation. So forward contracts will be more desirable than futures, like I said. Pricing and valuation of a swap. So a swap is essentially a series of cash flows, a series of exchange of cash flows. And the main thing to take out of this is a swap is a series of forward contracts. Specifically, it's a set of contracts expiring at various times in which one party agrees to make a fixed payment and the other receives a variable payment. So what happens? At this point, an exchange of cash flows are made. At this point, so this can be as a series of four contracts. Yes, can you now? Sorry about that. I'm erratic today. Now. Can any...
Hello, Fola. We can hear you, but the line is breaking. Hello.
Please, can you confirm if this is better?
Yes, it is, Fola.
Hello.
Hello, Fola. We can hear you. Hello.
Okay, go ahead. And apologies for them. Yeah, like I said, network is really bad today. I don't know about this. If I'm trailing or my network becomes again, please just let me know so I can if I can switch provider. Right. Sean, you have a Sean where sorry.
Once again, everyone, apologies for Bay. He's been trying to log in and he's still trying right now.
Right. I'm so sorry for this, and unfortunately we are running out of time. So I'll just quickly rush through what I wanted. So I'll just quickly rush through what I wanted to talk about. So there is a direct relationship between time and the European call, and then there's a direct or inverse relationship between between time and the European put. And why is this? It's because the put holders are waiting for the sale of the underlying, for which they would receive the exercise price. The longer they have to wait, the longer the lower the present value of the payoff. If you think about it, it will make sense. Unfortunately, because of time, I can't really explain. And I'll send these slides over so you can just look at it, and it kind of explains everything. There's a direct relationship between volatility and the value of the option in both cases. Now, there's something called the put call parity, and this equation is basically the put call parity, where you have a protective put that must be equal to a fiduciary call. When you have a protective put, this is a protective put, a long stock and a long put, and then a fiduciary call, you have the long risk-free coupon bond, zero coupon bond, and a long call, which is the fiduciary call. When you equate this together, what do you have? You have put call parity. And when put call parity does not exist, what happens? Arbitrage opportunities exist. Now, if the testable part of this equation comes from these three equations here, where you can say a question that says, according to the put call parity, a long put is equal to this, or a long call is equal to this. So all we did here was to rearrange the equation from the put call parity, which says this plus this, that is your stock plus the put, is equal to a zero coupon bond and the value of the call. So you can then use put call, you can then rearrange the equation to get any of this. Now, the binomial valuation model is the last thing we'll talk about, and it's another model for valuing the options apart from the Black-Scholes model, which you'll see in level 2, and you'll see more of this binomial valuation model in level 1. And what happens? You have two factors. You have the up and the down factor. The up, is like the
Excuse me, Fola.
Yes.
Sorry, we can't see your screen.
Oh, sorry. Hang on. Oh, I forgot to share my screen. I apologize. I apologize for this. Okay, right. So we were looking at different things, and if you go through the slides later on, I'm sure it will make sense. But these are some of the things that I talked about. I talked about the relationship between different variables and the options. I talked about okay, so there's another thing we need to talk about, which is the minimum value of an option. The value of an option, of a call option, is maximum of 0s minus x. But the minimum value of a call option is different. It is the maximum of 0 and S0 minus the present value of the exercise price. And it's the same thing with the put. Not the same thing, but I mean, it's a similar concept with the put. The minimum value of a put is maximum of 0 and the present value of the exercise price minus S0. So the lowest value of a European put is the greater of 0. Okay, so this is just highlighting what I said here. So that's the minimum value of an option, which is different from the value of an option. Now, I talked about the the put call parity, which is this one, which is a long stock plus long put is equal to the long risk-free zero coupon bond plus the fiduciary call. And you say for put call parity to hold, must be equal to this. Your fiduciary call must be equal to your protective put, or else there will be arbitrage opportunities. And I said these equations, you can get a question that says under the put call parity, what is a long put? And then you then have to rearrange this equation here, which you would have derived by reasoning that the protective put must be equal to the fiduciary call. And you can get any of this. Now, lastly, we're talking about, I said, binomial valuation of options. You have an up factor and a down factor. And you have a formula here. Unfortunately, I can't go through the intuition behind the formula, but you have this pi here. Now, this pi is called a risk-neutral probability. From the curriculum perspective, it is not a probability. It is just a risk-neutral probability. And it is also called a synthetic or pseudo probability. And they produce the weighted average of the next two possible call values. And to get the value of a call, you use this formula, and to get this pi, it is this formula. Now, the U or D factors is the up and down factors that drive the price of the stock. And then this R is the risk-free rate. Now, for American pricing of a call option, we said the value of an American call is higher than the value of the price when you're buying an American call is more costlier than a European call because you can exercise anytime. Now, one important point before I close is that it is worthwhile to exercise a call just before the stock goes ex-dividend. What does that mean? It's better to exercise a call before the stock pays dividend. Why? If you have an option to buy and you exercise the call, what happens? You buy the underlying and you hold the underlying, meaning that you can then earn dividends on the underlying. But for puts, it is the other way around. Early exercise is discouraged for puts, for underlyings that are going to pay dividends. Because why? A put is an option to sell. So if you have an underlying and you have a put option to sell, if you then exercise the put and you sell, you miss out on the dividend. So that's just what we are saying. So what we are saying is early exercise is worthwhile for a call, but not for a put. But however, if there is the other way around, if there are costs associated with them, if you are going to incur costs on the underlying, then it is worthwhile for you to exercise the put so that you don't incur the cost. So that's it for derivatives. And once again, I am so sorry for my presentation seems all muddled up, and I hope you could catch one or two things. I would send the slides over, which is quite comprehensive and describes everything I have said. And so unfortunately, we can't go through the questions that I really wanted us to go through because of the network issues I was having. But my advice to everyone is practice. You are better off practicing more than trying to read and remember or cram things. If you practice, you are better off scaling through because you are putting yourself in an exam condition. You are understanding how the institute is going to test you. It is better for you to practice than to go into the exam thinking you know it, and some of the questions catch you off guard just because of the way the questions are asked. Sometimes they ask questions in a very confusing way, and they make the options so similar that you would get so confused. But for you to familiarize yourself with this, you need to practice. So once again, best of luck in your exams and have a wonderful evening. I would hand over to Yemi for closing remarks, but before then, I think there's going to be a short break. Thank you and good evening.
Oh, hi. No, not Yemi, rather Frank Okwidadi. My name is Frank. I just said that. I work with CFA Society Nigeria. I just want to say a big thank you, to especially our facilitators. It's basically selfless service that they offer, and the students and the society, we're grateful for what you guys do. So thank you so much to all the facilitators. We also want to thank our sponsors. I know we'll be playing the videos a few times today. Just want to thank them because they keep this going. They keep this going, and I hope that you students will actually encourage them by signing up for their courses and at least letting them help you through the exam process. I want to thank you guys as well, the students, for attending the sessions. I know it's a form of trust to know or believe that what we are doing here will add value to what you're doing, greater than you spending this time reading by yourself. So thank you for that trust that you've placed in us. I want to thank the society as well for organizing all of this. I wish you guys the best in your upcoming exams. And if you have any questions, do not fail to email or call us. I know a few people have been asking if the slides will be made available. We have your emails. I need to speak to the facilitators to find out if their slides are proprietary or if we are allowed to send them to you. But we will do our best to give you all the support we can. And if we can send the slides, we will. So thank you. Please enjoy the rest of your day.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? I tuition to help with your pursuit of the highly prestigious CFA charter. If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further. Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.